So till yesterday we have completed the provisions of SA 500 we have completed. So audit evidence related discussion we had completed successfully. So now we are going to revise from SA 230 relating to audit documentation. So as I was saying, audit documentation is the most important thing. How much effectively you do the audit, that doesn't matter, but how effectively you maintain the documentation, that is going to be very, very important. So but what exactly is this audit documentation? What is the meaning of audit documentation? How the term audit documentation has been defined? Audit documentation means it is a record. Record in the sense it is a storage of what? It is a record of audit procedures performed, audit evidences obtained, and conclusions which are reached by the auditor. So while conducting the audit, what and all you have done, basically from the beginning till the ending, from the time you have been appointed till the time you give your opinion, what and all you have done in your audit. So what audit procedures you have performed, by performing that audit procedures, what kind of evidence you have got, on the basis of that evidence what kind of opinion you have expressed, everything we need to store it. That recorded information, that stored information, we are going to call it as audit documentation. See, basically what will happen is audit documentation is a very detailed program, very detailed thing, in which starting from, if you have gone to the entity, for example, a client X Limited has came to you and gave you the audit appointment. So what we will include in the audit documentation, not just audit procedures, audit evidences, not just conclusions. We maintain the details like our engagement team. Who are our engagement team? Who is the engagement partner? And who are the article assistants, who is the audit manager, who is the paid assistant. So that details also we will maintain. And we will document something called plan, strategy, program. At the beginning of the audit, we develop a audit strategy, we develop a audit plan, we develop a audit program. Even that audit strategy, plan and program we are going to document. What is the date of starting audit? Each area, when it was started, when it was ended, who did which area. So as we all are aware, when engagement team has been assigned the audit, work will be divided among all the engagement team members. Which person has handled which area of the work, when he started, when he ended, in that specific area what procedures he performed, in that specific area what evidences he has gathered, and on the basis of that evidence in that specific area what is the conclusion. Now after all this audit, how that opinion has been arrived, how you have concluded whether a misstatement is material. If you have concluded a misstatement is material, is it pervasive? If you are considering it as pervasive, on what basis you have considered it as pervasive? Then how you have decided which kind of opinion is appropriate, unmodified, modified, or in modified also qualified, adverse, disclaimer, how you have decided your opinion. So everything, and finally we will give an audit report, right? In the previous session we have understood what is the meaning of the audit report, how the audit report will look like, that we have seen. Even that audit report also should go and form part of audit documentation. So such a comprehensive information is audit documentation. It includes everything whatever we have done in the audit. Now what is the purpose of audit documentation? What is the purpose of audit documentation? Why it is important to maintain the audit documentation? What is the main objective of maintaining the audit documentation? So the main objective of audit documentation is, if tomorrow someone is coming and asking you, boss, you have given report on this company, you have told so and so opinion on this company, what is the basis for your opinion? So I should be able to prove my documentation, no? So I should have something in my support to say that, boss, this is the basis on which I have given my opinion. So basically the main objective of maintaining audit documentation is a sufficient and appropriate record. And tomorrow if someone comes and questions you, you have done the audit, what is a guarantee whether you have done the audit as per the standards on auditing or not? As we are telling, whenever you do the audit, you have to do the audit in accordance with standards on audit. If tomorrow someone comes and questions you whether you have planned and performed the audit in accordance with the standards on audit, I should have something against me to prove. So what will come to your rescue there? Audit documentation will come to your rescue there. So the two main objectives why audit documentation is maintained is, it will act as a sufficient and appropriate record for the basis of your report, and also it will act as a evidence that you have planned and performed the audit in accordance with standards on audit. These are two main purposes, but apart from that it also serves various other purposes also. Main purpose is that, but apart from that it also serves various other purposes. What are all that other purposes it will service? It will assist the engagement team to plan and perform the audit. If you have a proper documentation in place, it will help your engagement team members to properly plan the audit and to properly perform the audit. And also it will assist the engagement team to direct and supervise the audit work. Basically engagement partner can monitor you in a better manner, and it will make them accountable for its work. How come audit documentation will make the people accountable for their work? So as we are saying, as we have told previously, work was allocated to which person, who has done which work, that also we are including in the documentation. So tomorrow if something has gone wrong, instead of going and searching who has committed that mistake, what I can do is I can open my audit documentation, check where the fraud has been identified, that work was allocated to which person. I can easily pinpoint. Tomorrow he can't say, no, sir, I did not do it, someone else has done it. You can't say it, no. Why? Because it has already been documented. Next, retaining a record of matters of continuing significance. So in the audit documentation, you maintain those matters which are very important, that will not just help you in the current year's engagement, it will also going to help you in the future year engagements. And it will also enable quality control reviews and inspections. In the sense, see, if inspection has to happen, that could be internal inspection or even it could be external inspection. Next point, they say external inspection. Whether it is internal inspection or is it external inspection. If inspection has to happen, there should be documentation. No documentation, no inspection. If there is no documentation, how you are going to inspect? Say for example, I'm an engagement partner. I want to make sure whether my engagement team has done the work in a qualitative manner or not. I want to do the inspection. If documentation is there, I will inspect. If documentation is there, no, how can I inspect? I can't go back to the time. No, I can't do the time travel and see. So if I want to do the inspection, only thing I can do is audit documentation verification. Similarly, if any external inspection should happen, sir, when external inspection will happen? I say we'll do something called peer review. Sometimes if I say is having suspicion whether chartered accountants are practically doing their works properly or not, if I say is having suspicion, they will do something called what? Peer review. So if I say has to come and do the peer review, if documentation is there, they will do the review. If documentation is not there, what review they will do? Nothing they are going to do. So for any inspection to happen, either internal or external, what should be there? Documentation should be there. And what will be included? What are the examples of audit documentation? So all this will come in the examples of audit documentation. So what are all they? Audit documentation may be recorded in, and one more thing, it should be recorded, it can be in paper form or it could be in electronic form. So previously what used to happen is, people used to have in the audit offices, you will be able to find one room, documentation room they used to call it. So in that there used to be big box files and all. So when you open that box file, you will find half pages, which other half will be eaten away by the rats. So that used to be the status of the documentation room. You used to have bulk of papers and all, files and all used to be there, full of dust and thing. That's how the audit offices used to look like. One documentation room used to be there specifically. But today, auditor's office itself is a single room. In that also, if you need a documentation room, it's going to become very costly. So, but we are maintaining documentation. How we are maintaining documentation? In an electronic format. So simply, what I generally do is I buy some cloud space. There I will keep a folder. All my documentation I will keep it there. Clear? So you can maintain data in electronic format or other medium. So what and all will be included in the audit documentation? Everything, as I have told, whatever you do in the audit, everything will be included in the audit documentation. Your audit programs like audit plans and strategies, whatever analysis you have done, issues memoranda, nothing but queries also we say. Summaries of significant matters, letters of confirmation representation, checklist, correspondence, that means whatever communications you had. So everything should form part of my audit documentation. And one more thing, say for example, anyhow, auditor is doing the audit and he will maintain the documentation, all the evidences he will gather, no? Since auditor is anyhow maintaining the audit documentation, can the management destroy their books of accounts? Can the management say, auditor anyhow is having the audit evidence, no? Why I need to maintain once again the books of accounts? Can they throw that books of accounts? No. So that's what the statement they say here. Audit documentation is not a substitute for entities' accounting records. Just because auditor is maintaining audit documentation, the management cannot throw away their books of accounts. If they have to retain, they have to retain as per the provisions of the Companies Act. What is the purpose of audit documentation? It will act as a evidence for the auditor. That's why auditor is storing audit documentation. He's not storing that, okay, my client is having a trouble in maintaining books of accounts, let me maintain in the form of audit documentation. That is not the purpose. The purpose of maintaining audit documentation is different. The purpose of maintaining books of accounts is different. So audit documentation is not a substitute for entities' accounting records. And this we will say need not include superseded documents and all that. I will cover it later. That point we will talk about it. Next, okay, I told what is audit documentation, what is the purpose of audit documentation I have told, what is the main objective of audit documentation I have told. Now comes the next question, what should be the format? In what form I have to maintain the audit documentation? Is there any specific format? Standards on audit, even SA 230 did not specify any specific format for maintaining documentation. They did not give any specific format. Then what they have told? Simply what they have told is they have left it to your professional judgment. They told one thing, you maintain documentation in such a manner that if some other experienced auditor, even though he doesn't have a connection with this audit, whatever you have done, he should be able to understand what audit procedures you have performed, what evidences you have gathered, what conclusions you have reached. He should be able to understand just by going through your audit documentation. So you use your professional judgment, you decide accordingly in whatever manner you want to maintain the documentation, but you should make sure that some other person, some other experienced auditor, even though he doesn't have a connection with this audit, if he goes through your audit documentation, he should be able to understand how you have performed the audit, what procedures were performed, what evidences were gathered, and what conclusions were reached by you. Understood? Clear and comfortable. Next. And one more thing, this one, timely preparation of audit documentation. You should be preparing documentation in a timely manner. See, can I say, I will give you two options. You are performing audit procedures and you are gathering audit evidence throughout the audit as and when you perform the audit procedures. Today, if I have performed audit procedure, immediately, what is the outcome? I am documenting. So as and when you perform audit procedures, as and when you gather audit evidence, you can document. The other option is first complete all the audit procedures, gather all the evidences. Later, once the entire audit comes to an end, then start gathering the documentation. Which one is better? First one is better. So you should not delay the documentation to a later point of time. To the extent possible, as early as possible, along with your audit procedures, along with your steps, immediately gather the documentation. Don't delay it to a later point of time. So why? What will happen? Because no, not relevance, it's actually some things we will miss out. Simply, if I have to put it, if you concentrate on performing audit procedures, if you gather audit evidences, later you think of audit documentation, you will forget things, what you have done, what you have gathered. So that's why they say one statement here. This statement very important for, once again, MCQs. This also they will twist you. How they will test this question is in the form of that choose the correct statement. They will say 4 options they will say, and they will do miss and match here. So if you read this statement, this is very important. Documentation prepared after the audit work has been performed is likely to be less accurate than the documentation prepared at the time when such work is performed. So whatever documentation you are gathering as and when you perform the work, that will be more accurate than the documentation which you have gathered after completion of your entire audit work. So you need to maintain the documentation in a timely manner. Now, what are the factors which affect form, content and extent of documentation? See, documentation will be there. In some cases, documentation will be very small file. If I talk it in the physical terms, if the documentation is in physical form, in some cases, audit documentation will be small file containing somewhere around 100 to 100 pages. In some cases, audit documentation files will be very, very bigger. It will be running for 700 pages, 800 pages and all. So how you will decide how much content should be there in the documentation, what extent of documentation you have to maintain, how can you decide it? Once again, that depends on professional judgment. So as an auditor, see, professional judgment is actually a weapon of auditor. At various instances, they say professional judgment, and this professional judgment itself is a beauty of the entire subject of the audit. That's what make this audit subject also very, very complicated. So why? Because in rest of all the subjects, you learn rules. There is no professional judgment there. You can't say when accounting standard you have read and you are required to solve some question regarding the accounting standard, there you can't say I will use my professional judgment and do whatever I want. You have to strictly follow accounting standards. But standards on auditing are not like that. Auditing is not like that. In audit, what they say is they will give you alternatives. Like for example, 7 methods they have told. Different forms of evidence they have told. Sufficiency meaning they have defined. Appropriateness meaning they have defined. But nowhere they have mentioned which method you have to use out of that 7, what quantity of evidence will be sufficient, what quality will be appropriate, and even if you just see now format of audit documentation, they did not say exact rule. What they have told, your choice, professional judgment. The subject of audit itself is like that only. They will give you multiple options. Finally, they will place the responsibility on your head. You use your professional judgment and do whatever you want. See, that's what distinguishes the subject also. Even just imagine if the standards on audit also says this is what exactly you have to do in the audit. In the standards they have told. Then you tell me, will audit have any effectiveness? No. Why? Because anybody can read the document. Anybody will come to know what auditor exactly will do. So this will enable the management to hide their mistakes easily. If the standard has told every time you do inspection only, then what will happen? The management will maintain perfect documentation. So you should maintain that surprise. That professional judgment adds the surprise element to that audit. So that is what the entire beauty of the subject of audit. At CA final, this professional judgment is going to kill you actually. So you go and ask the CA final students what will be the difficult subject, what subject is stopping you from getting that CA final degree and all. Most of the people will say auditing. We don't know how to do CA inter also, right? CA inter to some extent okay, but CA final no. CA final almost entire question paper is professional judgment only. Entire question paper is professional judgment. So they will give you scenario, they will give you question, they will give you facts and all. What you are supposed to do in that case? If you are an auditor, advise him. Here, at least what we have an edge at the CA inter level is, we at least know the question will be tested from so and so standard. By reading the question, we at least get a sense. Okay, this question is related to so and so concept, so and so standard. In CFNL, what will happen is once you read the question, no, it will look like it will be from SA. It is looking like SA 200 also, SA 500 is also there, SA 300 is also there, SA 600 related matters is also there. Now, which standard related question, which standard related paragraph I have to write? So, comprehensive questions. Touching multiple standards, they will ask comprehensive questions. So, that is where your professional judgment even matters more. Okay, because see here also professional judgment, no, 4 standards are coming to your mind. Now you have to use your professional judgment and write which is standard I have to pick and write the answer. So that's actually the entire beauty of the subject of audit. Entire things are depending on professional judgment. So here also what they have told is what content should be there in the documentation, what extent of things should be there in the audit documentation. It is going to depend on some factors. So basically professional judgment, but you will decide that professional judgment considering some factors. What factors? Very simple. Size and complexity of entity. If your client's size is very, very bigger, your audit documentation also will be bigger. Simply you perform more audit procedures, you have bigger samples and all. So that's why what will happen is your documentation, once evidence is increasing, documentation also will increase. Why? Because the major component of audit documentation is nothing but audit evidence only. So if your audit evidence is increasing because of some reason, audit documentation is also increasing. So it depends on size and complexity of the entity. It also depends on what kind of audit procedures you are performing. It depends on risk of material misstatement. If the risk is very high, more documentation. If the risk is low, less documentation. It depends on significance of the evidence. If the evidence is very important, much of the evidence is important, more documentation. Less evidence is significant, less documentation. It also depends on nature and extent of exceptions. Exceptions you can consider it as misstatements for the time being now. So SA 505 we will see later. There we will discuss more about exceptions. And the need to document a conclusion or the basis for a conclusion not readily determinable from the documentation of work performed. So this is one useless point. What I try to say here is sometimes you will decide whether a document is, whether a information is required to be documented or not. That you have to decide it on the basis of whatever work you have performed. Once again, professional judgment only, no, indirectly. Next, the audit methodology. It also depends on what will be the extent of documentation. That depends on what audit methodology you are using. Like if you do inspection, more documentation you will have. If you do inquiry, less documentation you will have. So it depends on the methodology you are using. So these are all the factors which affect the form, content and extent of audit documentation. Right. The class is not getting the vibe, no? Why the vibe is not there? No, I do feel it. Fine. So now, come on, participate now. Listen. Now coming to the next aspect. So we need to understand one more thing. There are two things actually. One is audit documentation and the other one is audit file. So what is this audit documentation? What is the audit file? Let us try to understand it. See, if you ask me, I will say both are same. Audit documentation and audit file, both are same. So even in practical terms also, when you go to the industry and say what is audit file, what is audit documentation, many people will say both are same. But since in the material they have used two phrases, I have to create a difference here. What I should do? I should create a difference. So what is the difference is, if I have to put it in simple terms, see, a team will do the audit. A team will do the audit now. See, everybody, for example, for this person I have allocated some purchases, for this person I have allocated sales, for this person I have allocated assets. Everybody will gather documentation regarding to their relevant area. So that we call it as documentation. So you are having some documents, this person is having some documents, that person is having documents, that is all documentation. But by the completion of the audit, you all should sit together, gather all the documentation, arrange in one proper order. Yes or no? See, if you randomly, like the way you maintain your running notes, like the way you maintain your class notes, if you maintain the documentation like that, you know what will happen. So somewhere at some random page you will open and write. Later you will search where you have written all that information and all. So the same thing will happen even in the audit also if you don't properly structure that documentation. So what you should do is everybody will gather their respective files, respective documentation. But once the opinion has been given, once the opinion has been expressed, all the engagement team members will sit together. They will accumulate all the evidences. They will accumulate all the documentation. They arrange it in a proper order. So that arranged documentation, that sorted documentation, we call it as audit file. Both are same, but audit documentation is unsorted, unarranged information, whereas audit file is a sorted, properly arranged audit documentation. And from this audit documentation, you are creating an audit file now. After the completion of the audit, I told you will all sit together, you will arrange the files, and you will discuss and create one final file. That process we call it as assembly of final audit file. What do we call it? Assembly of final audit file. And basically from this audit documentation, you have to sort and create one file ready, which can be helpful for your future references. So now, should there be time limit for doing it, or auditors can take their own sweet time? If there is no time limit given, what will happen? Next year's audit also will get completed, previous year's audit file will not be assembled. So that's why even the standards have also given the time limit. They did not just say assemble the audit file, they have even given a time limit within which you are supposed to assemble the audit file. What is the time limit? Within 60 days from the date of auditor's report, you are required to assemble the audit file. Where they have told it? SQC1, even though SA 230 talks about audit documentation, but SA 230 did not mention the time limit. The time limit was given in SQC1. SQC1 says within 60 days from the date of the auditor's report, you have to assemble the audit documentation. See, when I am assembling that audit documentation, will I perform any new audit procedures? Will I form any new conclusions? Will I gather any new evidences? No. So while I am assembling the audit file, as a part of that assembly of the audit file, we will not perform any new audit procedures. We will not make any new conclusions. We will also not gather any extra evidences. So what we simply do is we make some changes. What kind of changes we do? Administrative changes we do. Like examples of administrative changes: deleting the superseded documents. Basically whatever duplicate documents are there, that we will delete. We will make them sign. Whoever has done the respective work, we will make them sign the documents. Basically initial we will ask them to put there. And also we will give references to the working papers. Like sometimes the sales might need references to debtors might need references to sales. So like that references will be required. That references we will keep. Page numbers if we will want, if we need it. So these kind of administrative changes only we will do during the process of assembly of the final audit file. We will not perform any new audit procedures. We will not form any new conclusion. We will also not gather any new evidences. And once you have made that audit file ready, what you will do? Throw it away. If you have to throw it away, why we are putting all that effort? No, right? So we have to retain it. How long you have to retain it? 7 years. 7 years from which date? From the date of auditor's report of your client, or if your client is forming part of a bigger group, that group related audit report date, whichever is later. From that date you have to maintain for 7 years. You have to maintain. But today, since we are all living in the digital world, 7 years is not a bare minimum. Just you can keep it on the drive, keep it on the hard disk, and leave it. That will remain with you for lifelong, right? So like this, you have to maintain the audit documentation and you have to retain it properly. Understood? Clear and comfortable, everybody? Next, one more concept from SA 230: audit documentation summary or completion memorandum. We have one small concept called audit documentation summary or completion memorandum. So what do you mean by this is, say for example, listed companies. If you take listed companies like Reliance or Infosys, which are having thousands and lakhs and crores of turnovers, if you look at their documentation, the documentation will run for 100 pages, 1200 pages, it will go. So I have seen one of the big four entities audit documentation. See, as I've told, big four entities are all experts in maintaining documentation. They're not experts in doing audit. They're all experts in maintaining what? Documentation. For one client, they have somewhere around 2300 pages of audit documentation they have. So now, see, basically what they do is everything they will try to document. Each and every small thing also, they have a system. Basically, they have designed their audit softwares revolving around audit documentation only. They will do the audit everything in a systematic way. They do software will tell them, so have you done this, a checklist will be there, and that software itself will maintain the documentation also. They have designed the softwares in such a way. So now if you take this kind of big entities, listed companies and all, that 2300 2400 pages of audit documentation, yes, it is that much information is there. Why they have stored that much amount of information is so that if any allegations comes against them in the future, they can take the help of that audit documentation and prove their point. But out of this entire 2300 2400 pages of audit documentation, not every paper is relevant for the subsequent years. Like I told, main purpose is it will act as evidence in the court of law. But other purpose is what? If you maintain the documentation of the current year, it will help you for better planning and performance of the audits of next years. But you tell me, all this 2300 2400 pages of information, will every information be useful for subsequent years? A few pages, like for example, out of this entire information, some 300, 400 pages are useful. So now what they will do is every time searching for that 300, 400 pages from that to 2300 pages will become extremely difficult. So in the case of big entities, what these auditors will do is they will have this bulk documentation. From that bulk documentation, they will take significant matters, and for that significant matters, they will prepare a summary. So that we call it as what? Audit completion memorandum, or audit documentation summary, or completion memorandum we call it. This generally we maintain only for large audits. In small audits where the documentation itself is 300, 400 pages, there also you can't say we'll create 30 pages of summary. Not required. So where the documentation is very bulky, in the case of large audits, there the auditors will generally prepare one summary out of that entire documentation. They pick the significant matters and create a summary out of it. So that we call it as audit documentation summary or audit completion memorandum. So anything significant else? Anything else? Yeah, ownership. Yeah. So who is the owner of audit documentation? Sure, 100%. Client is asking, please share the copies of the audit documentation. Will you share it? Client, yeah, his information only, no? Huh? If so no any such complication. It is completely up to the discretion of the auditor. Phrases are very important. This terminology very is important. You can say up to the choice of the auditor, up to the decision of the auditor. You can say everything. Everything conveys the same meaning. But you will get the marks only when you use the phrase discretion, at the choice of the auditor. So if the auditor feels like giving, he will give it, even though the client is asking. Yes, in the audit documentation, client information is only there. So whatever information client has provided, or from the client's books of accounts only information is there, but still there is no obligation on the auditor to share the copies of audit documentation with the client. It is up to whose choice? Auditor's choice. Let him decide. What if the law or regulation is asking? What if the law or regulation is asking? Then also his choice. Then no choice. You have to compulsorily provide that documentation. Can the principal auditor have the right to ask documentation of branch auditor? Branch auditor, we know the concept, right? Branch auditor will do the audit of a branch, and that branch auditor will submit a report to principal auditor. Now what the principal auditor will do? Using his own work and also using the work of branch auditor, he will prepare a report on entire company. So now principal auditor, since he is giving a report on entire company, can he request the working papers from the branch auditor? He can request. If he requests, is the branch auditor under an obligation to share the copies of the audit documentation? No, it is also at his discretion. It is up to his choice. If he wants, he can share the documentation. If he doesn't want, he will say, get lost, I will not share. Okay. But in case if he is not sharing documentation, we have principal auditor will have one right. SA 600, if you remember previously in the audit reporting chapter, I told one thing is, if you have doubt, so as a principal auditor, what you can do is you can go and request audit working papers. If he gives okay, if he doesn't give, what you can do is you can inquire him. You can ask him what audit procedures he has performed, or even you can ask him a written summary of audit procedures performed. Able to understand? Fourth and fifth point, SA 600, like we have seen. If you are not getting satisfied with a inquiry, if you are not getting satisfied with a written summary, even you can go and plan a visit to the branch auditor also. Understood? So even principal auditor can't demand the working papers from the branch auditor. Clear? So this is what all the significant content from SA 230. So now we will end this chapter, audit documentation and evidence. The next chapter we will pick up for our revision. So which chapter we are going to pick up? Risk assessment and internal control. Very lovely chapter, no? No, I don't know about you. I hate this chapter. So why do I hate this chapter is not from the conceptual perspective. Conceptually, it is very, very good. Excellent. Why? Because risk assessment and all, as I have told, the first and foremost audit procedure which you have to do in the audit. Do you remember audit procedures? Different types of audit procedures. What are they? Risk assessment procedures, compliance procedures, further audit procedures. Very good. So first and foremost procedure which we do in the audit is what? Risk assessment procedures. So now as a part of that risk assessment procedures, what we do generally, we try to understand the entity, environment and its internal control to identify and assess the risk of material mistreatment. I told that if you don't understand the entity, if you don't understand the environment, without understanding the internal controls, if you directly rush to the accounts department and start verifying the books of accounts and all, your audit is truly worthless. It is waste of time. So such an important procedure is a risk assessment procedure. Such a strong procedure is a risk assessment procedure. But why I said I hate this chapter particularly is from the textual perspective. Whatever text they use it in the standard, it's very, very complicated text. The terminology, the phrases which they use and all is very complicated. It's going to take the shit of our brains. So difficult it is. But keeping in mind, so anyhow, since it is difficult, we can't leave it out. Why? Because this chapter is having linkages with the subsequent chapters. At various places, they say risk of material misstatement and all. So if we don't know what is the risk of material misstatement, the discussion going forward will not be smooth at all. So that's why we need to understand at least some basic things. Whatever we are going to link in the subsequent chapters, that things we must know. So the same thing I will do here in the revision also. Even though the chapter is very voluminous, very bulky, we are not going to touch upon each and everything here. We will try to concentrate on those things which are very repeatedly tested in the examination, and also those concepts which we are going to use them in the subsequent chapters. So chapter is very huge, but coverage we are going to do in the revision is very, very limited. Okay, clear? Right. So this chapter also contains two components. One is risk assessment and the other one is internal control. Both are not new to us. We are aware of both. We have already understood what is risk assessment as a part of audit procedures. I told you what is internal control as a part of nature, objective and scope of audit. So no, what we are going to do is we are going to learn this from a technical perspective. In common parlance, we have understood what is the meaning of the terms, but now we need to dig deeper into the concepts. So first we will start about risk assessment, assessing the risk in an audit. If you guys remember, by doing the audit, will you face any risk? If you have been appointed as an auditor of an entity, are you going to face any risk? Yes. What risk? That risk we call it as what? Audit risk. What did I tell you? What meaning of audit risk? The risk of expression of a wrong opinion. The risk of expressing wrong opinion. That risk we are going to call it as audit risk. That is in simple terms, but when we look at the actual definition, that is what somewhat extended. So they define the term audit risk in such a manner that audit risk means the risk of so let me go to that statement itself for better understanding without dilution of the key terminology, right? So if you see here, audit risk means the risk that the auditor gives an inappropriate opinion when the financial statements are materially misstated. Simply, there is a risk that auditor might give a wrong opinion, inappropriate opinion, when the financial statements are materially misstated. Now, say for example, financial statements are materially misstated. Financial statements are containing a material misstatement. In that case, what is the appropriate opinion? Appropriate opinion will be modified opinion. But I am saying I am giving an inappropriate opinion. That means what I am doing? Unmodified opinion I am giving. So in that case, this scenario we call it as what? Audit risk. Risk of expressing an inappropriate opinion when the financial statements are materially misstated. Now let me say another scenario. Financial statements are not materially misstated. Financial statements do not contain a misstatement. What is the appropriate opinion there? Unmodified opinion. But the auditor is giving inappropriate opinion. That means what he is doing? Modified opinion he is giving. See, why auditor will give modified, sir, when unmodified opinion is appropriate? One example, if I have to give you, like I told you yesterday, one newly qualified chartered accountant wanted to display all his skills in the first audit only. So might be he's doing audit of some entity, the financial statements. He found some small misstatement that is not at all material only. He could have given a unmodified opinion, but he wanted to advertise all his skills and all. So what he's doing is modified opinion he's giving. So financial statements are not containing material misstatement. Appropriate opinion is unmodified opinion, but auditor is giving inappropriate opinion. That means he is giving a modified opinion. This also will come under. This will not come under audit risk. Why? Because definition literally says the financial statements containing the risk of expressing an inappropriate opinion when the financial statements are materially misstated. So when modified opinion is appropriate, but you are giving a unmodified opinion, that is the audit risk. Sir, here also risk is there, no? When unmodified opinion is appropriate, you are giving a modified opinion. Risk is there. But it is not audit risk. Risk is there. What risk is there? business risk will be there. See, if you give unmodified, when you are supposed to give unmodified, if you give modified, the client will become unhappy. No, you have found small misstatement. You could have given an unmodified opinion, but still that also you are saying that also you are seeing it as bigger and giving a modified opinion. Client will become what? Unhappy. If the client becomes unhappy, what will happen? He will not appoint us. Hey, fees he will give here. Fees he can't do anything. Next time he will not appoint us. So that is losing a business. Losing a business is business risk. When I say audit risk, I am talking about the risk which auditor will face from the legal perspective, legal consequences, what he is going to face. In the first case, he will face the legal consequences. Why? Because when you should have told financial statements are not giving true and fair view, you are telling financial statements are giving true and fair view. If some shareholder has, based on your opinion, if he invested his money in the company, later that misstatement was found out, the share price of the company will fall. Now the shareholder will go and raise a complaint on an auditor. This auditor has given a wrong opinion because of which my decision has gone wrong. Then as an auditor, you have to face the consequences. Legal consequences will be there on you. In the second case, there will not be legal consequences. If the auditor has given a modified opinion, he will say, I'm cautious. I don't want shareholder to get affected. See, even small misstatement also have considered material. I'm a very cautious person. So from the legal perspective, there will not be any risk. But from business perspective, there will be a risk. Audit risk does not include business risk. Audit risk is different. Business risk is different. Next. And this audit risk happens because of two components. Audit risk contains two components. So what are the two components of the audit risk? One is risk of material misstatement and the other one is detection risk. So what is the risk of material misstatement? Simply the name itself says the risk of happening of material misstatement in the financial statements. We know what is a material misstatement. When I say risk of material misstatement, the risk of the chance of happening of material misstatement. Nothing but, say for example, in the cash department, a cashier is there. That cashier is maintaining the cash balance. But that cashier is not updating the cash records properly. So generally what cashier should do is, as and when the payment is made, immediately he has to record the payment. But when I'm going to the accounts department and when I watch at that cashier, what he's doing is he's first making all the payments. By the end of the day, he's making the entry. Is there a chance of happening misstatement there? Yes. There might be a possibility that some payments might have got missed out, or he might have recorded excess payments. So there is a chance. I'm not saying there is a material misstatement. I'm saying what? Chance. Might be the cashier is very smart, his memory power is very good, he will remember each and every transaction and he will write 100% correct entries only. That chance is also there. That option is also there. But here still there is a probability of missing out some entries. So I found here not material misstatement. I found here risk of material misstatement. Risk of material misstatement is different. Material misstatement is different. Just I'm identifying the chance here. Clear? So I was walking inside the company. I went to the warehouse where the stock is kept. I found that there is no CCTV camera. There is no security guard. Did I find out a material misstatement? No. So even though there is no CCTV camera, even though there is no security guard, employees could be honest. There are no such employees in the company which are who wants to steal the stock and all. Then fraud and theft will not happen. But what I found out there, possibility. There is a chance. I did not find out any material misstatement. So risk of material misstatement is different. Material misstatement is different. So that is what the risk of material misstatement is, the chance of happening of material misstatement in the financial statements. Who is responsible for that risk? Is auditor. Has this risk been created because of auditor or has this risk been created because of management? This is something which has been created because of management risk, management not implementing internal controls or management not effectively overcoming the problems of the internal controls, because of which risk of material misstatement will happen. So auditor is not having any responsibility for the creation of the risk. It is purely the management risk. And in fact, risk of material misstatement will be there whether audit happens or not. Even though audit did not happen, say for example, if in the warehouse internal controls are not there, just because audit is happening, theft will happen? Even there is no audit happening, still there is a possibility of theft of the stock. So this risk of material misstatement is purely a management risk. It has nothing to do with the auditor. Then what auditor will do regarding risk of material misstatement? If the risk of material misstatement has been created by the management, then what is auditor's role regarding risk of material misstatement? His responsibility is to only identify and assess. Identifying means finding out and assessing means analyzing. So his responsibility is only identifying and assessing risk of material misstatement. Just study the entity, environment and its internal control to find out, to identify and also to analyze where there is a risk of happening of material misstatement in the financial statements. And that procedures only we call it as what? Risk assessment procedures. So when it comes to risk of material misstatement, auditor's responsibility is only to identify and assess. Clear? Next, this risk of material misstatement will be created because of two components. This will be created further because of two components. One is inherent risk, and the other one is control risk. So what is inherent risk? They say, if I have to put it in technical terms, they say that the chance of happening of a misstatement before considering any internal control, they will say the susceptibility of a transaction to a misstatement even before considering internal controls. So basically what do they mean here is, here there are no internal controls to consider. Here there are no internal controls to consider. So that kind of areas, or in most of the areas, sometimes we might not be able to implement internal controls only. So petty thefts and all, if you take in some organizations which are dealing in the small products, no matter how many internal controls you keep on doing it, but still theft will happen. Petty theft will happen. Or in some areas, it is not at all suitable to implement the internal controls only. So that kind of risk where there is an absence of internal control, where internal controls can't be implemented. So that risk we call it as what? Inherent risk. But not many areas are like that. In major areas, we can implement some sort of internal controls. So in some area, you have implemented internal control, but sometimes what will happen is that internal control will suffer from some weakness, will suffer from some deficiencies, which can give an opportunity for a person to overcome that internal control and commit a fraud or error. That risk we call it as what? Control risk. Basically, failure of the internal control. If the control itself is not there, that we call it as what? Inherent risk. If control is there, but if that control has failed to prevent a mistake from happening, that we call it as what? Control risk. Absence of internal controls also you can say it, and even control deficiency also you can say that. Understood everyone? Next. So risk of material misstatement contains two components, inherent and control risk. Now let us come to the detection risk. Sir, what is detection risk? They say that detection risk means the risk that audit procedures performed by the auditor may not be able to detect a material misstatement in the financial statements. What do you mean by detection risk? The audit procedures performed by the auditor may not be able to detect a material misstatement which is already there in the financial statements. So in the financial statements, some material misstatement has already happened, but auditor generally will perform audit procedures to find out that misstatements only. But you performed audit procedures, but those procedures were not able to identify a misstatement in the financial statements. That might be because of your negligence, that might be because of inherent limitations, whatever it is. But whatever audit procedures you have performed, those audit procedures are having a chance of not detecting a material misstatement in the financial statements. That risk we call it as what? Detection risk. Tell me, who is responsible for the detection risk? Auditor is exclusively responsible for the detection risk. So between the risk of material misstatement and detection risk, which one auditor can control? Which risk auditor can influence? Only detection risk. As I have told, when it comes to risk of material misstatement, the auditor can only identify if something which auditor can control or if something which auditor can influence, that is completely detection risk only. So now basically if you look at the entire process of the audit, so how audit will flow is, auditor will perform audit procedures. So by performing risk assessment procedures, he will identify risk of material misstatement. On the basis of that identification of risk of material misstatement, he will perform further audit procedures to manage his detection risk. To manage his detection risk, so that overall audit risk will be kept at a low level. As we all are aware, audit risk can never be eliminated. Audit risk cannot be reduced to zero. What auditor can do? He has to keep the audit risk. He has to reduce the audit risk to an acceptably low level. That is the objective. The objective of the auditor is to reduce the audit risk to an acceptably low level. For that, what he will do is he perform audit procedures. But how he will perform audit procedures is, first he will perform risk assessment. By that he will identify risk of material misstatement. Now using that risk of material misstatement, he will plan his substantive audit procedures. By proper planning of substantive audit procedures, he will be able to control his detection risk, so that overall audit risk will be kept at a lower level, and hence the objective of the audit has been met. Understood? Clear and comfortable, everyone? Then one more thing, between risk of material misstatement and detection risk, what is the interrelationship? What is the relationship between risk of material misstatement and detection risk? Don't say distance relationship. So what relationship it is? Inverse relationship. What do you mean by inverse relationship? Right. So they move in opposite directions basically. So risk of material misstatement, if the risk is very, very high, if the risk of material misstatement, the auditor identifies the risk of material misstatement as very high, then what he should do? He will perform more audit procedures. He will identify more misstatements. If he is detecting more misstatements, what is happening to detection risk? Is it coming down or is it increasing? It is coming down. So when the risk of material misstatement is high, the auditor should keep the detection risk at a low level. On the other hand, if the risk of material misstatement is low, then he can keep the detection risk at a very high. No, not exactly. He can take some leverage. He can take little bit extra detection risk. Okay, but the second logic doesn't fit properly. First logic only will justify. Second logic, if we say no, if you keep the risk of material misstatement, if the risk of material misstatement is low, become lazy, don't do audit procedures, right? So that kind of meaning it conveys. So better way of presentation is just stick to the first point only. When the risk is very high, perform more audit procedures and try to keep the detection risk at a low level. Inverse relationship. Understood? Next. Then one more thing. See, this assessment of audit risk and all we are doing. This assessment of risk of material misstatement, assessment of audit risk, all this we are doing. See, that also we are required to do purely on the basis of professional judgment. Even risk assessment is also professional judgment. Risk assessment is not an exact measure. If I found out that there is a 10% chance of happening of misstatement in the sales, does that mean is it a precise measurement? When I say I found out a risk of material misstatement of 10% in the revenue, does that mean exactly 10% misstatements will happen in the revenue? No. So whatever assessment of risk you have done, that is only professional judgment. It is not a precise measurement. That is not a precise calculation. Next. Now, now we will see, sir, you are telling risk assessment procedures. No. How I can perform risk assessment procedures? What methods I can use for performing risk assessment procedures? Very important question. So any audit procedure you take, we have how many methods? 7 methods we have. List them out. Inquiry, inspection, external confirmation, observation, recalculation, reperformance, and analytical procedures. So these 7 methods are only available. In the risk assessment procedures, what we do? We need to understand the entity, environment, and its internal control. So for the purpose of understanding entity, environment, and its internal control, and to identify the risk of material misstatement, out of the 7 methods which we can use, let us try to list them out first. Inquiry, inspection, observation, external confirmation, recalculation, reperformance, analytical procedures. So out of this 7, which one will be suitable for understanding the entity and its environment? Whether can we do 7 or can we do any few, let us try to understand. Can you do inquiry? Now, with whom and all you can do inquiry? There are, okay, definitely you will go and inquire with the management. But are the management only people with whom you are going to do the inquiry? Inquiries mainly we do with management, but we need not restrict our inquiries only with management. We can inquire with the different people in the organization. Like we can inquire with those charged with governance, we can inquire with the internal audit team, we can inquire with the employees, we can inquire with IT personnel, we can inquire with sales and marketing staff, we can inquire with what else? So we have a list there. Production department we can inquire. So like that, this question has been asked multiple times in the past examination. So how they will frame this question is, auditor will do inquiries with the management to understand about the entity and its environment as a part of risk assessment procedures. List who are that others with whom management can inquire apart from the management. Apart from the management, with whom others, with others, who are those other people apart from management with whom the auditor can do inquiries. So like this, employees, those charged with garnets, that list will be there. That list you are supposed to write. That list we have it here. Right. So if you see this one. So inquiries of the management and others within the entity. So generally you do with the management, but apart from that, you can inquire with internal audit personnel, employees. You can inquire in-house legal counsel. You can inquire with the marketing or sales staff. You can inquire with risk management function, and also you can discuss with the. You can inquire with information system personnel. Okay, we can do inquiry. One thing got clarified. Can we do inspection? Can what happens in the inspection basically? Examination of the documents or physical examination of the assets, that we call it as inspection. Can I do inspection for the purpose of performing risk assessment procedures? See, I told you plant visit. In the plant visit, what we are doing? No, plant visit is an observation, sorry. So how you can do inspection to know about the entity is you can go through the incorporation documents like MOA documents, AOA documents. You can read the legal contracts and all. So by doing that inspection also you get a lot of information regarding entity and its environment. So we can do inspection as well. Observation, I've already told this. Plant visit. When you are doing plant visit, basically you are doing observation. Can you do external confirmation? No. See, you have to understand regarding the client's entity internal environment. For that, you can't rely on the external people. So that's why external confirmation is not suitable for performing risk assessment procedures. Can I do recalculation? For that, you should be an astrologer. So no. So doing some calculation and all, telling business is that, business is this, we can't do. Recalculation, we can't do. Reperformance, can you do? You can do, but it is not practically feasible. So if you reperformance means what? Performing an activity once again. So reperformance for understanding the entity means what? Start a establishment, do the operations, and then understand the entity. That much time we don't have, no. So that's why reperformance is also practically not feasible. Can we do analytical procedures? Yes, we can do analytical procedures. Even and in the analytical procedures, what we do generally in the analytical procedures? So by studying some relationship between financial and non-financial items, we can also identify risk of material misstatement. Like by studying gross profit percentages and all. Like for example, when compared with the last year, in the current year, there was a huge drastic fall in the gross profit. So there could be various reasons. For gross profit falling, there could be multiple reasons, genuine reasons also, and might be a fraudulent reason also. There might be a chance that management might have over reported the expenses to reduce their taxes. Risk. I'm not telling that it will happen, but there is a risk. So that risk of material misstatement we can even identify by performing analytical procedures. So out of 7 methods we have, these are the 4 methods which are suitable for performing risk assessment procedures. What are they? Inquiry, inspection, observation, analytical procedures. Never they will ask the entire question, but many times they have asked a part of the question. 2-3 times they have asked that inquiry related question, and in one case they have asked analytical procedures, how analytical procedures can be performed as a risk assessment procedures, that also they have asked. So part of the question can be tested. So since they have asked many times inquiry and inquiry and analytical procedures, for this attempt they might ask inspection and observation. Who knows? So this question is very important. Please do refer it before you go for the examination. Next, coming to the next part. Then see, I'm telling you will try to understand about the entity, you will try to understand about the environment. I'm saying. So what exactly you will try to understand regarding the entity and its environment? We are saying as a part of risk assessment procedures, what we are supposed to do? We are supposed to understand the entity and its environment. Every time I was saying that, you are also repeating along with me. As a part of risk assessment procedures, we will try to understand the entity and its environment. But what exactly is included in the entity and its environment? Assume that you are my article assistant. We have got one audit. I told you some manufacturing entity is there or some client is there. I did not tell you the nature of business also. Some client X Limited is there. I am calling you, I am asking you, go to that client X Limited, get an understanding of the entity and its environment. So just step into the shoes of that article assistant and tell me what things you will try to understand. First, business you will try to understand. So what is your client's nature? Are they manufacturing? Are they service oriented? Are what products they are doing and all? So that you will try to understand. Internal matters you will definitely try to understand. Apart from that, external matters like what laws and regulations are applicable for them, what is their applicable financial reporting framework, to which industry they belong, what kind of customers they have, what kind of suppliers they have, that you will try to understand. Apart from that, ownership structure, yeah, that also you will that is also internal matter. Ownership structure and all is an internal matter. Then what is their applicable financial reporting framework, so that you, what is their accounting policies, that you will try to understand. Which method of depreciation will be suitable for them. SLM will be suitable when you are expected to use uniformly. WDV will be appropriate when year after year the usage is getting reduced. And will you track the past performance of the company or not? Till now, what the company has been doing, like you will go through the annual reports and all. What is the stage of revenue? Is it increasing, falling? Is the profits are increasing or falling? A brief understanding of their past history also you will get it or not. Along with that, you will also understand the geographical spread, at how many locations they are currently. Are they operating from only one location? Are they in multiple states? Do they have any international units? Along with that, you will also try to understand who are the top level management, who are the board of directors, who are those charged with governance, who are the promoters. Along with that, you will also try to understand any related parties are there. Do they have any subsidiaries? Do they have any associates? Do they have any joint ventures? So these are all the things which you will generally try to understand. That's what this question is about. So as you could see, various things I will try to understand regarding entity and its environment. First one, relevant industry, regulatory and other external factors. The name itself says first, they are trying to say external factors. External factors in the sense what all will get included here: market and competition, whether the entity is engaged in seasonal activities, what kind of technology they will use, into which industry they belong, what are the relevant regulatory factors, which laws and regulations will become applicable for them. A few examples are also given here. Next, once you have understood the external matters, then we will try to understand the nature of the entity. Now they are talking about internal matters, like what are their operations, what is their ownership and governance structure, where they are investing their money, and the way entity is structured, how it is getting financed. Is it a debt financed company or equity financed company? Then whether entity has a complex structure, are they doing simple business or they're doing complicated business? Company is simply one retail unit, it is running supermarkets, simple business. Company is a IT company, complicated business, complex structure will be there. Next one. And also understanding the matters related to ownership, once again repeated, who is the owner, who are the owners of this company, are they subsidiary of any other company, that we will try to understand. And some examples of the matters they have given here. Guys, please do refer to these examples. In the recent times, from these kind of areas they are asking example. So how they will frame the question here is, they will say, as an auditor, when understanding the entity, you need to obtain understanding about the nature of the including nature of the entity. State a few examples of the matters which you will understand as a part of the nature of the entity. So you aren't supposed to write everything, but just you are supposed to write only examples. Okay, so very important. Examples many people will ignore. Yes or no? That is generally habit, right? We all have that habit. Examples, why they will give? To understand it better. So concept will be there. To relate to that, they will give concepts. So examples are just for reference. But very unfortunate, they are asking questions from examples only. So which have been given for reference, they are asking it as a main question, ignoring the concept, and they're asking you to write the examples. So very unfortunate for that. So I don't personally agree with that kind of questioning. If you want to test a student, if you want to test the potential of the student, test him the concept. Why examples you will test him? How can you expect a CA student to remember the examples and all? Yes, no? Yeah, I understand your brain. Fine. So third one. So after first point, they're asking about external matters. Second point, they're talking about internal matters. And the third point, in addition to that, what you need to understand is application of accounting policies, including reasons for changes. What accounting policies they are following. And we have one of the fundamental accounting assumption, consistency. If at all if there is any change in accounting policy, because of what reasons that changes are made. Next. Apart from that, you need to understand what is the entity's objective, what kind of strategies they follow, and what kind of business risk they follow. In this, very important is business risk. What are the different kinds of business risk, they will say. Yeah, this one. This here also examples. So you need to understand what kind of objectives the company is having, what kind of strategies they follow. See, for different companies, objectives could be same, but the strategies to achieve that objectives could be different. Every company will have an objective of growth. Growth is objective for every company, but there are different strategies to achieve the growth. Some companies will start from the scratch and grow by themselves. Some companies acquire other companies and grow. So objective is same, but the strategy to achieve is different. And different entities will have different risk. Business risk will be there. You need to particularly pay attention what business risk your client will face. If your client is a technology product, electronic related products, mobile phone industry, new developments in the industry is a bigger risk. If you don't remain relevant with the new changes happening in the industry, you will be sooner or later thrown out of the market. Next, some entities will have a risk of laws and regulations. Like for example, those companies who are dealing in the tobacco related products. If tomorrow government takes this very strictly and imposes a complete ban on tobacco products, what will happen? ITC's share price will be hit very badly. Why? Because even after so much of diversification, still ITC derives a significant chunk of revenue from tobacco. So some companies will have this risk of impact of laws and regulations. Some companies will have a risk of inappropriate estimation of demand. Somewhere they will say here, this one. Demand has not been accurately estimated. Some companies will have this problem. Lack of inappropriate estimation of demand. This risk will be mainly faced by restaurant industry. Restaurant industry, if I have to give in layman terms, if a restaurant was not able to estimate the crowd, how many people will come and have dinner or lunch at their place, they might cook extra. If that many customers don't turn up, all that extra food will go. In many cases it will not go, it will go to refrigerator and it will be served the next day. But the thing is, the things will get worsen. So some companies will face this risk. So different businesses will have different risk. You need to understand what business risk your client is facing. Next, you need to measure and review the entity's financial performance. So basically, as I've told, past track record, at least you have to give a glance, like what are the key performance indicators, period to period financial statements, budget, forecast, variance analysis. So all these things you have to cover. Next, why understanding the entity is significant? Should you spend the time on understanding of the entity and its environment? That's what we are saying from the beginning. It's very important. That's if you do that, then only you will come to know risk of material misstatement. Then only you can betterly plan your audit procedures. Then only your audit will be effective. And one more important question, which will be many times tested in the examination: understanding an entity is a continuous process. It is not a one-time activity. It is a continuous process. It will go on throughout the audit. Does that mean throughout the audit I will be doing only understanding of the entity? Throughout the audit, if you do only understanding of the entity, then who will do compliance procedures and substantive audit procedures? You told no, understanding entity is a continuous process. That means continuously I have to do. Huh? So the thing here is, what do they mean by this is, you will understand the entity and its environment at the beginning. That is correct. But it is not like, you should not be so stubborn that I understood something about the entity at the beginning. I will stick to that only. Even if extra information also comes to my knowledge, I will not change my understanding. Whatever understanding I had at the beginning, that I will stick. According to that only I will perform audit procedures. Can you be so stubborn? So what you should do, at the beginning you will try to understand the audit, understand the entity. During the course of audit, if any extra information comes to you, if any changed information comes to you, if any update regarding the client's business comes to you, you should be able to adopt it, you should be able to accommodate it, and you should be able to make the changes to your audit procedures accordingly. So that adaptive nature they are talking about. Understood? So that is what the meaning of the term understanding an entity is a continuous process. And so this they say this question, but this question is already answered by just writing in one paragraph. The question is already answered. So that you have to understand the entity on a continuous basis. Throughout the audit, you should remain alert for extra information. But if you just write this paragraph, you will not get 3 or 4 marks. No, just they have given you this question, asked you for 4 marks. In one line we can answer, but if we answer in one line, will we get that 3 or 4 marks whatever we have expected? No. So we have to make our answer look lengthy. How we can make our answer look lengthy? Now you have to add something extra. What you have to add? So what they have done is, they have given one statement, yes, obtaining understanding entity is a continuous process. After that they have added, if you understand the entity, how you will get benefited. So but they put it in different words. They might ask a question from this also. The understanding establishes a frame of reference with which auditor plans the audit and exercises professional judgment. So how they might frame a question from this is, by understanding the entity, the auditor can establish a framework within which he can exercise a professional judgment. Give examples. Now you all will get confused from where this question has been taken from. From where this question has been taken from, you will not be able to understand only. But this is where the question has been taken. So one sentence, somewhere, some sentence which we ignore completely, from that sentence they will create a question out of it. Understood? Right. So how they will ask a question here? They will say, by understanding the entity, the auditor can establish a framework within which he plans and exercises a professional judgment. State examples for this, or give a few illustrations for this. Like this they will ask. So then you are required to write these examples. So basically, what is the meaning of this entire sentence is by maintaining professional judgment, you can take better decisions during the course of audit. What do you mean by professional judgment? Decision making. You have to take your decision according to your knowledge, experience, and training. So when I say it is going to increase your professional judgment, that means it will help you to make better decisions. How? Why? Because by understanding the entity, you can easily assess risk of material misstatement. If you assess risk of material misstatement, you can betterly plan your audit procedures. Next one, it will help you to determine materiality. Even if you understand risk of material, even if you understand the entity, you can betterly determine your materiality levels. Considering appropriateness of selection and application of accounting policies. If you don't know business, how you can judge whether accounting policy is correct or not? Like as I told, SLM or WTV, the basic accounting policy, whether SLM method will be appropriate or WTV method will be appropriate, that itself will depend on the nature of the business. Pattern of consumption of machines. If you want to know pattern of consumption of business, pattern of consumption of machines, you need to have knowledge of client's business, and also you can identify. Not audible. Gone. So yeah, next point. One more advantage if you maintain now, if you understand the entity, it will help you to decide which areas require special consideration. In way, basically wherever risk is high, there we pay more attention. Wherever risk is low, there we pay less attention. And also it will help you to develop expectations for use when performing analytical procedures. So this we will try to cover in SA 520 when we take up the analytical procedures. And it will help you to evaluate sufficiency and appropriateness of audit evidence. So we need to evaluate whatever evidence we have obtained, is it sufficient and is it appropriate or not. One of the factor which will affect the decision regarding sufficiency and appropriateness is this understanding of the entity. That will also help you, if you understand the entity in a better manner, that will also help you to evaluate whether evidence you have obtained is sufficient and appropriate or not. Understood everybody till here? So with this we have completed the risk assessment part. Now we will come to the internal controls part. So what is this internal control? I told you one simple meaning. What did I tell you regarding internal control? I told internal control means any policy or procedure which is designed, implemented and maintained by the management to prevent the mistakes from happening in the organization. That policies and procedures, we call them as what? Internal controls. So that is what we have already understood. But that is not exactly the technical meaning. The term internal controls has been defined. So how they have defined is, if you see it here in SA 315 they have defined it. So they say that internal control may be defined as similar to whatever I have told, but little bit very detailed definition. They say it is a process which is designed, implemented, maintained. Designing also will be done by some parties. Design, implementation, maintenance, three things. Design means what? That thought, what process should be implemented. Once that thought has come to mind, that alone will not be enough. That needs to be put into action. That we call it as implementation. See, just putting into action alone will not be enough. You have to maintain whatever you thought, whatever that thing came into your mind. If you implement it, you need to see whether whatever we thought that is practically working or not, or are we required to make any changes. So that phase we call it as what? Maintenance. So any process which is designed also, implemented also, maintained also. By whom? By those charged with governance, basically top level management. Those charged with governance, clearly I will explain when I take up say 260 and 65. There I will explain the differences between management and those charged with governance. So which is designed, implemented and maintained by those charged with governance, management and other personnel. Who will come under other personnel? Will auditor come under other personnel? No. Will auditor not design, implement or maintain the internal control? Never. He should not do it. If he does that, that will become a self-review threat. If he does that, what will it will become? Self-review threat. Why? Because as a part of audit, we are required to evaluate internal control. If you designed, implemented or maintained the internal control, whatever work you have done, that only you are reviewing. So that will become a self-review threat. So then who are this other personnel? Employees. See, management might design, but management will not implement. Who will implement? Staff will implement. Sometimes a design itself will be done by other personnel, some experts, industry experts, business consultants will be there. Today, many chartered accountants are giving up their practice and acting as business consultants also. So they might, if they don't know what kind of controls are required to be there in their organization, they might even take the help of business consultants, like those people will come under other personal definition, but auditor will never come there. So any process which is designed, implemented and maintained by management, those charged with governance, other personnel. And for what purpose these processes are designed? They say that to provide reasonable assurance about achievement of entity's objective. Every entity will have an objective. My business also will have an objective, some others business also will have an objective, Reliance also will have an objective, Adani also will have an objective, everybody will have an objective. For achieving their objectives, to fulfill their objectives, any process which is getting designed, implemented and maintained by those charged with governance, management and other personnel, that we call them as internal controls. So overall, broader objective, if I have to say, the broader objective of internal control, I have to say, to help the organization to achieve its objectives. But when I narrow it down, when we talk about specific objectives, see, broader objective is it will help the organization to fulfill their purpose. But when I narrow it down, when I specifically talk about the specific objectives, I will say every internal control you take, that will try to fulfill at least one of the four objectives. At least one of four specific objectives. So what are that four specific objectives? Number one, first and foremost, safeguarding of assets. What is the first and foremost one? Safeguard. Here they say reliability, but I will tell you logic why I am telling safeguarding of the assets. Any internal control you take, the main purpose will be to protect the entity's assets of the company. So you take security guards. Why security guards? To protect the assets of the company, to stop anybody from stealing the assets. CCTV footage, once again, to protect the assets. Account in the approval mechanism, voucher should be signed by the manager. That is also indirectly related to safeguarding the assets, which is nothing but cash. So like that, any internal control you take, directly or indirectly, it will be related to safeguarding of the assets. Then some internal controls will be related to reliability of financial reporting. Some internal controls will work with the objective of increasing reliability of financial reporting. Reliability means what? Trustability of financial reporting. Mainly accounting controls will come here. In the accounts department, we have various controls like check signing authority, I have told. So up to 10,000 cashier, 10,000 to 1 lakh finance head, more than 1 lakh rupees CFO and all. So these kind of internal controls, and if you pay close attention to this internal controls also, two objectives it is fulfilling. It is safeguarding the asset. Basically, the bank balances of the company, it is safeguarding. In addition to that, it will make the banking transactions more reliable also. Next, third one, some internal controls will work with the objective of increasing efficiency and effectiveness of operations. They might not be related to financial reporting. Some internal controls will be working with the objective of ensuring efficiency and effectiveness of operations. Example. So this example I very often use. One simple way to understand is restricting the access of the employees to the internet. IT companies and all will have internet access to their employees. They will restrict the access so that people will not waste their time. Or companies plan schedule maintenance. SBI server, sometimes it will not work. They say server is under maintenance. So that is also internal control. So during that maintenance, what they do is they do some system runs and all to make their servers relevant, to avoid any major damage. That is a planned maintenance, we say. That is also an internal control. So that they will keep their servers foolproof, or during that maintenance time, they might be taking backups. Some essential activity they will be doing. That is also one internal control. So next, some internal controls will work with the objective of ensuring compliance with applicable laws and regulations. Some internal controls will be implemented exclusively with the objective of implementation of internal controls. Like for example, data breach. IT companies deal a lot of client data, a lot of personal data. Their data should not be breached. So in order to make sure that the data will not breach, they will implement so many kind of internal controls, data encryption and all we see. So that controls are implemented to ensure applicable compliance with applicable laws and regulations. So you pick any internal control in the organization, it will try to fulfill at least one of the four objectives. Some internal controls might fulfill all the four objectives also, but at least to one objective it will relate. So what are that four specific objectives? Number one, safeguarding of the assets. Some will increase the reliability of financial reporting, efficiency and effectiveness of operations, and applicable laws and regulations. Now, there is one more term called internal financial controls. There is one more term called internal financial controls. Practically speaking, both are actually same. The term internal control is defined under standards on audit. The term internal financial controls has been defined under Companies Act. That's the only difference. More or less, the definition will remain the same. So if you go to that specific question of internal financial controls, there they will say that internal financial controls are also nothing but processes for the purpose of achieving 5 objectives, they say. Under standards, they say 4 objectives. Under Companies Act, they have told 5 objectives. What are that 5 objectives? These 4 will remain the same. Safeguarding the assets, reliability of financial reporting, efficiency and effectiveness of operations, applicable laws and regulations. In addition to that, they will say one more thing, prevention of frauds and errors, they say. What else they have added? Prevention of frauds and errors. If you ask me, prevention of frauds and errors is an indirect outcome of all the above 4. If you properly take care of all the above 4, ultimate objective is frauds and errors will get prevented. So that one more line they add there and they define the term as internal financial controls under the Companies Act. So technically speaking, both the definitions are same. Just they have explicitly stated that one more objective as prevention of frauds and errors. Understood, right? Now, internal controls. I have told that if you pay close attention here in the definition, they have told internal controls provide reasonable assurance about the achievement of the entity's objectives. About achievement of entity's objectives. We have seen even auditor is also liable to obtain only reasonable assurance. They are telling that if you have internal controls, even internal controls also will give you reasonable assurance that these objectives will be met. Internal controls will not give you absolute assurance. That means just because you have internal control, there is no guarantee that no fraud or error will happen. It is like saying if I have a CCTV camera, no theft will happen. Can I say that? But still after that also there is a possibility of happening. So the same logic applies here, like the way the process of audit is suffering from some inherent limitations, because of which we are not able to obtain absolute assurance. Even internal controls are also suffering from some inherent limitations. Those limitations which are avoidable or unavoidable. Those limitations which are unavoidable in nature, no matter whatever you do, those limitations can't be avoided. So even internal controls also suffer from some inherent limitations, because of which they can't provide absolute assurance. They will only provide reasonable assurance. Understood? So what are that limitations which internal controls are suffering from? Guys, if they ask you objectives of internal control, also write the 4 points. Even if they ask you what is the purpose of internal controls, also write the same 4 points. Okay, don't get confused. Objectives or purpose, for both the thing you write the specific 4 things whatever we have seen. Next. Yeah, so what are the limitations of internal control? As I've told, internal controls can only provide what? Reasonable assurance. Why, sir? What are that limitations? Number 1, human judgment and decision making. Who will design internal control? Humans. Are we error free? So being human, it is an inbuilt ability, capability for us to do mistakes. So which can't be avoided. Yes or no? So our nature is, God has created us that way. So we can't avoid that. So even internal controls also will be designed by human beings only. That management, those charged with guns, they're all not someone who has fallen from the sky. They're also human beings like you and me. So even these people also, when they are designing internal controls, some human error they might have committed, which they might not notice. Or if I put the same thing in other way around, as a human, we make judgment only till the extent we can imagine. For example, if I think that the fraud can happen in 10 ways, the fraud can happen in 10 ways. Say, for example, in this room, I am keeping some important stock. So now I felt that someone might come and commit a theft. So I have thought of implementing internal control. Oh, okay. How a person can come and enter in this room and commit the theft. I found that there is one door there. I thought, okay, let me appoint a security guard there. Let me keep a CCTV camera there. Good. I have imagined the theft will happen in that manner. I have implemented internal control. But now, next time when a person wants to commit theft, I realize that he is not coming from that way. He is coming from that window. He is coming from that window. So now what I have done is, okay, one more way of fraud is happening. What I have implemented, I have taken all that windows and I have implemented the wall. So now for some period the theft did not happen. Then after some time, once again I found out the person is having a lot of urge to commit that fraud and all. One day he dig a hole on the top and came. Anything can happen. No, then I will fix it. Then what will happen? He might come from below. So as a human being, I can implement internal control only to the extent I can imagine. But the person, whoever is committing the fraud, he can always come up with new ways which can make my control fail. So human judgment is always involved. Then Lack of understanding the purpose. Internal controls also will fail because those people who are required to implement internal control, they will not understand the basic purpose of the internal control only. So here I often use the example of that security guards. When you visit the supermarket, when you are done with your billing, the security guard will be standing at the exit gate. What he should do? He should check. So he got the instruction, boss, every customer, whoever is going out, check the items which he is carrying. Now what that security guard is doing is, every customer who is going out, he is stopping the customer. He is taking the bill. In the bill, some 10 items are there. Now he will check whatever items which are there in the bill, whether those items are there in the trolley or not. 10 items are there in the bill, that all the 10 items which are there in the bill, those are in the trolley. If he is satisfied, he is sending out. Is the control working effectively there? Control is not working effectively there. There is a blunder. What is the blunder? He should check the items which are there in the trolley, they are included in the bill or not. Yes or no? So he got instruction. He did not attend the class properly. The training session he did not attend properly. He slept there. He understood only one thing. I have to check. But we have to check what with what he did not understand. He should check the items in the trolley with the bill, not the items in the bill with the trolley. So the person who is required to implement internal control, he did not understand the basic purpose only. Now you tell me, will that control work effectively? Definitely not. Next, collusion among people. So one more main reason why internal controls will fail is collusion. People at different levels collude with each other. So even the so-called biggest scams, what it all has taken place in India, PNB scam you take, or this Kingfisher Airlines, or many other kind of scams have taken place. Do you think in those organizations internal controls are not there? 13,500 crores worth of scam in the Punjab National Bank. We all know how nationalized banks will work. How many internal controls we have, we know. If you want to withdraw the money, if you want to go to the bank and withdraw the money, how many counters you have to go, we know. So that level of internal controls they are having. Even after having that extent of internal controls also, someone was able to pull off 13,500 crores worth of scam. How come that was happening? Because collusion. People, what the organization has done is they have divided the work among so many people with the objective of ensuring that no fraud or error will happen. They have implemented internal control. But those people among whom the duties are divided, they colluded with each other. Even the same thing happened even at the PNB scam. Starting from the clerk, manager, branch head, director, external party. These many people have colluded with each other. They are able to successfully override the internal control regarding the SWIFT transactions and all, and they are able to happily pull off 13,500 crores worth of scam. So collusion is a major problem because of which internal controls can fail. And then comes judgments by management. So yeah. Further, in designing and implementing internal controls, management may make judgments. This is also more or less related to human judgments in decision making. So something related point. Next, limitation in case of small entities. In the case of small entities, the problems with the internal controls are much higher. Why? Because in small organizations, you will not find large number of people. Segregation of duties will not be possible. And in small organization, if the owner himself is managing the business, he will have control over entire organization. So he himself will not encourage for segregation of duties. So that's why in small organizations, even though controls look like it's working, but there are more chances that control might not be working there. So you have to be a bit more careful when you're doing audit of small entities. Understood? So these are all the various limitations of internal controls, because of which you can only obtain reasonable assurance, but not absolute assurance. Then, and if you remember, this is the point which they have told in the inherent limitations of audit also. First point, nature of financial reporting. Their first point, they have told management will make use of assumptions and judgments, and these assumptions and judgments can go wrong. Second point, they told we do the audit with the assumption that internal controls are there, but even those internal controls are also suffering from inherent limitations which can fail, because of which our opinion also can go wrong. There we have given reference, here we have understood the concept. Able to understand the linking? Yes or no? Right. Next. And next important concept. See, I told in an organization, many controls will be there. Different controls will be related to different objectives. But do you think all the controls which are there in your client are relevant for you, are relevant for audit? Should the auditor be concerned about each and every internal control? Should you understand, should you verify each and every internal control? See, there might be numerous amount of internal controls, but all controls will not be relevant for audit. So whether a control will be relevant for audit or not, it depends on many factors. Like if I have to give the example for you, I told about one internal control, that whether access of the employees to the internet is restricted or not. That is internal control. But is it relevant to audit? As an auditor, are you supposed to go and check whether every employee is having access to internet or not? That is not relevant. So like many controls will be there, but all controls are not relevant. Whether a control will be relevant or not, that depends on various factors, and those factors are materiality, whether that control is material or not. It depends on significance of the related risk. What is the risk that control is trying to prevent? And size of the entity. It depends on entity's business. It depends on diversity and complexity of the entity's operations. It depends on applicable laws and regulations and the circumstances of components of internal control. Components we'll see just now. And it depends on nature and complexity of the systems that are part of entity's internal control, including the service organization. This I will say ignore it. Service organization and all is relating to SA 402, not a part of our CA inter syllabus. It is a part of CA final. SA 402 service organizations and all, you can ignore that. Next, whether and how a specific control, individually or in combination with others, prevents or detects or corrects a misstatement. So basically, these many factors will be there. After considering all these factors, you will decide whether a control is relevant for you or not. If the control is relevant for us, we will consider it, we will understand it, we will test it. If the control is not relevant for us, what we will do? Ignore it. So generally, what kind of controls are often relevant for the audit is those controls which are operating over completeness and accuracy of information. Basically, those controls which are working on completeness of accounting records, accuracy of the accounting records, those controls will be generally relevant for us. Similarly, controls which are operating over safeguarding of the assets. That is also in most of the cases, in majority of the cases, those controls which have the objective of safeguarding the assets, they will also be relevant for us. When it comes to efficiency and effectiveness of operations, when it comes to compliances with the laws and regulations, in many cases they might not be relevant for us. Clear? Next. So this is regarding relevance of internal control. Next, the next thing which we'll try to understand. So are you required to evaluate internal controls? Are you required to test and understand and evaluate the internal controls? Yes. Now, the standard says there are 4 methods for evaluation of internal controls. How many methods are there? 4 methods are there for evaluation of internal control. So what are that 4 methods which are available for evaluation of internal control? They say 4 things which are narrative record, then we have checklist, internal control questionnaire, and then we have something called flow chart. So these are the 4 methods which are available for evaluation of internal control. So let us try to understand about each of the method in a detailed manner. Once again, important from the examination perspective, there is a chance of testing a case scenario based MCQ also from here. So what is a narrative record? First, we will try to understand about the narrative record. What is a narrative record? So in the narrative record, what we do is first we go and understand the internal control, and whatever understanding we have obtained regarding the internal control, that we try to do a exhaustive description. What we try to do? We try to do a exhaustive description of internal control. And in flowchart, what we do? Here also we will try to understand internal control, but whatever understanding we have got, whatever flow of the transactions we have got, that we will try to present it in a diagrammatic format, a pictorial representation we are going to do. So that we call it as a flow chart. Between narrative record and flow chart, which one is very much time consuming? Narrative record is very time consuming. Why? Because first you have to understand the control, then you have to develop a record of it. Which one is briefest way of presentation? Flowchart is a briefest way of presentation, which will give a better overview. Flowchart. Where it is easy to spot errors. Flowchart only. In narrative record, we have to read many pages to find out the error, but in the flowchart, you can, since it is a diagrammatical presentation, we can pinpoint where it is there. Now, narrative record, where it is suitable, large entities or small entities, smaller entities. So these are 2 methods, but widely used methods are checklist and internal control questionnaire. So what happens in the checklist and internal control questionnaire is, in both the cases, it contains series of questions, series of logically arranged questions. Questions regarding what breakfast you will eat, what lunch you will eat, what dinner you will eat. No. So the questions are regarding elements of internal control, desirable elements of internal control. And the questions will be drafted by auditor in the sense auditor or his staff. In both the cases, internal control questionnaire and checklist, in both the cases the questions will be there regarding the elements of the internal control, and in both the cases the questions will be drafted by auditor, and the questions will be drafted in such a manner that yes, no or not applicable. So both contains the same thing. And what exactly is the point of difference? Where the difference lies? Who is going to answer that questions? In the case of the checklist, the questions will be drafted by the auditor, but they will be answered by auditor's staff only. So if it is a checklist, what I do is I will draft the questions. I will call my article assistant. Hey, these are the list of questions in the area of purchases. You go to the purchases department, verify the controls, come back to me with the answers. You can also call them as instructions. In the case of checklist, you can also call them as instructions. Basically, in the purchases, 10 questions I have given. That means he has to go and verify that 10 questions. It can also act as a instructions. So in the case of checklist, you can either call them as a list of questions to be answered by the audit staff, or even you can say a list of instructions to be followed by the audit staff. Now, in the case of internal control questionnaire, what I will do? So I will draft the questions, and this questionnaire, I will hand it over to the management, either the client's management or client's staff. They will answer that questions and give it back to me. See, in the case of internal control questionnaire, the main task is not asking the questions and getting the responses. The main task is evaluating the responses. Whatever responses you have got, that you have to evaluate. And what else they say in internal control questionnaire? In ICQ, they say more points. In checklist, they say limited points. But in ICQ, they say some extra points. So in ICQ, what they say here is, once you got the responses, and one more thing you can do in internal control questionnaire, for no remarks, for negative remarks, you can add the remarks column also if you want. And once you got any negative response for the question, whatever you are asking, you can even ask the man before forming any conclusion. First, you have to go and discuss that with the management. You asked one question, and to that question, if you have got a negative response, don't immediately jump to the conclusion. First, go and discuss that negative comment with the management. Why they specifically say here is sometimes management might misunderstand the question. So that's why they might have given a wrong response. So that's why better before forming a conclusion, go and consult the management once, go and discuss the management once. Did they understand the question properly and gave the appropriate response? Okay, clear and comfortable then. After that, they say one more thing. In the case of internal control questionnaire, you have to draft the questions in such a manner that yes answer denotes a positive reply, no answer denotes a negative reply, and wherever it is not applicable, then not applicable, this should be given. This is only a instruction, not a hard and fast rule. To the extent possible, try to draft the questions in such a way that S indicates a positive response, no indicates a negative response. But whether S is a positive response or no is a negative response, it depends on the question you are asking. It depends on whatever question you are asking. If I say you are a waste fellow, answer is yes, positive or negative. What here? Not applicable, right? So if you get the yes as an answer there, that is a negative response. So whether S is a positive response or no is a negative response or not, it depends on question you are asking. But to the extent possible, try to draft the questions in such a manner that S indicates a positive answer, no indicates a negative answer. Understood? And apart from all this, the most important thing in this methods is for internal control questionnaire. Out of all this four, ICQ is very important, and in that ICQ also I have given examples. In the material you will be able to find the examples, like what kind of questions will be there in the area of purchases, what kind of questions you will draft in the area of creditors, what kind of questions you have to draft in the area of inventories, what kind of questions you have to draft in the area of fixed assets and all. This is very important. So they might ask a question, assume they will create a scenario actually. You are conducting audit of so-and-so company, you are supposed to verify the fixed assets, draft a questionnaire for the area of the fixed assets. So that kind of examples, they can ask it as a question instead of the concept. I told you no, unfortunate, very unfortunate. They might ask the examples and draft the questions there. But yeah, we have to get through the examination, whatever it is, whether we agree or disagree. First objective here is to get through the examination. So please go through these examples. Don't miss it. Please do refer it without any fail. Write it somewhere, mark it somewhere, but these examples refer and then go for the examination. Correct. So methods of evaluation of internal control also we are done. And apart from that, one question which I generally feel important is what are the benefits for evaluation of internal controls? If you evaluate the internal controls, how you will get benefited? Number one, you will come to know whether controls are working effectively or not. And number two, depending on that effectiveness of controls, you can plan your substantive audit procedures. Number three, you will come to know whether internal audit department is working effectively or not. Why? Because sometimes we might be required to rely on the work of internal auditors. So whether internal audit department is working effectively or not, you can get to know by determining effectiveness of internal controls. And also you will get to know which areas require special consideration, and also you will get to know, depending on that, which audit technique will be appropriate. So which method will be appropriate. Like as I've told, internal controls are not at all effective. Out of the 7 methods, you want most effective method. In some area, internal controls are not at all effective, internal controls are wrong, internal controls are not operating effectively. So you need to perform that method. You want to perform such a method as a substantive audit procedures, which will give the most effective evidence. Which method will give most effective evidence? Yesterday only I have told. Most effective reperformance. Most effective reperformance, most efficient is inquiry. Right. So which audit method will be suitable? That also you can decide on the basis of effectiveness of internal control. And if you evaluate internal controls, you can even give suggestions to the management to improve, to overcome the weaknesses that will indirectly benefit management also. So if you do the evaluation of internal controls, these are all the various benefits which you and also the management is going to get. Okay, then I want to talk about one more aspect as a part of this internal controls. After that, we will wind up this chapter. So one more aspect which I want to talk here is regarding components of internal control. We will talk components of internal control. So any internal control you pick in the organization, there will be 5 components. Basically, you can call it as, if an organization wants to implement internal control, they have to go through 5 components. 5 components they have to set. So what are that 5 components of internal control? Number one, control environment. First, they have to work on establishing control environment. Number two, entities risk assessment. Number three, control activities, no, information system, including related business process. And number four is control activities. And number five is monitoring of controls. So I need to charge my pencil for a while. In the meantime, I will orally continue. So there will be 5 components of internal control. What are the 5 components of internal control? Control environment, entities risk assessment process, information system including related business process, control activities, monitoring of the controls. So what exactly happens in each of this component? First one, if we talk about the control environment means, if you want to implement internal controls, first you have to create a good culture in the organization. Culture of honesty and ethical behavior you have to create. If there is no good culture in the organization, if your employees are not honest, if there is no ethical behavior among the employees, no matter how effectively you implement internal controls, those internal controls are never going to work for you. So if you want to implement internal controls, before you do anything, the first step which management should focus is what? To create a control environment, to create a good culture of honesty and ethical behavior. Now, how the management can create a culture of honesty and ethical behavior? What factors will implement that? What are the elements of creating a good control environment? So you'll be able to have a few points here. Like if I take you through that discussion, this thing is also getting tested. So that's why I wanted to make sure. Yeah, this one. Elements of the control environment. So if you want to create a good control, when I say if you, I'm not talking about auditor, I'm talking about the management. So if the management wants to create a good control environment, what they should do? Number one, communication is very important. As a management, you should communicate with your staff how important it is to maintain integrity, honesty. Communication alone will not be enough. Even you have to enforce. What do you mean by enforcing? Implementation, taking action. You are saying that honesty is very important, but you found one employee who is committing a fraud. You are not taking any action against him. Tell me, will control environment will be created? It will not be created. So in order to ensure a good control environment, it should be communication as well as enforcement. You have to put that into action, not just communication. You have to put that things also into action. Next, commitment to competence. When you are recruiting the people, you should show your commitment to capabilities. Those people who are competent, that people only you are required to recruit. Next, participation by those charged with governance. Those charged with governance means top level management. When I say people are top level management, should they always sit in their cabins and never participate in the business? No. The more they participate in the business, the better environment will get created. The lesser they participate in the business, the less environment will get created. Next one, it also depends on management's philosophy and operating style. So what kind of philosophy management is following, and also what kind of attitude they have towards financial reporting. Some management will have a very good attitude. Whether we are showing profits or losses doesn't matter. Correct information should flow to the shareholders. That is a good philosophy. The management is setting an example for good culture. Some managements will be there. They will say whether we are showing correct information or not doesn't matter. Our financial statement should always show profit. So this is a what? Bad attitude. They're setting a bad example for creating a culture. So like this, it depends on what is their attitude, how they are selecting accounting policies, what approach they are having towards business risk. Some management will be there. They will kindly accept the risk, whatever risk they are facing. They will accept it. They will announce it before public, how they are going to tackle it, what are the steps for the future. That also they will come and disclose it. Some management will be there. Whenever they face any risk, they will keep on trying to hide it, which is actually a bad example for creating a culture. And also it depends on organizational structure, the framework of the organization, what structure they have set, what rules and regulations are there, what hierarchy is there. So that also decides. And assignment of authority and responsibility. So the organization should be set in such a way that some person is doing an activity, some person is approving an activity. Authorization mechanism should be there. And finally, it depends on human resource policies, HR. That should be reflected even in your HR policies also. Like you should be rewarding the people who are showing that honesty and ethical behavior. You are punishing the people. You are taking stringent policies and actions on the people who have not committed to their integrity and ethical behavior. So even in your HR policies also, you have to implement this. So these are all the elements. These are all the different ways by which a good control environment will get created. And one more question which has been repeatedly tested in the examination is relating to control environment. Existence of a satisfactory internal control environment is not a absolute deterrent to fraud. This meaning of the statement we have to understand. Existence of a satisfactory control environment means what? Control environment, just now I have told, culture of honesty and ethical behavior. So existence of satisfactory control environment, which means in an organization, there is a very good culture of honesty and ethical behavior. I'm very much satisfied how much good culture this organization is having. Does that mean no fraud will happen in the organization? That's what the statement says. Existence of a satisfactory control environment is not an absolute deterrent to the fraud. That means just because you have a good control environment in the organization, that doesn't guarantee that frauds will not happen. Do you agree with that statement? 100% yes. Why? Why? So they say here, the existence of satisfactory control environment, it is a positive factor. Definitely, it is a good sign, but it is not a absolute deterrent to fraud. So deficiencies in control environment may undermine the effectiveness of internal controls. On the other hand, if you have weakness in the control environment, if the organization is not having good culture, then obviously there is a strong indication that controls will not work effectively there. So for example, they give a few examples here. Yeah, this is example, you ignore it. Let us come to the main point. Why satisfactory control environment is not absolute deterrent fraud? The control environment itself does not prevent or detect and correct a material misstatement. Control environment itself is not a complete control. It is just one of the component. Only if one component is working, internal control will not work effectively. To say that controls are working effectively, to say that frauds will not happen, you need all other 5 components also. Not just one component alone will be enough. So control environment itself does not prevent, detect or correct a material misstatement. However, it will influence the auditor's evaluation of effectiveness of internal controls. So you cannot decide purely on control environment. Just you can take what is that saying. That means you can consider if there is a satisfactory control environment, you can treat it as a good sign. But don't take it for granted that controls all will become effective, no fraud will happen, because it is only one of the component, not the entire internal control system. Then number 2, entities risk assessment process. Basically, why organization will implement internal control? To prevent the frauds and errors. Before they can implement internal controls, first they should know in the organization where there is a chance of happening of fraud and error. So basically, the organization should study about their own organization. Risk assessment they should do. Risk assessment till now we have seen auditor will do. Why auditor will do risk assessment? To identify the risk of material misstatement. Why he will identify risk of material misstatement? To plan his audit procedures. The same activity should be even done by management. Management also should study the organization. They should also identify the risk of material misstatement. But with what objective? To implement the internal controls. So risk could arise from different sources. So they have to identify risk from different sources, and accordingly they have to implement the internal controls. Then third step, information system including related business process. The meaning of this component is today all the internal controls we are relying on information technology. And here they specifically talk about accounting systems. If you want to implement internal control today, you need some information system. You need some software, hardware, and database, all that you need. So you need to have a strong information system. Strong information system in the sense that information system which can properly classify the transactions. It should be able to properly classify the transactions. And also the procedures by which those transactions are initiated, recorded, processed correctly. From the initiation till the final entry, they should be able to do proper procedures. And also all the related accounting records which are getting generated by this information system, and how the information system captures events and conditions, how it is getting the data. And also you need to understand the financial reporting process and what kind of controls should be surrounding journal entries. So you need to have a proper information system which will fulfill all these purposes. Clear? Next. And control activities is basically the actual implementation of internal control. So in the first step you have created control environment. In the second step you have done risk assessment, identified the risk. Third step you have acquired all the necessary information systems. Now what is the fourth step? Now you have to start designing the controls. So in which area which control I have to put? Like in some areas I will implement something called performance reviews, nothing but verification. Periodical verifications I will do, like periodical stock verification, periodical BRS. This is a kind of internal control. And in some cases, I will implement information processing. These are the controls relating to information technology. I will implement information technology controls. Sometimes I will put physical controls like appointment of security guards, CCTV cameras. In some areas, I will implement something called segregation of duties. Basically, work is getting divided among many people. So like this, once you have created a control environment, once you have done the risk assessment, once you have acquired information system, now you have to decide in which area, which kind of control activity is required. And with that, you will implement. That's all. Your responsibility is over? No. So just with implementation, your responsibility is not going to come to an end. You have to even monitor that. Who has to monitor? Management has to monitor. On a continuous basis, they have to monitor with whatever objective they have implemented the control, whether that control is achieving that purpose or not. And organizations can do monitoring either as a ongoing process. As a part of regular activities, they can do monitoring. As a part of day-to-day activities, they can do monitoring, or even they can plan it separately also. So that's what they say here. The monitoring can be done either either through ongoing activities, or even by way of a separate evaluation, or even they can use a combination of two. And also for monitoring the internal controls, the management can use internal communications, and the manager can also use external communications like complaints from the customers, notices from the regulatory authorities. That kind of external information also can be used for the purpose of determining whether controls are working effectively or not. So this continuous monitoring also should happen. Out of all these 5 components, first and last is very important. Control environment is very important. Monitoring is very important. Clear? That's all. With this, we will wind up this chapter, risk assessment and internal control. So, okay. So now we are going to learn the standards on audit. In the previous session, we have completed risk assessment and internal control. So we will be discussing now the standards on audit, and this entire standards on audit chapter, we are going to cover it as a part of this chapter. So before we dig deeper into the standards, first let us try to understand the different categories of the standards which the institute has released. So we have something called Auditing and Assurance Standards Board, which is working under the leadership of ICAI, and they are working for harmonizing and bringing the improvements in the auditing and assurance professions, whatever assignments we do, to improvise it or to bring the harmony in that. So this AASB, under the guidance and the leadership of ICAI, they are giving different kinds of standards, and they have given 4 categories of the standards. How many? 4 categories of the standards they have given, which are standards on audit, then we have standards on review engagement, standards on assurance engagement, and standards on related services. So let us try to understand when which standard will become applicable. So first we will talk about SAs. SA stands for standards on audit. These are the standards which will become These are the standards which will become applicable when you as a chartered accountant, when you are performing a audit engagement. When you are performing what? Audit engagement, that too of historical financial information. So when you are performing audit engagement, that too of historical financial information, then you are required to apply the content which is given in SAs. Now, and what kind of engagement audit is? Say reasonable assurance engagement. So in audit, we try to obtain reasonable assurance. And reasonable assurance is a high level of assurance. It is not a absolute assurance. At the same time, it is not a low level of assurance. It is not the medium level of assurance also. It is what? High level of assurance. We will not get 100% guarantee, but we'll try to get the highest level of assurance, where we try to perform audit procedures, we try to get the evidences, we try to check the supporting documents, we perform analytical procedures, we follow different methods, and unless and until we get sufficient and appropriate audit evidence, we will not give that opinion. So that engagement is audit engagement. So whenever you are doing audit engagements, that too of historical financial information, then SAs will become applicable. Then standards on audit engagement will become applicable. Then we have something called SREs, standards on review engagements. These standards will become applicable whenever you are doing something called a review engagement. So what is the difference between audit engagement and review engagement is? Yeah, so in audit, we obtain reasonable assurance, high level of assurance. But in the case of review engagement, you obtain something called limited assurance, very, very limited. So frankly speaking, in the case of review engagement, we will not even check the supporting documents also. Just we will do overall verification. Like listed companies will prepare something called quarterly financial statements. That quarterly financial statements, will they be verified by the auditor or will they not be verified by the auditor? They will be verified by the auditor. But that verification, we don't call it as audit. That verification, we call it as what? Review. In the case of quarterly financial statements, what auditor will do is just auditor will check the overall presentation, the profit figures calculation and all. So presentation perspective only he will check. He will not go into the supporting documents. If at all required, some minimal analytical procedures he will perform. But opening the documents, checking the supporting documents, all that he will not do. So that engagement, we call it as limited assurance engagement, and they will become applicable when a chartered accountant is performing review engagement of, once again, historical financial information. Then SREs will become applicable. Then we have something called SAA, standards on assurance engagement. These standards will become applicable when a chartered accountant gets associated with other than historical financial information. What? Other than historical financial information. When I say other than historical financial information, it could be a non-financial information also. It could be a future financial information also. When I say non-financial, when I say other than historical financial year, number one, it could not be altogether a financial information. It could be he could be doing some assignment with relating to non-financial information, or he might be doing some assignment relating to future financial information. So when he is doing some engagement regarding non-financial information or future financial information, then which standards will become applicable? SAEs will become applicable. If I have to give you an example, non-financial information, you can say internal controls. In some engagements, you will do something, you will verify only internal controls and give a report. So that engagement is a non-financial information. So their assurance engagement, SAE, will become applicable. On the other hand, future financial information, prospective financial information, we say. So whenever you are concerned with prospective financial information, like projections, estimates, at some place I have used this example. So sometimes you will be required to prepare projections and all. I think while explaining assurance engagement as a part of nature, objective, and scope of audit. So in case if you are concerned with future financial information like projections, estimations, prospective financial information, then also you are required to follow something called standards on assurance engagement. And here the assurance which you will be offering is moderate assurance. Here what they say, moderate assurance, somewhat mid-level. So if I use simple terminology, low level of assurance, review. Mid level of assurance, assurance. High level of assurance, audit engagement. Clear? So whenever you are doing any engagement which is associated with other than historical financial information, then SAs will become applicable. Then we have finally something called SRS. So what is SRS? Non-assurance. Yeah, you can also say those engagements where you will not give any assurance, where you will perform something called agreed upon procedures. where you will perform something called what? Agreed upon procedures. You agree with the client to perform some procedures, you will perform it, you will not give any kind of assurance. Like for example, one day a client has asked you to prepare the financial statements for them. They already have the books of accounts and all, but they don't know, they don't have an expert who knows who knows companies act and schedule 3. So they have approached you, sir, you please prepare the financial statements for us, we will give you some amount of money as fees. So I accepted the engagement. So as a part of that engagement, I'm not giving any assurance. What I'm doing? I'm performing some procedures which I have agreed with the client. So those kind of engagements, I call them as related services. And whenever you are performing related services, you are required to comply with something called SRS. Clear? So here how the questions they are asking is they're asking differences between reasonable assurance and limited assurance engagement. So they have asked also in fact once. In one case they have asked in question regarding what is the difference between historical financial information and prospective financial information. So and sometimes they have asked a question difference between SAs and SRAs. In one attempt they have asked this question. So better that introductory information is there. I have given you the concept. Just go through the introductory information before you go for the examination, because from there also you are getting a significant questions. Understood? Now all these four standards put together, we call them as engagement standards. All the four standards put together, what do we call them? Engagement standards, we call them. Now, whenever you are performing any of this engagement, be it audit, be it review, be it assurance, be it related service, you are required to follow one more thing called quality control. You have to maintain quality in all the engagements, whatever you are doing. Whether you are doing audit engagement, whether you are doing review engagement, whether you are doing assurance engagement, or you are performing related services. Do you think is there a requirement for maintaining the quality in all the work, whatever we are doing? 100%. If you don't maintain the quality in our work, what will happen? Entire profession will get blamed. So no, so that's why whatever work we are doing, be it audit engagement, be it review engagement, be it assurance engagement, be it related service, there needs to be what what their quality needs to be maintained. And in order to maintain that quality in the engagements, we have one more series of standards called SQC, standards on quality control. We have, and that we have only one standard, SQC1 we have. So this SQC will become applicable whenever you are doing any engagement. And what does SQC help us out with? It will help us with maintaining the quality in all the engagements, whatever we are doing. Clear? Able to understand everybody? Right. So with this background info, now we will go to the standards. Now we'll start understanding the standards. So we have a few things which we are required to discuss, few standards we are required to discuss. I'll try to explain the overall concept of all the standards, whatever content which is mainly repeatedly tested in the examination, all these things we'll try to cover. So first standard, first series we will take is SA 500 series we will take. So what does SA 500 series? In SA 500 series, entirely it talks about audit evidence. And in the 500 series, we have many things to cover. SA 500 anyhow we have covered. Audit evidence chapter. Audit evidence chapter is completely from SA 500. Apart from SA 500, we have under 500 series, 501 we have, 505 we have, 510 we have, 520, 530. These are actually two dedicated chapters. Then we have 550, 560, 570 we have, 580 we have. So these are all the standards which we have in 500 series. 520, 530, as I have told, this we will discuss later as a part of dedicated chapter. 530 talking about audit sampling, 520 talking about analytical procedures. Remaining all we have to discuss. So first we will pick up SA 501. So what does SA 501 talk about? So if we look at the title of the standard, SA 500, what does that say? What does the title of the standard say? Audit evidence specific, 1 minute. Specific considerations for selected items, no? Yes. All right. So here we have. So we will take the chart also simultaneously. Both we will keep it aside. Yeah. So we have SA 501, which is talking about audit evidence and special considerations for specific items. So basically, SA 501 is also the standard which is talking about audit evidence only. But you all will say, sir, we have already covered one standard regarding audit evidence, which is SA 500. Then what is SA 501 for? SA 500 is a general standard which is talking about overall audit evidence. What is the meaning of audit evidence? What are different audit procedures? What are different methods? What is sufficiency? What is appropriateness? What factors will affect? That is a very general standard talking about overall audit evidence. SA 501 is a standard which is talking about how to obtain audit evidence, that too not for all items, only for three specific items. Only for three specific items, how you are required to obtain audit evidence. That's what SA 501 is talking about. So how we need to obtain audit evidence regarding three specific items? What are the three specific items which they have asked? Number one is attendance, existence and condition of inventory. How you have to obtain audit evidence regarding existence and condition of inventory. How you need to obtain audit evidence regarding completeness of litigations and claims. And how you need to obtain audit evidence regarding presentation of segment information. So out of that, first thing we will pick up. How do you obtain audit evidence regarding existence and condition of inventory? So here they are talking about two aspects. You need to obtain audit evidence regarding existence and also condition. Existence is something. See, for example, if you find any stock value in your balance sheet, how the stock value will be derived? You have to determine what is the quantity of the stock available, that you have to multiply with cost or NRV, whichever is lower, but you will get a resulting figure that will be the inventory value. So if this inventory value is correct or not, that depends on whatever quantity that you have used in the valuation, that should be correct, and whatever cost or NRV which you are using, that should be correct. If we got to know that quantity is correct and this cost or NRV is correct, then obviously value of the inventory also will be correct. So when I say you need to obtain audit evidence regarding existence, I'm talking about quantity. You need to obtain audit evidence regarding the quantity, whatever quantity that has been used for the purpose of valuation, whether that quantity is really there with the company. And when I say you need to obtain evidence regarding condition, condition is something which will determine the NRV. NRV of the stock will depend on what? Condition. So as you all are aware, simple example if you have to take, simple vegetables example if you take, all the day they are brought to the market, they are superior condition, the NRV will be much higher, they will be able to sell it for more. One day passes, their condition will become deteriorated, the price will fall down. That price you are paying is nothing but NRV. Few more days passes, even NRV comes down even further. So when I am trying to obtain evidence regarding condition, I am trying to obtain evidence regarding that NRV. Cost is something you need not worry. Cost you can directly calculate from the books. So what is more crucial? NRV is more crucial. So if you obtain evidence regarding the existence and condition, obviously the value of the inventory will be correct. Now let me ask you, okay, let us keep the standard aside. You tell me if you want to obtain evidence regarding existence and condition of inventory. If you are in the position of an auditor, assume yourself as an auditor, what you will do to obtain that audit evidence. So what you have to do is, first you have to go and attend. Unless you go and see that, you will not be able to see, you will not be able to know whether inventory is there, what is the condition of the inventory. If you want to know that, you have to go and see it. So what the standards suggest is, management will do inventory verification. Like even in car also we are required to report whether management has done the physical verification at reasonable intervals or not. And what is a reasonable interval for inventory verification? Once in every year they will do. And generally most of the companies will try to plan it around the year end. So many companies will do it as on 31st of March. A few companies will do 5 or 10 days before or after. So many of the companies will plan their physical verification near the end of the financial year. So every company will do physical verification of their stock. Now what the standard suggests is, as an auditor, you try to attend that management inventory counting process. So whenever management is doing physical verification, they will inform you as an auditor, you should try to attend that inventory counting process. Sir, what I should do by attending there? Just time pass, whatever we do regularly. So what you should do by attending that inventory counting is, you have to evaluate the management process. So what processes management is following for doing that inventory counting. Then you observe. First you get the understanding of their plans. Then you sit and observe. According to the plans only they are doing the counting, or they are doing counting in a different manner. Then inspect the inventory. So randomly walk here and there, just have a look on the inventory in what condition it is. And if you are even feeling more bored, perform test counts. Randomly you go to some items and do the counting on your own. Inventory counting will be interesting in some cases. So in some cases, in some clients, what they do know, they will have a very big warehouses and all, and inventory will pile up like very high. high ceilings will be there. If you want to really go into the stock, they will have some kind of this elevator kind of things and all. They will take you up, they will get you see there. So you can do a lot of time pass there actually, but you have to be very careful, right? So when you go for inventory verification to those places, when you go for inventory verification, no, you go in complete formals and all. For in the morning you get ready, go to the formals and attend the inventory verification. By the evening when you come out, no, you will also get mixed with that labor only. They will not be able to recognize that you are a chartered accountant or or an auditor. So whatever it is, as an auditor, if you want to obtain evidence regarding existence and condition of the inventory, management will do the inventory counting. You should attend. By attending there, you should do four things. What are they? Evaluate the management's process, observe the management counting, inspect the inventory, perform test accounts. One thing which I got worried a lot by looking at one question in the examination, either in RTPs, MTPs, I don't know. They have asked one question in the MCQs. What is the question? As an auditor, you go and attend the inventory counting process. By attending the inventory counting process, you should do four things. Identify which four things you should do. Four options I have given. In each option, you are able to find the four things. In every option, all the four things are there. But how the options are structured is option A, evaluate, inspect, test count, observe. Second option, observe, evaluate, perform test count, inspect. Order. In what order? So you have to choose the correct order. So evaluate, observe, inspect, perform test counts. I told the answer here. Okay. So this is the order. Evaluate. Evaluate, observe, inspect, and perform test count. So that order, correct order, you have to find it out and you have to write the answer. So I felt very bad looking at that question. For a moment, I felt like I should quit the teaching and all. I can't see all these horrible things happening. I felt it is really worst question here if you ask me. Yeah, why I should do that in that order only? Huh? So first I will evaluate management plans. Okay, then I will sit and observe. I will perform test count, then inspect the inventory. What mistake I have done by doing that? Nothing, no. So, but still, they expected an answer. They're not just expecting you to remember the points, but in one case, they have even expected you to remember order also. How mean, no? Right. So, whatever it is, fine. So, let us keep all our worries aside. Let us come back to the concept. If we keep on cribbing, there are many things to crib. One after the one, so many things will come. So let us proceed. So first you will attend and do these four things. And one more thing they say here. In case if the inventory verification is happening on the balance sheet date, well and good. Whatever stock which is there on that date, if you are satisfied with that quantity and condition, no issues, you will be happy. Sometimes inventory verification will happen on other than balance sheet date. Say for example, management is doing the physical verification on 10th of April. On 10th of April, they are doing physical verification. You attended there. On 10th of April, whatever condition is there, whatever quantity is there, that is matching. But with that, your responsibility will not come to an end. Why? Because the stock which is there on 10th of April will not come in my balance sheet. The stock which is there on 31st of March will come in my balance sheet. So now you have to do the calculation, reverse calculation you have to do. So if stock on 10th of April is matching, intervening transactions from the date of the balance sheet till the date of that counting, whatever intervening transactions are there, that you need to recalculate. That means you need to add whatever sales which have taken place from 1st of April to 10th of April. You need to reduce whatever purchases which have been done from 1st of April to 10th of April. Then balance stock you have to see, that is a stock as on balance sheet date. Now whatever these additions or deletions which have taken place between these dates, whether they are genuine or not, that also we need to obtain audit evidence. Clear? So whatever it is, management will do physical verification. They will invite you, they will call you, you please go and attend that inventory verification. Next. Sometimes what will happen is management will do physical verification. They have even invited you, but you are unable to go and attend that inventory counting. You are unable to go and attend that inventory counting. Then what you should do? Then you alone should go and do then you on your own, if you are unable to go on the date of inventory verification done by the management, then on some alternative date, you plan the inventory verification with your team. But when you go there, no need to do 100% verification. On a sampling basis, you do the counting. That's what you should do. Then in case you are unable to attend the inventory counting process by the management, later you thought of attending, but it has become highly impracticable for you to attend that inventory verification process. You did not go when the management invited. You thought, okay, I will go after some time on my own with my team and will do the test count. But that has become highly impracticable now. You are unable to do it. So, sir, what do you mean by impracticability? Can the auditor say the warehouse where the stock is kept is 50 kilometers away? I have to spend 1 day to go and verify that stock. That is a reason for impracticability. I will not do. Can he say that? When we say impracticability, that should have been caused by circumstances beyond the control of the auditor. Difficulty of time, difficulty of cost, they are not considered the reasons for impracticability. Able to understand? So you need to compulsorily go and attend the inventory verification on your own if it is, unless impracticable. If it is impracticable, then what I should do, sir? Sir, impracticable examples of impracticability will be like natural calamities, social riots, it could be there, or some dangerous places. Your stock is very dangerous. You can't go and physically verify. Say, for example, your client is dealing in some chemical products. So those chemical products, they are having some hazardous products. They said that some 200 kgs of some material is there. You can't go in surroundings, in proximity. You can't go to that chemical. Even if you go to the proximity, also you have some hazardous effects. So there you can't verify. So that is the reason for impracticability. Sir, I did not attend management's inventory counting process. I thought of going it on my own, but that has become highly impracticable. Then what I should do? Then the standard says try to perform alternative audit procedures. Think, apply your mind. What else you can do apart from doing physical verification? Can you do anything else to obtain audit evidence? Sir, what I can do, that is up to your choice. Sir, someone has come and told, sir, I will do a video call and see. If you feel that that will give you audit evidence, do it. Sir, I am unable to attend, but I have a known person, I have a local person there who can go on my behalf. Natural calamity is there on the way. I can't go, but I know a person at that location where a warehouse is there. I will send that person. Do it. So whatever it is, try to do alternative audit procedures to obtain audit evidence. Sir, alternative audit procedures are also not possible. Might be you thought of alternative audit procedures, but they are not giving evidence. Or you did not come across any alternative audit procedures only. Then what you should do? Modify the opinion. Then you don't have any option. You have to modify. Which kind of modification you will give? Which kind of modification? Not disclaimer. I told you, no. You told whenever there is no evidence, you will directly jump to disclaimer, but it is not the case. Here it could be either a qualified or disclaimer. If the possible effect of that inventory is only material but not qualified, if the possible effect is material and also, then what is? Then disclaimer we are supposed to do. Understood? Clear and comfortable? Right. Next. In addition to that, they say one more thing. When you go, now if you come to the material, when you go and attend the inventory counting process, there are some matters which you have to pay attention. What are the matters which are relevant in planning attendance at physical inventory counting? So what matters you have to pay attention? You have to pay attention to what is the nature of inventory. Is it work in progress? Is it finished goods? Or is it raw material? You have to pay, if it is work in progress, what is the stage of completion? 30%, 50%, 60%. What is the stage of completion? So that you have to pay attention. Risk of material misstatement. Keeping in mind the inventory, what is the risk of material misstatement here? And also nature of internal control. The place where they are keeping the inventory, what kind of internal controls they have, whether there are adequate procedures and proper instructions. The staff who are involved in the inventory counting, to them proper instructions have been given or not. The timing, at what time you are doing that physical verification. Whether the entity maintains perpetual inventory system, how they are maintaining the records. Generally they should maintain perpetual inventory records, not periodic. And the location where the inventory is held, because of that location, is the inventory facing any challenges? Is the inventory facing any risk? And also whether the assistance of an auditor's expert is needed. Sometimes to obtain evidence regarding inventory, you might need the assistance of an expert, especially when the quantity is in the form of liquids. Like oil refining company, or doing the audit, they store the oil in very big containers. The container will be equal to the length of a building and all. They say in this container we have 2000 liters of oil. You have to measure whether really 2000 liters of oil is there or not. What do you do? Take a bucket, tie a thread, tie a rope, and start extracting. Can you do that? No. So you have to take an expert of engineers. They're depending on the dimensions and all, they will give you some kind of estimation. So like this, whether you are required to take any help of the expert, that also you have to pay attention. So these things you will try to obtain, these things you will do to try to obtain audit evidence. Sometimes what will happen is your client is owning a stock, but that stock is not with your client. That stock is held in possession, is in the custody of a third party. Someone else is holding that stock. Now what auditor should do? In case if the inventory is getting held by some third party, so for that also you need to obtain audit evidence. So how you will obtain audit evidence? You will try to obtain external confirmation. Generally external confirmations will be reliable. See, when this circumstance will arise is in the case of job work, in the case of goods sent on consignment, in the case of goods sent on sale or approval basis. So in those cases this thing arises. So in those cases, for that also we need to obtain audit evidence. But first thing what we do, external confirmation we do. Generally external confirmations are reliable, but in some cases external confirmations are not reliable. When the third party from where the stock is kept, they are not independent, then you need to perform alternative audit procedures. What alternative audit procedures you can do? If possible, you go and attend there. If the time permits, you go and travel. If you know somebody else, go and ask them to go on your behalf. So like that, whatever you feel appropriate, in addition to external confirmation, that extra procedures also you are required to perform. Clear? So this is what SA 501 says regarding obtaining of audit evidence relating to existence and condition of inventory. Second item regarding which you need to obtain audit evidence. Second item regarding which SA 501 is giving guidance. What is that? Completeness of litigations and claims. Whether management has completely whatever litigations and claims the company is going through, the client is going through, without ignoring, without leaving anything, everything should have been presented in the financial statements. See, every litigation and claim, if because of a litigation and claim, if we know that we are going to compulsorily lose the case, that will be shown as a provision. That amount will be shown as a provision. If outcome is uncertain, then it has to be shown as a contingent liability. But somewhere litigation and claim should be completely presented. So as an auditor, you should obtain audit evidence whether the company has disclosed all the litigations and claims either in the balance sheet or in the notes to accounts, and whether have they hidden anything from you, that you need to obtain audit evidence. Sir, how I need to, what steps I need to do in order to obtain the audit evidence? First, the standard says don't directly go for finding out the misstatement. First you try to find out, is there a risk of material misstatement? Is there a risk of material misstatement regarding litigations and claims? What do you mean by having a risk of material misstatement regarding litigations and claims? Is there any chance that the management could have hidden some litigations and claims? Find the risk. Sir, how will I find the risk? They say 3 steps you have to perform to find whether there is any risk of material misstatement regarding. Listen carefully, guys. Listen. Don't put your heads down. Listen carefully. So you need to first identify risk of material misstatement. They are not asking you to directly identify misstatement. First, they are asking you to identify risk of material misstatement. How can I do that? By performing 3 steps. First, they are asking you to do 3. What exactly you need to do? They are saying here. So 3 things they are asking you to perform first. What is that? Inquiring with the management and in-house legal counsel, internal legal department and the management. Go and inquire with them. Sir, did you completely disclose all the litigations and claims? Go and talk with the legal team also. Then read the minutes of those charged with governance. Top level management might have conducted the meetings. Go through the minutes. Third one, review legal expenses. What are the legal expenses in the current year? What are the legal expenses in the past year? Do the comparison. If there is any significant increase, there should have been new cases, whether that has been disclosed or not. Clear? So 3 things you are required to do. What are the first 3 things you are required to do? Number 1, inquire with management and in-house legal counsel. Number 2, read the minutes of those charged with governance. Number 3, review the legal expenses. These 3 why we are doing? To identify risk of material misstatement in the area of litigations and claims. Now, by following these 3 steps, 2 outcomes could be possible. What 2 outcomes could be possible? There is a risk of material misstatement or there is no risk of material misstatement. If you are satisfied after following the 3 steps, you are satisfied that there is no risk of material misstatement. I did not find any risk there. I did not find any chance management hiding. I felt genuine. Management has disclosed all the litigations and claims. You aren't supposed to do anything. Your activity will get completed there itself. Done. If you don't find risk of material misstatement, your responsibility is over. But in case if you find the risk of material misstatement, you perform at these 3 steps. But if you found the risk of material misstatement, yes, there is a chance somewhere some suspicion is there that management might have hidden some litigations and claims. Then you need to perform further audit procedures. So what further audit procedures you have to perform? Like even if you see in the chart here, I have specifically mentioned only if there is a risk of material misstatement. No risk of material misstatement, nothing. Your process will end here only. If risk of material misstatement, perform extra. What you have to perform? Number one, auditor shall communicate with entities external legal counsel. You have to go and communicate with the entity's external lawyer. For the purpose of fighting the case, they might have recruited the lawyer. Go and consult with the entity's external legal counsel. But if you go and ask something to the entity's external legal counsel, they will not respond to you. Why? Because you are not the person who are paying them the fees. So if you need information, when entity's external legal counsel will give the information? Only when you have some kind of approval from the management. Or management will better know if you ask the information in what manner you will get the reply. Yes or no? So I am helpless here. I have to go and take the help of management. So what I should do? How I will take the help of management is, see, generally I will try to communicate with the entity's external legal counsel through a written letter. But I don't know how, if I ask to whom to address, I will get the information. So for this, I have to take the help of management. So I will ask the management. I will tell them the content. I will ask the management to draft that letter of inquiry. So auditor will try to communicate with the entity's external legal counsel through a letter of inquiry prepared by the management, sent by the auditor, and asking the entity's external legal counsel to reply back to the auditor directly. Three things. The auditor will communicate with entity's external legal counsel through letter of inquiry prepared by, sent by, and asking the entity's external legal counsel to reply back to. Perfect. Now, after you have sent the letter of inquiry, two things can happen. One, what is the first one? Entity's external legal counsel has communicated. He gave the reply. Now we will analyze the reply. On the basis of that, we will form the conclusion. So this audit will proceed normally. So when there will be an obstacle, that means you are not getting reply from the entity's external legal counsel. Not getting reply from entity's external legal counsel might happen because of multiple reasons. Number one, first, management itself did not cooperate with you to send a letter of inquiry. Number two, management helped you through a letter of inquiry, but the external legal party, he is prohibited from the law or regulation. Like we have confidentiality, even lawyers also will have confidentiality. So that external legal counsel is prohibited from responding, or external legal counsel intentionally he is not providing, even though there is no prohibition, he is not responding. Any of these three cases, either management did not help you out to draft the letter of inquiry, management helped you out, but the external legal counsel is prohibited from responding, or he is not responding out of his own. In any of these cases, you will not be able to get a reply. Now what you should do? Now the standard says perform alternative audit procedures. What you should perform? Alternative audit procedures you have to perform. Now once again, it is up to your choice. What alternative audit procedures you will perform, that you decide and do it, but try to perform alternative audit procedures to get the audit evidence. Now, if alternative audit procedures are also not possible, then what you should do? Then you have to give a modified opinion. Which kind of modified opinion? Qualified opinion you are required to give. Qualified or disclaimer of opinion you are required to give. In addition to that, even you are required to obtain written representations from the management that they have completely disclosed the litigations and claims. They did not hide anything. Ask the written representations also. And in some cases, you might feel that just communicating through letter of inquiry alone will not be enough. Sometimes you will feel the need to go and meet with the entity's external legal counsel directly. The standard says you have to go and meet with the entity's external legal counsel. You have to communicate with the entity's external legal counsel through letter of inquiry. But sometimes as an auditor, you might feel that communicating through letter of inquiry alone will not be enough. You might be required to go and meet with him personally when that need arises. So here they have given, if you find that risk is a significant risk, the legal matter is very big legal matter, it is a very significant risk, then not just communicating with letter of inquiry, you can go and meet him personally. And also, matter is complex. Matter is very difficult to understand. That legal issue is very difficult to understand. Through letter of inquiry, you are not getting clarity. Then also you can go and meet with the entity's external legal counsel. Or if there is a disagreement between management and entity's external legal counsel, that means management told something, we sent a letter of inquiry, he gave a reply, whatever entity's external legal counsel is saying, whatever management is saying, there is a difference, there is a conflict. Then also you can go and personally meet with him and clarify the issue. So these are the three circumstances where the auditor might feel a need or urge to go and meet that entity's external legal counsel: when the risk is a significant risk, when the matter is very complex, when there is a disagreement between management and entity's external legal counsel, then you can directly go and meet that entity's external legal counsel. Generally, the entity sectional legal counsel will not meet you directly. For that also, he will ask you to get the permission of the management, or he will ask you to bring some representative of the management. So then you have to go to that fellows and ask them, hey, come useless fellow, he's not meeting you. He's not meeting me along without you. Please come, we will go and meet him. You have to take him and you have to go and meet him. Clear? And one more small thing is also there here. This is not covered in this chart. A small thing. General letter of inquiry, something will be there. Yes. Yeah, here. So this one. Sometimes what will happen is you might not be able to communicate through a specific letter of inquiry. I told you are required to communicate with the entity sectional legal counsel through a letter of inquiry. But sometimes what will happen is, like if you read this phrase, it is considered unlikely that entity's external legal counsel will respond appropriately to a letter of general inquiry. So basically, first you will send, sir, what and all cases your client is going through. I'm an auditor of this company. Give me a list of all the cases which your client is going through. Now, external legal counsel will say, get lost. See, he will not respond to the general letter of inquiry. Anybody will have a doubt? No. See, for example, if someone is asking, tell me what and all your client is doing. You are doing audit of some company. Tell what are the various sources of revenue your client is having. Will you just like that reply? No. Even external legal counsel also will be very unlikely to respond to a general inquiry. So in that case, what you should do is you should make a specific inquiry. If you ask him broader things, he will not respond. He will have a doubt why this person need all this information. But instead of that, what you should do is you should ask him a specific inquiry. If you send specific inquiry, the chances of reply are very higher. So for this purpose, a letter of specific inquiry includes the list of litigations and claims. Basically, not the entire list regarding is there any specific doubt you have regarding certain litigation. So that list of litigations you can include. Where available, management's assessment of outcome of each of the identified litigation. You will also mention in that letter of inquiry, sir, these litigations the company is going through. When I ask the management is saying this. They are telling that there are more chances for winning. That's why they did not show it as a provision. They are showing it as a contingent liability. Management is saying this. Then a request that entity sectional legal counsel confirm the reasonableness of the management assessment, and you request the entity's legal counsel, sir, management is saying this, whether is it acceptable or not, or do you have any contrary view. So if you draft the inquiry letter specifically like this, the chances of getting the reply are very higher than the general inquiry. So if you have decided to send the specific inquiry, these are the things which are required to be included in the specific inquiry. What are they? List of litigations and claims. Number 2, management's assessment. Number 3, requesting the entity's external legal counsel to comment on reasonableness of management's assessment. Understood? So 2 aspects we have covered. Now we are left with last aspect. What is that? Segment information. So whether the management has presented the segment information properly or not, here I have nothing much to explain. Basically, we have an accounting standard talking about the segment information. So whether that requirements of the segment information standard has been complied with or not, we need to check. So as per that AS 17, we have a primary segments and all. We have how to identify the primary segments and all. They will give you criteria. Whether that criteria has been followed or not, we will check. And whatever calculations they have done, is it as per the standards or not, we will check. And if time permit, if suitable, we will also try to perform analytical procedures on the segment information. Like for example, if the business is having, if the client is having multiple businesses in the current year, like Reliance only you take. Last year from petroleum from petroleum segment, they have generated 70% of the revenue. In the current year, they have generated only 60% of the revenue. So I will do the comparison. Why there is a fall? Is it a genuine reason or is it any misrepresentation? So like this, I will try to dig deeper and get the information. Understood? So this is what you are supposed to do regarding segment information. Understood everyone? Shall we proceed further? So that's all. SA 501 has been completed. Now we will talk about SA 505. We will try to discuss, which is relating to external confirmation. So what does this external confirmation talk about? So first we need to be clear about a few definitions. So what is an external confirmation? If you remember, external confirmation is one of the method for obtaining audit evidence. We have discussed 7 methods. In that, one of the method is what? External confirmation. So what is the meaning of external confirmation? So external confirmation means it is a direct written response And one important thing you have to keep in mind, if you are getting oral response, that will not be considered as external confirmation. In order to be considered as external confirmation, that response should be a compulsorily a written response. Whether you will get that written response in paper form or electronic form, that is up to your choice. But that should be compulsorily in written format. If you get an email, yes, external confirmation. If you get a WhatsApp message, yes, external confirmation. If you get confirmation over call, not an external confirmation, because it must be in a written format. So auditor getting a written response either in paper or electronic form from whom? From a third party. Which third party? Other than auditor and the client. Other than auditor and the client, from a third party like debtor, creditor and all, from banker, etc. From the third party, whatever direct written response which auditor is getting, that we call it as, and third party we also call it as confirming party, and that written response we call it as external confirmation. And now these confirmations you can get it in two ways. As an auditor, if you want reply, basically in external confirmation, we will ask the information from the other party. We'll ask the confirmation from the other party. That letter which you are sending, that we call it as confirmation request. You want written response, no? For getting that written response, you have to first ask the information, either by way of email or letter. That request which you are sending for response, that we call it as confirmation request. And that confirmation request can be of two types. What is that? Positive confirmation request, negative confirmation request. What is a positive confirmation request? In your confirmation request, if you are expecting a third party to respond whether he agrees or disagrees. If he is agreeing also, you are expecting a reply. If he is disagreeing also, you are expecting a reply. Then we call it as positive confirmation request. Then what is negative confirmation request? You are expecting the other party to respond only when he disagrees. You have to determine whether a request is a positive confirmation request or a negative confirmation request depending on the wording used in the confirmation request, not on the basis of you are getting reply or not. So you have to decide whether a confirmation request is a positive or negative depending on expectation of the auditor, what he is expecting. If he is expecting the third party to respond, either he agrees or disagrees, then it is a positive. If he is expecting a reply only when the third party disagrees, then it is a negative confirmation request. Understood? Then, say for example, one auditor is sending the confirmation request like this. He is saying in the confirmation request, sir, I am the auditor of so and so company. I came to know that you are a debtor of my client. Please tell me the amount you are due to my client company. Positive or negative? Understood the question what I am asking? See, I am not asking him for a confirmation. What I am asking, sir, I am an auditor. I am an auditor of your client, of my client. My client says you are a debtor. Please tell me what is the amount you owe to the company. Positive or negative? Positive. Why? Because here also I will get response. I am expecting response in all the cases. I am not asking him yes or no. I am asking him to directly provide information. So there also I am expecting response in all the cases, no? So that will also fall under positive confirmation request. Next. One more term which we need to understand is exception. Exception means what? Exception means mismatch basically. Say for example, I send a confirmation request asking my debtor, sir, I'm an auditor of so and so company. My client says that you are a debtor. You owe them 1 CR. You owe them 1 CR. Your outstanding balance in their books is 1 CR. But the debtor replied me back, no sir, I am not required to pay 1 crore. I am required to pay only 80 lakh rupees. So information, whatever is there in the confirmation request and whatever response you got from the third party, both are not matching. There is a difference. That case we call it as exception. So here I have an exception. So whenever you come across exception, will you automatically conclude that it is a misstatement? Does an exception always mean a misstatement? No, exception doesn't always mean a misstatement. Exception can also be because of third party's mistake also. When a difference you have got, you don't automatically come to the conclusion that your client has only done a mistake. Sometimes exception might arise even because third party has made a mistake in his books of accounts. So exception doesn't always mean a misstatement. When you come across exception, you have to put that extra effort to determine is that exception a misstatement or not a misstatement. Then one more definition, you need to understand what is the meaning of non-response. What do you mean by non-response? So non-response means one simple thing. You sent a confirmation request, but you did not get the response. This is what generally we issue. But they define this in a detailed manner. Number one, you sent a confirmation request, but it got returned undelivered. You sent a confirmation request, either positive or negative. You sent a confirmation request, but you got it was not delivered, you got it back. Like you sent a post, you got it back. You sent a email, you got a message that the message was not delivered. This we call it as non-response. Or you sent a positive confirmation request. What? Positive confirmation request, and you did not get the reply. Then also we call it as a non-response. If I send a negative confirmation request and if I did not get reply, that also will I consider it as non-response? That you can't consider as non-response. Why? Because in the case of negative confirmation request, that will be considered, the other party is required to reply only when he disagrees. If you don't get the reply, that means he has agreed, that you can't consider it as non-response. So non-response covers two cases. Number one, confirmation request got returned undelivered, either positive or negative. Number two, you sent a positive confirmation request, but you did not get a reply from the third party. Understood? Clear about all the 5 definitions? Then now let us come to what are the various steps which are involved. If you want to get a proper response from the external confirmation, what and all are the steps which you are required to follow? It involves 4 steps. Number 1, you have to determine the information regarding which information you want to send the confirmation request. Number 2, you have to select appropriate confirming party. Number 3, you have to design the confirmation request. Number 4, you have to send it and do the follow-up also. Let us talk about the first one. What is the first one? Determining the information regarding which you want the confirmation. See, mainly we use external confirmation for confirmation of balances. There is no doubt about it. What is the debtor's balance? What is the creditor's balance? What is the bank balance? So we mainly use that confirmation request for quantitative balances. But do you think the use of external confirmation is restricted only to quantitative things? We can also use it for qualitative aspects, like whether the customer has really given a discount or not. If the property is pledged with the bank, really the property is pledged with the bank or not. Do the bank has ownership documents or not? These kind of things also you can get a confirmation by way of external confirmation. So you can use it for both qualitative as well as quantitative aspects. So whatever it is, first you will determine regarding which information you want to send the confirmation request. Number 2, you have to select appropriate confirming party. So you have to choose to appropriate person you have to send. Why? Because if you send the confirmation request to inappropriate party, you can't expect a reply. Even if you expect a reply, even if you got a reply also, that is not reliable. Only when the confirmation request has been sent to appropriate recipient and you got a reply from that appropriate confirming party, then only reliability will be there. Next, third step. Okay, you decided who is the confirming party, got his communication details, and you have sent that. You have identified the party. Now, what is the third step? Design. Now you have to take a decision. Should I go for positive? Should I go for negative? And what various factors you will consider, like risk of material misstatement you will consider. If the risk is high, positive confirmation request. If the risk is low, negative confirmation request. You should also decide on presentation. So you have to send it on paper form or you have to send it on electronic form. That also you have to decide. Even in taking that decision, you can use your past experience also. You can use your previous experience. Whether if you send it by post, you will get a reply, or if you send it by email, you will get a reply. You use your past experience as well. It also depends on the assertion, that respective item of the financial statement. On that also you will decide. And even you have to decide on method of communication. So, and also management authorization. Sometimes what some third parties will do is, if I am an auditor, I send a confirmation request to the debtor. Debtor will see the mail, he will reply back saying why I should believe you are an auditor, why I should reply. That he is having so much of time. If he doesn't feel me as a genuine, he should have ignored. But what that person will do, he will even reply back. Why I should trust you are a genuine person, why I should trust you are an auditor. Let us do one thing, you get the approval of the management that you are really an auditor, then only I will reply back. Now you don't have any option. What you should do? You have to include the management approval, then send the confirmation request. And also you need to decide whether you want item wise details or you want total information. Say for example, from some debtor, you want balance confirmation. Instead of asking, you know that debtor is a genuine person, good person, you have already past experience with him. Whatever information you ask, he will share. From that people, you can ask invoice wise details also. He will give a confirmation. Now some people will be frustrated people. If you ask balances only, they will not reply. Very rarely reply. For those people, if you ask invoice wise details, they will even look your mail, delete your email. They will not reply. So you need to decide whether you want invoice wise details or you want total balances confirmation. Keep all these factors in mind, then design your confirmation request. Okay, after designing, what you will do? Keep it safely in the locker. What you should do, you have to send it, and you have to do the follow-up also. In which kind of confirmation request you do the follow-up? In the positive confirmation request, we do the follow-up. For negative, we don't do the follow-up. Why? Because if we don't get the response, we generally imagine that the third party has agreed with the information. Next. Now, between positive versus negative, which one is more reliable? Positive is more reliable. Negative confirmation request does not. Negative confirmation request does not give that much persuasive evidence. Persuasive. What is the meaning of persuasive? Convincing. Pervasive is different. Persuasive is different. See, positive confirmation request, you get more convincing evidence, whereas negative confirmation request will give you less convincing evidence. Does that mean should you not use a negative confirmation request at all? No, you can use it. You can use a negative confirmation request only when certain things are present. And in fact, they use the phrase, don't you you can use negative confirmation request as a sole substantive audit procedures only in few cases. Only in few cases you can use negative confirmation as a sole substantive audit procedure. Always using only negative confirmation request is not correct. You can rely only on negative confirmation request only in few circumstances. What are the circumstances? Risk is very high. Sorry, risk is very low. The items are very small, minimal balances, and also homogeneous, small and homogeneous populations, they say. And few more things. Low exception rate. In that area, you don't expect any kind of differences. Generally, they will be matching only. So then also, like for example, if you take bank balances and all, there is a very less chance for exception because mostly they will match. And also, recipient doesn't disregard the request. So what do you mean by this is, you know the recipient very well. As an auditor, you know the recipient very well, that if I send a message, he will definitely respond. If something is wrong, he will definitely respond. He's not a person who will ignore the messages and mail. You know that third party very well. If you know that third party very well, then also you can send a negative confirmation request. If you trust him so well that he will definitely look at the mail, and if he finds something is in problem, definitely he will reply. That much confidence if you have on the third party, then also you can send a negative confirmation request. And also wherever controls are effective. So you can use negative confirmation request as a sole substantive audit procedure only when these things are present. In other cases, you can't rely only on negative confirmation request. Either you have to go for positive confirmation request, or you should use negative confirmation request in combination with other methods. Sir, I want to send a confirmation request, but management is not allowing me to send a confirmation request. Who are the management here to stop us? How they can the question is, why they will stop us? Why do we need their permission first of all? See, stopping in the sense, how they will stop is, as a part of this external confirmation process, we rely on management. Whether you agree or not, we have to rely on the management. At which step we become rely on the management is in the second step. You have to select the appropriate confirming party. Your client has done a business with them with very big company. Now you want to send a confirmation from that big company, from that customer, but you can't send the email to their official email address because they will not respond. So you need to find out, for example, if your client has done sales to them, that means it is a purchase for the third party. You need to know who is that concerned purchase head of that third party and what is his email address. You have to get it. That without the help of management, you can't get it. So yes, more or less, whether you agree or not, in order to send the confirmation request, we need the help of the management. But sometimes management will refuse. So you go to the management and say, sir, I want to send confirmation request to your creditor. I need his details. I need his email account. Then the management is saying, no, we will not share with you the details. Or they will request, sir, please don't send the confirmation request. Then what you should do? First, you should understand the reasons why they are stopping you from sending that external confirmation. Why they are stopping you? Get the reasons. If there is a valid justification, what you do is try to perform alternative audit procedures. If you are unable to perform alternative audit procedures, you will give a modified opinion. However, if there is no reasonable justification, management is not giving any reasonable justification. They told, sir, don't send external confirmation. I asked them reasons. They are not at all giving me any reasons, or they gave me some reasons which are not at all acceptable. then what they're asking you to do is reassess your risk of material misstatement. You might have done the risk of material misstatement assessment at the beginning of the audit. Reassess the risk of material misstatement. Why? Because now you got to know about the true nature of the management. Earlier they are saying yes to everything. Okay, sir, do whatever you want. But now they have come to you and showed that true color. No. Now they are telling when you want to communicate with the third party, they are coming and telling you no, don't communicate, and they're not telling me any valid reason. Now you got to know extra information regarding the management. Earlier you might have thought risk as low, but now you got to know about the management's nature. Now you should reassess your risk of material misstatement. You should consider the risk as very high. Increase your audit procedures. So reassess your risk of material misstatement, especially risk of fraud, and communicate this matter with those charged with governance, and even if required, modify the opinion. And whatever evidence you are getting it from external confirmation, you are required to evaluate it. What you are required to do? You are required to evaluate whatever evidence you have got it from obtaining external confirmation. So that one last paragraph will be there. So like as you could see, whatever evidence you are getting, that you need to evaluate. So the auditor should evaluate whether the results of the external confirmation procedures provide relevant and reliable audit evidence. Whatever responses you have got from the third parties, are they reliable or not? You need to check it. And when evaluating the results of individual external confirmation requests, the auditor may categorize such results as follows. Whatever responses you have got, you need to categorize them. How you have to categorize? A response by the appropriate confirming party indicating agreement with the information provided in the confirmation request. That means no exception. Everything is matching. See, basically you sent 100 confirmation requests. You got the responses. Now you need to segregate, no? For which, how many confirmation requests are there where the third party has agreed? Then a response deemed unreliable. You got a response, but the third party is not independent. You have a suspicion. Even though he gave a response, even though he told everything is correct, but it is not reliable. That you keep it aside. Then a non-response. You sent a confirmation request but did not get any reply. That you keep it aside. And a response indicating an exception. Nothing but differences are there. So you get all the external responses, collect all the external responses and segregate them, categorize them. On what basis? Into 4 categories. Into 4 categories you have to aggregate, you have to separate them. What are the 4 categories? Those which are matching. Those where there are no discrepancies, everything is matching. Those responses which are considered non-reliable. No responses or exceptions are there. So into 4 categories you have to segregate. Then the auditor's evaluation, when taken into account with other audit procedures, it will assist the auditor in concluding whether sufficient and appropriate audit evidence. Now after categorizing into all these 4, analyze them further and finally arrive at a conclusion whether this external confirmation has given you sufficient and appropriate audit evidence. If you feel that no, external confirmation has not given me sufficient and appropriate audit evidence, perform additional procedures. Clear? Other methods also you take the help of. Understood? So this is how you need to evaluate the responses to written representation, external confirmations. Understood? Clear? Shall we proceed further? Next. So now what we will do is 580 we will do. Very much related to 505. So I say 505 is external confirmation. 580 is written representation. That we will try to do now. Right. So what is written representation? What is the meaning of the written representation? It is also basically a confirmation, a written statement which is obtained by the auditor. External confirmation, we are getting a written response from a third party, but written representation, we are getting it from a management. So written representation is a statement, is a written statement received by the auditor from the management regarding what? Regarding confirmation of certain matters. You need confirmation regarding certain matter from the management. You want the management to confirm certain things. So you ask them to confirm them in a written manner through a written statement, and also to support other audit evidences. You have got some evidences, but you want some supporting information. So to support other audit evidences also, you can ask a confirmation from management. So written representations are written statements obtained by the auditor from the management, either to confirm certain matters or to support other audit evidences. Now, can you use written representation as an audit evidence? Yes. Written representation is an important audit evidence like inquiry, but the problem is written representation does not provide evidence on its own. Written representation does not provide evidence on its own. What do you mean by that? You can't rely only on written representation. Written representation is just a supporting evidence. You can't rely only on written representation. but you have to use that phrase, terminology. So written representation does not provide evidence on its own. The other way of saying that is written representation do not provide evidence, you can't only use written representation as audit evidence. That is also same meaning. That is also same meaning. But you should not write it. What you should write in the examination? Written representation does not provide the evidence on its own. Understood? Next. Sir, what are the objectives of the auditor? As per SA 580, from whom, regarding which matters you need to obtain written representation. So, SA 580 says, regarding 2 matters it is compulsory. Not 2 actually, regarding 3 matters it is compulsory. Number 1, every auditor should ask the management to give a written representation whether management has fulfilled their responsibility for preparation of financial statements. Every auditor should ask the management to give a written confirmation that whether they have fulfilled the responsibility for preparation of financial statements. And also every auditor should ask the management to give a written representation regarding completeness of information provided to the auditor. Basically, you should ask the management, sir, did you completely provide the information to me regarding anything? Did you completely provide the information to me? Management will say yes. They will nod their heads. Stop them to nod the heads. Ask them to write it on the piece of paper and give it to me. So 2 matters: compulsory written representation. Number 1, whether management has fulfilled their responsibility for the preparation of financial statements. Number 2, whether management has completely provided the information to the auditor. Third thing where it is mandatory is if there is any requirement of other standard. In other standard, if they are asking you to get the written representation regarding that matter also you need to obtain. Just now we have seen SA 501. There we have seen the second aspect, completeness of litigations and claims. There they have asked you to obtain written representation regarding completeness of litigations and claims. It is mandatory for you to obtain written representation in that matter. Similarly, in SA 570, they will ask you to obtain written representation regarding going concern. It is mandatory for you to obtain written representation regarding the going concern. So 3 cases mandatory. What are the 3 cases mandatory? Management fulfill the responsibility for preparation of financial statements. Number 2, completeness of information provided to the auditor. Number 3, wherever there is a requirement of relevant standard, rest of the matter is auditor's choice. Rest of the matter, if auditor feels it necessary, he will obtain the written representation. Next, what should be the date and period covered by written representation? The date of written representation should be on or before the date of audit evidence. It can never be later than the date, sorry, on or before the auditor's report. I told audit evidence, no, sorry. So the date of written representation should be on or before the date of auditor's report, but in any case it should not be later. Why? Why? Because written representation is also a kind of audit evidence, and the sequence is first audit evidence, then auditor's report. If you take the audit report first and then dated the audit evidence, once again you are showing that you are a fool, which we should not look like, even though we are in some cases. Right. So this is what regarding date and period covered by written representation. Then, sir, from whom you will request written representation? Management. But management is a very broader term. Many people will get included there. All the team of board of directors will get included in the management. But we can't go and ask written representation from everybody, no. We generally go and ask written representation from that part of the management who are having the responsibilities relating to financial statements. Like if there is a CEO, we can go and ask the written representation from CEO. Or if there is a CFO, we can go and ask the written representation from CFO. If there is an audit committee, we can go and ask the written representation from audit committee. So we should go to that part of the management who are directly or indirectly associated with financial statements. Sometimes what will happen is we will ask a written representation regarding certain matter. Like say for example, SA 501, I need written representation regarding litigations and claims. I went to the management, I went to the CFO and told, sir, I need written representation regarding litigations and claims. CFO told, no sir, I am not the person looking into legal matters. We have an internal legal team. They are looking into the legal matters. Saying that, can he escape? Can he say, no, I don't have information, I will not give written representation? Can he say that? No. Then what should be done? So he should go to the concerned person in the organization, get the information from that concerned person, then provide the written representation to auditor. No person can escape saying, I don't have information, I am not getting associated there, I will not give written representation. He can't say it. So he has to go to the concerned person, get the required information, then provide written representation to auditor. Clear? Able to understand? Next. Like this also they have asked. In one exam they have asked, So auditor needs to, auditor will ask representation from the management. Sometimes management will not have requested information. They will go to the concerned persons in the organization, get the required information and give the written representation to the auditor. Who are that concerned persons with whom management will go and inquire? Examples. Who could be that persons in the organization with whom management will go and consult? Like they have given examples like actuary. You are asking a written representation regarding provision, but management did not create it. Actuary has created it. Then what management should do? Go to the actuary, get the information, and then provide written representation to auditor. Similarly, legal expert, like as I've told, litigations and claims, and also staff engineer. When I'm asking something relating to the plant and machinery or some assets, then also what they can do, they can go to the concerned staff engineer, get the information, and then provide written representation to auditor. Next, when to obtain written representation from management to reconfirm its responsibilities. See, generally what I will do is at the beginning of the audit, at the beginning of the audit only from the management, I will take written representation regarding two important things. No, what are they? That the management will fulfill their responsibilities regarding preparation of financial statements and completeness of information provided to auditor. At the beginning, I will get that written representation. But sometime during the course of the audit, I need to get once again written representation from the management to reconfirm their responsibilities. I got written representation at the beginning. They have confirmed their responsibilities. But in some cases, during the course of the audit, I need to get a confirmation once again that they are reconfirming their responsibilities. When? Number one, those who signed the engagement letter have changed. Initially, when you have accepted the audit, there were separate people who have signed the engagement letter. Now different people are there. Might be management has undergone some changes. Or terms of engagement are prepared in the previous year. Basically, last year you have got the written representation. When in the current year, see, some matters you need not obtain written representation year after year. You can use the last year's written representation also. But in case if the terms of the engagement have changed, then what we will do in the current year, we will get once again written representation. Or management misunderstands its responsibilities. Initially, when I asked for confirmation, management gave written representation, but they were confused. They did not understand it properly, and they gave the confirmation. I got to know about it. Let us sort out the misunderstanding by getting once again a written representation, and also if there are any changes in the circumstances. So these are the cases where the auditor will try to get written representation once again from the management to reconfirm their responsibilities. Next one. Sometimes you will get the written representation. You will ask the written representation. Management has given you that written representation also, but you have a doubt that those written representations are not reliable. When you will generally have a doubt that written representations are not reliable, when you have a doubt regarding their integrity, when you came to know that they are not honest people, or when you came to know that they are not having competence, they don't know what is exactly happening in the organization, but still they have given written representation, or you came to know that they don't have ethical requirements, they don't follow ethics and all, they're all fraudulent people, then generally you should get a doubt that whatever written representations you have got, they are not reliable. And also, you should get a doubt that written representations are not reliable when they are inconsistent with other evidences. I told written representation is just a supporting evidence. So you would try to generally match that evidences with written representation. Sometimes they might be mismatch. I got evidence something else, management is confirming something else. Then what I should do? Then what I should do is I should try to resolve it. Where is wrong? Is my evidence wrong, or management is only giving written representation? If I decided that, okay, my evidence is only wrong, I will perform extra procedures and get the correct evidence. If I came to know that written representation itself is wrong, management has given written representation itself as wrong, is that a small issue or big issue? Very big issue. Management knowingly they have provided you wrong information. Now they say that in those cases, you should take extreme action. You can even go and give a disclaimer of opinion. What you can give? Disclaimer. Why disclaimer? If the management has given the written representation itself wrong, what is the guarantee? Whatever information they have provided you, whatever financial statements they have given to you, to what extent they are genuine? Do you have any clarity? No. So that's why it is completely a deadlock situation. So what they have told us, in those cases, you can even go to an extreme and give a disclaimer of opinion. Next. Sometimes management will not give written representations only. I'm asking for written representation, sir. I want some matters for you to confirm. Please confirm. But the management is not at all giving written representation. Previous paragraph, I asked it for written representation. They have given it, but those are not reliable. But now what? I asked for written representation. They are not at all giving that written representations only. Then what I should do? First, I should go and discuss. Be a gentleman once again. Go and discuss with the management. Sir, why are you not giving me written representation? Then if they give it, well and good, fine. If they are not giving, even after discussion also, they are not giving that written representation, then what we should do is re-evaluate the integrity of the management. Once again, now you got to know about the true nature of the management. Earlier, when you initially did the risk assessment, you thought that management are honest, but now you have realized that the management are not honest. Here also you need to consider modifying the opinion. Here also what you can do is go to an extreme and give a disclaimer of opinion. Why? Because management themselves are honest. To what extent I can rely whatever information they have provided to me till now. Understood? Comfortable everyone? So this is what regarding SA 580. So we have completed SA 580 also. Now we will do one more thing. SA 510 we will try to cover. After that we'll go for a break. Right. So let us try to do SA 510, which is talking about initial audit engagement and opening balances. Before we go deeper, what does the standard say? First, let us become familiar with what is the meaning of initial audit engagement, what is the meaning of opening balances. The initial audit engagement I have already told. Initial audit engagement I have already told. If the previous year auditor and current year auditor are different, if the current year auditor is different from previous year's auditor, then the current year engagement will become initial audit engagement. This in simple terms. But how they have defined this term initial audit engagement in SA 510 is the engagement in which either prior years were unaudited, last year is not at all audited, or prior years were audited but by a predecessor auditor, someone else, not your firm. Someone else has conducted the audit of the previous year. Then also in the current year it will become initial audit engagement. So either prior years were unaudited, or the current year auditor is different, or the prior year is audited by predecessor auditor. Then what is the meaning of opening balances? You all know it, no? What is the meaning of opening balances? Those balances which are there at the beginning of the year. Those are nothing but last year's closing balances. And when I say balances, once again here you will look at only balance sheet. But when I say opening balances, it even includes the disclosures also. Might be in the last year's balance sheet, in the last year's notes to account, they have told there is a contingent liability. Even that will also become an opening balance. So when I say opening balance, don't restrict yourself to balance sheet. Even in notes to accounts also, whatever things are there, they might also fall under opening balances. Then what is the auditor's responsibility? And one more thing before that, we say opening balances reflect two things. Opening balances reflect two things. What information is reflected in the opening balances? Number one, opening balances reflect the effect of all the transactions whatever have taken place in the preceding financial year. And also opening balances reflect accounting policies which are followed in the previous financial year. So opening balances reflect two kinds of information. So what will they reflect? Number one, they reflect the effect of all the transactions which have taken place in the previous year. They also reflect accounting policies which have been followed in the previous financial year. And when I say accounting policies, one fundamental accounting assumption should come to your mind: consistency. So by checking opening balances, you will get to know what accounting policies are followed in the previous year. Now you need to check whether the same accounting policies are applied in the current year. If they have changed, is there a proper disclosure there or not? So the same thing they will try to say there in the objectives also. What this standard is expecting from the auditor is they are expecting from you two things. Number one, obtain sufficient and appropriate audit evidence whether opening balances contain a material misstatement that could affect the current period financial statements. Definitely, when the opening balances contain a misstatement, that is obviously going to come and affect my closing balances also. So that's why you need to obtain sufficient and appropriate audit evidence whether opening balances contain a misstatement that could affect my current period's financial statements. You need to obtain evidence regarding that. Sir, how I can obtain audit evidence? By performing audit procedure. Second objective, we will come to that later. First, let us complete the discussion regarding first objective. So you need to obtain audit evidence whether opening balances contain a misstatement that affect my current period financial statements. But in order to obtain sufficient and appropriate audit evidence, I know that I need to perform audit procedures. Sir, what audit procedures I have to perform to obtain audit evidence? That also they have told it in the question. That also they have told it in the standard itself. So what audit procedures they have told us? Read the most recent financial statements. Whatever most recent financial statements are there, that you have to read and determine whether prior period closing balances were correctly brought forward. Nothing but last year closing balances are matching with current year's opening balances or not. You have to check. Any adjustment relating to prior periods have been shown as prior period items. In the current year, if you find any error which belongs to a previous year, that you have to show it as a prior period item in the current year. So that you need to check. And also whether opening balances reflect application of appropriate accounting policies. Whatever accounting policies that are reflected in the opening balances, are they appropriate? Basically, whether correct accounting policies they have followed or not. And even you need to perform specific audit procedures like comparing the opening trial balance with the last year's audited financial statements. In addition to that, in the standard you will be able to find something else. They specifically talk about what audit procedures you need to perform regarding current assets and liabilities, what audit procedures you need to perform regarding non-current assets and liabilities. That also they try to add it here. Just go through it once. Okay, so they don't go that deeper. Just if we understand this broader audit procedures, that will be enough. So this the later thing you can go, or once again if you want me to quickly take you through it, I will take you through it. So when it comes to current assets and liabilities, what you should do? So in the case of inventories, if you just the current period's audit procedures on the closing inventory balances provide little audit evidence regarding inventory on hand at the beginning. See, in the current year you will do closing balances verification, closing inventory verification you will do. That will provide very little evidence regarding opening balances. So when you are doing physical verification for closing balance, you get evidence regarding current year. From that you will not get any evidence regarding opening balances. Therefore, additional audit procedures may be necessary. That's why in order to obtain evidence regarding opening balance of inventory, you need to perform additional procedures in addition to current year's inventory. So what I need to perform? Number one, observe a current physical inventory counting and reconciling it with inventory quantities. Nothing but if you are satisfied with the current year's closing stock, if you could do reverse calculation, same like we have done in the SA 501, if you are satisfied, if you are satisfied with current year's closing stock, you have to do reverse calculation and find out opening balance. That opening balance should match with my last year's closing balances. That you can do. Or you can perform audit procedures on the valuation of the opening inventory item. Nothing but ask the management to share the last year's valuation sheet. Try to perform audit procedures whether they have done the valuation properly or not. And also performing audit procedures on gross profit and cutoff, basically analytical procedures. These are nothing but analytical procedures you need to perform. Gross profit margins and all you have to compare. So this is what specifically you need to do regarding current assets and liabilities. And for non-current assets and liabilities, what you should do is like property, plant and equipment, investments, long-term debt. So you can obtain audit evidence by verifying accounting records and other information. Like for example, if PPE is there, management is saying this PPE is there in the as a part of opening balance also. What you can do is you can ask the management to share the copy of the ownership deed. In the ownership deed, I will see when is the date of the purchase. So that will give me evidence whether this is only belonging to current year or this belongs to previous year also. Next, in certain cases, the auditor may be able to obtain some evidence regarding opening balances through confirmation with third parties. Even external confirmations also you can use. So whatever it is, you perform audit procedures. These are general audit procedures, and we have seen specific audit procedures for current assets and liabilities, specific audit procedures for non-current assets and liabilities. So perform all these audit procedures and obtain audit evidence that opening balances do not contain any material misstatement. Okay, now after performing that audit procedures, what will happen? You came to know that opening balances do not contain any kind of material misstatement. What you will do? Unmodified opinion you will give. On the other hand, if you obtain sufficient and appropriate audit evidence that opening balances contain a material misstatement, you performed all the audit procedures, whatever we have told you till now, and you concluded that opening balances contain a material misstatement, then what you will do? Then you have to modify. Which modification? Either a qualified or adverse. If it is only material but not pervasive, qualified. If it is material and also pervasive, adverse. What will be the other case? You already know. You are unable to obtain sufficient and appropriate audit evidence to determine whether opening balances contain a material misstatement or not. Then what you should do? Either you should give a qualified opinion or disclaim, depending on whether a possible effect is being material or material and pervasive. Understood? Next. So one objective only we are done. Till now what we have done? One objective. But I told there are two objectives. What is the second objective? As I have told, opening balances are reflecting accounting policies. But regarding accounting policy, we have a fundamental accounting principle, which is consistency. So they say you need to obtain sufficient and appropriate audit evidence whether accounting policies which are reflected in the opening balances, they have been consistently applied in the current year, or if at all they have changed, that change has been properly disclosed or not. If there is a valid reason, you can change the accounting policy, but you have to give a proper disclosure. What change you have made, because of what is the effect, sometimes retrospective effect, sometimes prospective effect. All this you have learned in the accounting standards. That proper disclosure is required to be given. So I need to obtain sufficient and appropriate audit evidence. Without very valid reason, they should not change accounting policy. Point number one. If there is a valid reason, they can change it, but it should be appropriately disclosed. Now, how it will have an impact on opinion. Number one, so there could be two cases. Listen carefully. Management, if you have obtained sufficient and appropriate audit evidence, management, without any valid reason, they have changed the accounting policy. That means consistency has been violated. The management has changed the accounting policy without any valid reason. Or there is a valid reason. That's why management changed the accounting policy, but they did not give proper disclosure. Two cases. You have an audit evidence where without any valid reason, management changed the accounting policy. Or you have evidence that management has changed the accounting policy. There is a valid reason, but they did not appropriately disclose it. In both these cases, what you are supposed to do? Modified opinion you have to give. Which kind of modification? I told you have a evidence. What you will do? Either a qualified opinion or adverse opinion you are required to give. Here the standard did not say what if there is no audit evidence. For opening balances, they have told two cases. You have evidence, you don't have evidence. But for accounting policies, they talked about only one scenario. What is that? If you have evidence, then you give either qualified or adverse. They did not say about no evidence. See, in accounting policies, you cannot say I don't have evidence. You are an expert. No. What are you? Expert. Expert in what? Accounts and audit. You can't go and say I'm unable to decide whether the accounting policy is consistently applied or not. I'm unable to decide whether the disclosure has been given or not. Can you say that? If you say that, will that be a shame on you or not? If the ICA keeps it in the material, if it is more shame or not. So that's why they did not give that scenario. So when it comes to accounting policies, only one scenario. You will have evidence. You must have the evidence. Then only you deserve to be a chartered accountant. So you will have evidence. You must have evidence whether accounting policies are consistently applied, or if there is any valid reason for change, whether it has been appropriately disclosed or not. So then you will give qualified or adverse. Then one more last paragraph. Sir, I am doing the audit for the current year. Last year auditor has given a modified opinion. Is there a mandatory obligation on the current year auditor to also give the modified opinion? If such mandatory obligation is there, once the company gets a modified opinion, never back in its life, they will get again a unmodified opinion. So it is not the case. Just because last year's auditor's report contains a modified opinion, the current year auditor need not always give a modified opinion. He will give modified opinion in the current year only when that matter still remains relevant and material for the current year, and it is not rectified in the current year. Then only he will express what? Modified opinion. If because of whatever reason last year auditor gave modified opinion, that is no longer relevant for the current year, that is no longer material for the current year, if it has been rectified in the current year, then there is no need for giving modified opinion. You can give unmodified opinion. Understood? That's all. This is what regarding SA 510. How many standards we have covered? 4 we have covered. 501, 505, 580, 510 we have. How many more we have under 500 series? 550 we have, 560 we have, 570 we have. That one, 580 we have covered. 3 we have, 520, 530 we will have a separate discussion. Okay, with that 500 series will get over. Then we have 200 series, 260, 265, that we will try to cover. After that we have 450, evaluation of misstatements, that is getting asked very frequently in the recent, because it was a newly added content. So then we will do 260, 265. After that 450 also we will do evaluation of identified misstatements we will do. Then after that SQC1, SA 220, SQC1 and SA 220 also we will do. Then apart from that SA 620 we will do quickly. SA 620 using the work of internal auditors we will do. Sorry. 610 using the work of internal auditor we will do quickly. 720 I will not explain. 720 why I will not do is that standard is not at all fit for revision, but still on my YouTube channel you will be able to find a detailed video with the charts. I have chart and the detailed explanation of that. Sorry. Yesterday I worked on 620 and 720 for CFN, so that thing is only coming on my mind. So comparative information and all that standard is there. So for that I have a chart. Detailed explanation has also been there. A video we will be able to find in the YouTube that you can watch. Perfect clarity you will get. I know SA710 is troubling for many, but just to watch that video, your perspective will change regarding SA710. Such an easy standard it is. So just go and watch that video. After that, I will wind up standards. We'll wind up the standards and we'll see after that what we will do. Okay. We will do. Now, if I start asking your opinions, everybody will say one chapter, so it becomes quite difficult. We will see, depending on the availability of the time and all. We will try to cover. I think I can easily cover audit in an automated environment, audit sampling, analytical procedures. These 3 chapters, just like that, I can complete it. After that, also, if the time is left, we will see. Okay. Strategy planning and program also we will do. There also questions are getting tested. We will do definitely strategy planning and program also we will do. Till now we have completed 4 500 series of the standards. What are they? What and all we have done? 500 we are done, 501 we are done, 505, 510, 580. Yeah. So these 4 standards we have completed. Let us now try to proceed further and understand few more 500 series of the standards. Volume reduce. Okay. They're doing it. Okay, so first what we will do, we'll take one simple standard, say 550. We will try to understand, which is increase. Fine enough. Okay, so now we will try to understand SA 550, which is going to talk about related parties. So as we all are aware, wherever we have a related party transaction, there the risk of happening of material misstatement is very, very high. And also, if you remember, when we discussed the inherent limitation concept, there we have seen one of the main reason for inherent limitation is related party transaction. So that's why wherever related party transactions are there, since there is a huge scope for manipulation, that's why accounting standards also have a lot of disclosure requirements. So many disclosure requirements are there regarding related party transactions, even as per accounting standards. Similarly, from auditing perspective also, since related party transactions have a high chances of misstatement, they have given us a dedicated standard. It exclusively gives us a guidance what audit procedures you need to perform, what evidence you are required to obtain regarding related party transactions. But before that, we need to understand what is the definition of related party. Now, here the standard has played it very safe. They have told that in the applicable financial reporting framework, if the related party has already been defined, follow that definition. Like for example, if you take companies, in case of companies, applicable financial reporting framework is Schedule 3 and accounting standards. In case in that applicable financial reporting framework, if the related party term is already defined, follow the same definition. Whatever definition they have given under applicable financial reporting framework, whoever they told will fall under related party definition. So just follow the same definition. In case applicable financial reporting framework does not define the term related party, then follow the definition whatever we are giving in the standard. If applicable financial reporting framework defines, follow the definition. In case if the applicable financial reporting framework doesn't define the term related party, then in SA 550 they have given the definition. That definition you are supposed to follow. Sir, as per the definition of SA 550, when 2 parties will be considered as related? So they say that 2 entities will be considered as related if they have control or significant influence over entity. If a person is having control over another entity or influence over another entity, so that then both will become related parties. Or another entity over which reporting entity has significant control or influence. You are controlling someone or someone is controlling you. You are having significant influence on someone or someone is having a significant influence on you, related parties. And they say one more thing also, another entity that is under common control with the reporting entity, either through common ownership, owners who are close family members, or common key management. Basically, you and some other entity, your client entity and some other entity, both are under common ownership. A third party is controlling both. So then these 2 entities which are under common control, they will also become related, and that common control can be by way of common ownership, or the owners can be close family members, and even they could be a common key management. So someone is having, if someone is having influence over your client, related party. Your client is having influence or control on other, related party. Your client and some other entity both are under common control of some third party. Then that entity which is with common ownership under you, common control under you, so that also will become a related party. Clear? Next. And here there is one exception. They have given an exception regarding government entities, state related entities. So they say that entities which are under common control by a state, even though they are under common control, they will not be considered related unless they engage in significant transactions or share resources. So I told that which are under common control. If two entities are under common control, they will be considered as related. One exception to that rule. If two entities are under common control of a state, state in the sense government they are talking here. If two entities are under common control of a state, they will not be considered related unless they share resources or unless they engage in significant transactions. So this is how the term related party has been defined. Then talking about the nature of the related party transactions. See, related party transactions, if they are happening like a normal transaction, under whatever terms and conditions, normal transactions happen. Under the same terms and conditions, if the related party transactions are also happening, be it price, be it payment terms, be it delivery terms, whatever it is. So if the related party transaction is also happening at par with a normal transaction, then there will be no high risk of material misstatement. Then they will be having low risk only. When they are equal, in all terms. So if the related party transactions are in the normal course of business, then there might be no higher risk of material misstatement. But however, in some cases, the risk is very, very high. In some cases, related party transactions carry a very high amount of risk. In what kind of circumstances? Number one, if they operate through extensive and complex relationship. There is existing on related party through with which you don't have any direct relationship, but the relationship is very complex. So what do you mean by indirect relationship or complex relationship? Is, say for example, there is one company. It has created one subsidiary. That subsidiary created an associate. That associate is having some joint venture. In that joint venture, one director is there. That director has incorporated another company. So a very distant change is there. Very complex relationship is there. In these kind of cases, it becomes difficult for you to identify whether that entity is a related party itself or not. So whenever the related parties are operating through extensive or complex relationships, it becomes very difficult that the risk of material misstatement is very, very high. On the other hand, if the relationship with the related party is straightforward, like direct subsidiary company, direct associate company, direct joint venture, then it is low risk. But if it is a complex or extensive relationship, then there is high risk. Similarly, information system may be ineffective. Whatever information system, basically today, so many related party transactions will be there. And if you open the financial statements of any company, related party transactions, so many pages of disclosures will be there. 2-3 pages will be dedicated only for explaining related party relationships and related party transactions. Today, the human beings are not accumulating all the related party transactions. The accounting software itself will identify the related party. That accounting software itself will accumulate related party transactions. That software will itself give a report. So now what we need to check is whatever that software they are using, whatever accounting software they are using, is it effective or not? Why? Because if the accounting software is effective, if the accounting software has been designed properly, yes, related party disclosures will be given appropriately. On the other hand, if the client is using some useless information system, if it is not able to identify or accumulate all the related party transactions, and if the company starts relying on such a software, the system will give wrong reports. That reports only they will include in the financial statements. In those cases, financial statements are having a chance of misstatement or not. Yes, that the risk is very high. Similarly, when the related party transactions are not conducted under normal market terms and conditions, like pricing is different, you are showing some favorism to your related parties, there the risk of material misstatement becomes very high. So summary of this paragraph is, generally if the related party transactions are happening under normal market terms and conditions, in the normal course of business, they might not carry higher risk, but in some cases there will be a very high risk of material misstatement with regard to related party transactions. 3 cases they have given where there will be high risk of material misstatement. What are they? When they operate through extensive and complex relationships, information systems may be ineffective, and they are not operating under normal market terms and conditions. Next. So what will be the responsibilities of an auditor? As an auditor, if you came to know that your client is having related party relationships or related party transactions, as an auditor, what responsibilities you are required to fulfill? Number one, first you have to obtain audit evidence regarding accounting and disclosure requirements. Basically, as I have told, even if you take Schedule 3, even if you take accounting standards, there are so many disclosure requirements they have mentioned. So, as an auditor, my objective is to obtain sufficient and appropriate audit evidence, whatever accounting and disclosure requirements are given under accounting standards, under applicable financial reporting framework, whether all that accounting and disclosure requirements are fulfilled or not. So what I have to do as an auditor, what is my responsibility? Whatever accounting and disclosure requirements are there given under applicable financial reporting framework, whether the related party transactions are accounted as per that, whether all the disclosures are given as per the applicable financial reporting framework. Now, as we all are aware, if we want to obtain evidence, what we should do? You should perform audit procedures. So to obtain that audit evidence, what audit procedures I have to perform, that they are mentioning in the standard itself. So as an auditor, you should perform audit procedures like you have to obtain an understanding of accounting and disclosure requirements. Common sense, no? Before you can see whether accounting and disclosure requirements are met or not, first you should know what are the accounting and disclosure requirements. So first you should go through the applicable financial reporting framework, and first you understand what are accounting requirements, what are disclosure requirements. Then to obtain understanding of related party relationships and transactions, now go and sit with the management, ask them, give me a list of all the related parties, give me a list of all the transactions you have done with the related parties. Then to conclude whether financial statements give a true and fair view and are not misleading, especially because of related party transactions. So you need to perform audit procedures. Which audit procedures you have to perform? First, obtain an understanding of accounting and disclosure requirements. Number 2, obtain an understanding of related party relationships and transactions. Number 3, finally obtain an understanding whether financial statements are giving true and fair view and they are not misleading, especially because of related party transactions. Next, see, because of related party, the chances of happening of fraud are also very high. And once again, if you apply the practicality here, many frauds, whatever have taken place in the recent times, in every fraud, you will be able to find the related parties. They commit this fraud through shell companies. They incorporate this subsidiaries, associates, like shell companies, we call them. Just for namesake, they incorporate the companies, and they incorporate these companies in the tax havens, in the Mauritius or in that British Islands, like that. So we have so many these kind of things are there. Tax havens are there. There they will incorporate some related parties, and through the related parties, many of the scam funds will go out of India. So related party transactions can lead to high chances of happening of fraud. So that's why you need to pay close attention to the related party transactions to identify whether there is any fraud getting committed. Misstatement, that too because of fraud. The chances are very high. So you need to pay close attention. Then, as we have already seen, because of related party transactions, there is a chance of inherent limitation. One of the main inherent limitation is arising because of related party transactions. So in case of related parties, the significance of inherent limitations are very much higher. Because of related party transactions, the chances of auditor's opinion going wrong are much high. So that's why what you should do is management may be, why? Because management may become unaware of existence of related party transactions. Sometimes management itself will not know who is a related party, who is not a related party. And also related party transactions provide a greater opportunity for collusion and manipulation. So that's why the inherent limitations are very greater for related party transactions. Then you have to maintain professional skepticism. If you want to overcome all these problems, all these headaches, one thing what you can do is you have to maintain professional skepticism. You have to maintain that attitude of questioning mind. To some extent, you can reduce your risk. So when we talk about auditors' responsibilities, they have told 4 things. Number 1, you need to obtain audit evidence regarding accounting and disclosure requirements. To do that, first you should obtain understanding of accounting and disclosure requirements. You should obtain understanding of related party relationships and transactions, and also you should make sure that financial statements give a true and fair view and are not misleading. Number 2, you should pay close attention for identification of any fraud, because fraud risk factors will be there. Number 3, because of related party transactions, the inherent limitations are very higher. Because sometimes management themselves are not aware who is a related party, and also related party transactions provide greater opportunity for collusion. And then finally, last one, you have to maintain professional skepticism. If you have to overcome these problems, you have to maintain professional skepticism. And also we have one more last thing, how auditor can verify existence of related parties. If you want to know whether your client is having related parties or not, what you should do? First, you should go and ask the management. You will go and ask the management, sir, please tell us who and all are your related parties. We will do inquiry. But in case of inquiries, I have already told you, inquiry will give least evidence. If you go and ask to the management, sir, I want you to give me a list of all the related parties, they will give. But you should not blindly believe on that. You should also verify some documents from your side to know whether related parties are there or not, or management has hidden some related parties from you. You will definitely go and ask. Management will give a list, but you don't blindly rely on it. You also try to verify some documents from your side to identify the related parties. So what documents I have to verify, sir, to know whether there is any existence of related parties? Number one, you can go through income tax returns. There also they will report related party transactions, and also information provided to regulatory authorities. Like in case of MCA, company filings and all, you are required to file the details of related parties. You can go through that filings also. Shareholders register. If you go to shareholders register, you will come to know who is your holding company, who is your associate entity, that you will get to know. Then statement of conflict. Basically, statement of conflict is a thing under Companies Act where they say if you are a part of the management and if your company is going to take decision in which in the transaction you are having interest. Like for example, there is a person, Mr. A. Now this person A is a director in the company ABC Limited. This ABC Limited wants to purchase goods from a firm XYZ and Co. A firm is there. From that firm, they want to purchase the goods. But in that firm, one of the partner is Mr. A once again. So this company is doing a transaction with another entity, but in this transaction, one of the director is having a interest. So when they are doing that decision making, they should stay away from that decision making. Here in this transaction, Mr. A should stay away. Why? Because he is having a interest there, and he should submit something called conflict of interest to the management. In listed companies and all, it will happen. So they have to submit a statement of conflict. They will say, boss, the company or the entity with which you are doing the transaction, in that I am having a interest. So like that, they will submit a statement of conflict. Now, one simple logic, if I can go through that statement of conflict, I can easily understand who is a related party, who is not a related party. And also I can go through investment register. If you go through investment register, once again, you will get to know subsidiary companies, associate companies, joint ventures, that you will get to know. Contract and agreements with the management. So nothing but with the key management, what and all contracts you have entered, go through that contracts and agreements. And contracts which are not in the ordinary course of business. If you find any contract which is beyond the normal course of business, try to dig deeper. Why? Because outside the normal course of business, the companies do transactions only with the related parties in 99% of the cases. And then even you can go through internal auditors report. So definitely will inquire for related parties, but don't just stop with inquiry. You verify the documents, you verify these documents from your side, so that you might find the existence of a related party. Understood? That's all. We have completed SA 550. Related party discussion, we are done. So now what we will try to do is we will pick the next most important standard, 570. We will pick now. What? Go. Oh, title you are telling, right? Okay. So we will try to cover now SA 570, talking about going concern. One of the most important standard from the examination perspective. Conceptually also, it is very, very important. So let us try to understand SA 570, which is talking about going concern. Is going concern an important matter? Is going concern is important in the preparation of financial statements? And even if you are aware, they say going concern is a fundamental accounting assumption. What is it? Fundamental accounting assumption. What do you mean by going concern? First of all, the entity will continue for the foreseeable future. Foreseeable future means how long? 1 year. For the coming 1 year, entity will continue. Neither it is having a intention to liquidate, nor there is any pressure on them to liquidate. So just having an intention alone will not be enough. If the management says, if yes, we have an intention to continue in the coming 1 year, will going concern be valid? No, situations also should permit them. Their financial position should permit them. Sure, their operations should permit them. So there is no intention, and also there is no requirement for the entity to close down in the foreseeable future. That assumption, we call it as going concern assumption. Now, so what role going concern assumption plays? How it is going to have an impact on the financial statements? How it is going to have an impact on the financial statements is, see, when I prepare the balance sheet, when the management prepares the balance sheet, as on the date of the balance sheet, they have to make one decision whether going concern is valid or not. They have to make an assessment and determine it. If they feel that going concern assumption is appropriate, that means entity will continue for the foreseeable future. Then they will prepare the financial statements on that basis. On going concern basis, they will prepare financial statements. So what do you mean by preparation of financial statements on going concern basis? So basically what they will try to do is fixed assets, they will value at the historical cost. So current assets, they will evaluate at the realizable values and all. So historical cost we follow for fixed assets, mainly fixed assets. That is where the impact is going to come. So mainly fixed assets will be valued at historical cost. That means whatever you have acquired it at a long ago, so at that price we will have, we will value it. Why? Because fixed assets we are not holding with the intention of selling. So we are holding it for the purpose of using it for our business. So that is what the meaning of going concern basis. So when we are preparing the financial statements on going concern basis, we continue to value our fixed assets at historical cost because we don't have any intention of selling them. In case if the going concern assumption is invalid, what do you mean by going concern becoming invalid? The entity will not continue for the foreseeable future. Either the management wants to liquidate or the situations doesn't permit the entity to continue for the foreseeable future. Then the company can no longer value their fixed assets at historical cost. Because if entity will not continue for the foreseeable future, even fixed assets are held with the intention of selling. So in that case, we prepare financial statements on something called liquidation basis, we say. What do we say? Liquidation basis. That means all the assets, all the liabilities, we will determine if the company sells them as on the balance sheet date, how much they will be able to realize. That value they will determine. All the assets, all the liabilities will be shown at realizable value. And the difference between that book value and the realizable value, that we will go and give the impact to the statement of P&L. So you tell me, going concern is having a significant impact on the financial statements? Very bigger impact on the financial statements it is going to have. And in case if the management tries to tamper with the going concern assumption, the management tries to do wrong things regarding going concern assumption, will it be a misstatement in the financial statements? Yes. Will it be a material misstatement? Will it be a pervasive misstatement? 100% yes. Why? Because going concern is something which is fundamental to users' understanding of the financial statements. Okay, so till now we understood the importance of going concern assumption from the accounting perspective. Now, as we all are aware, standards on audit doesn't talk about financial statements. Standards on audit talk about auditing requirements. So now, as an auditor, what is your responsibility? As an auditor, what is your responsibility? First of all, who will make an assessment regarding going concern? So whether we will continue for the coming 1 year or we will not continue for the coming 1 year, whether going concern assumption is valid or invalid, who will do that assessment? It is always and always the responsibility of the management to do the assessment. On what basis they will do the assessment? Will they toss a coin? Heads comes going concern valid, tails comes going concern invalid. No. So they will consider some factors. So what factors they will consider? They will consider the factors like size and complexity of the entity. What is the size of the entity? What is the complexity of the business they are doing? And also they focus on nature and condition of the business. What is the current nature of the business? What is the current condition of the business? They will pay attention. Uncertainty of events and conditions. Like for example, any legal cases going on them, any significant changes in the laws and regulations are going to come. So they will even pay attention to events, uncertain events like pending cases, laws and regulations. And even they will consider the effect of external factors. Once again, this laws and regulations kind of thing. So they will pay attention to various factors. These all factors they will consider, and then they will make an assessment whether going concern assumption is valid for them or going concern assumption is invalid for them. Now, what is auditor's responsibility? Till now we have seen management responsibility. What is auditor's responsibility? To obtain sufficient and appropriate audit evidence whether whatever management has done the assessment regarding going concern, is it valid or not? Is it appropriate or not? Whatever assessment management has done regarding going concern, whether that assessment of going concern done by the management is appropriate or not, that we need to obtain sufficient and appropriate audit evidence. Like if the management says, yes, our going concern assumption is valid, we will continue for the foreseeable future. They are preparing the financial statements on going concern basis. They are continuing to value the fixed assets on historical cost. Now I need to obtain audit evidence. Is it so? Really the entity will continue for the foreseeable future, or there is any requirement on the company to close down in the coming 1 year? That appropriateness, regarding that appropriateness, I need to obtain sufficient and appropriate audit evidence. So obtaining audit evidence is my responsibility. So I will come back to this remaining two responsibilities later. I will come back to this two responsibilities later. So now, okay, so your objective is to obtain what? Sufficient and appropriate audit evidence. Now, to obtain that sufficient and appropriate audit evidence, you need to perform audit procedures. So what audit procedures and all you will perform, we will talk about it later. But after performing all the audit procedures, what audit procedures we will do? We will discuss it. But after performing all the audit procedures, he will be left with some observations. He will have his findings. Now let us try to understand what impact that findings will have on his opinion. What impact that findings will have on his opinion. So I will do some different this chart only. This is a since it is getting very clumsy, I have divided the chart into multiple parts. But if I draw one single chart covering all, so after he has done all the audit procedures, there might be multiple cases. Let us try to understand each case. Number one, you performed audit procedures, you obtained assumptions, you obtained audit evidences, and you have concluded that the management going concern assumption, whatever management has decided, that is appropriate. Or let me put it this way, going concern assumption is valid. Entity will continue for the foreseeable future. There is no doubt, there is no intention also, there is no requirement also to close down the business. Entity will definitely continue for coming 1 year. You have perfect evidence. Very good. Management has also prepared the financial statements on going concern basis. Now what you will do? Management has also prepared the financial statements on going concern basis. What you will do? You will give unmodified opinion. So basically we will give what? Unmodified opinion we will give. No issue to modify the opinion. Next. Let us come to the other case. What could be the other cases? You might decide that going concern is invalid. You came to know going concern is invalid. That means entity will not continue for the foreseeable future. Then what we should do? So then we should decide whether there is a adequate disclosure in the financial statements. In case if you came to know that going concern is invalid, we need to check, is there a adequate disclosure? So what do you mean by adequate disclosure? What do you mean by adequate disclosure? So adequate disclosure in the sense that the company has realized that fact that going concern assumption is invalid and have prepared the financial statements on liquidation basis, and the differential component they have taken into the statement of P&L. So everything they have valued at realizable value, difference also they have taken to the statement of P&L. In the notes to account also clearly they have explained that they will not continue for the coming 1 year. What opinion I will give here? Unmodified opinion I have to give. Why? Because I will give modified opinion only when there is a material misstatement. But here people are genuine, no. So they did not hide anything. Yes, they also agreed. Yes, sir, we will not continue for the coming 1 year. They agreed to that fact. They have valued all their assets and liabilities at realizable value. Differential also they have taken to statement of P&L. Even in the notes to accounts also they have clearly explained that they will not continue for the foreseeable future. So no mistake they have done. So here there is no purpose in giving a modified opinion. What I can do here? Unmodified opinion I will give. What if there is no adequate disclosure? What if there is no adequate disclosure? What do you mean by not giving an adequate disclosure? Even though I got to know, even though I have a clear evidence that entity will not continue for the coming 1 year, but management is denying the fact and they continue to prepare the financial statements on going concern basis only. That means they are still continuing to value their fixed assets on historical cost basis only. Now what I should do? Now you have to modify. Which kind of modification? So you have to directly give a adverse opinion. Directly give adverse opinion you are supposed to give. Okay, why adverse? So as we have told at the beginning, if the management tries to tamper with the going concern assumption, definitely that will lead to a misstatement. That misstatement will not just be material, it will be pervasive also. And you have a evidence that going concern is invalid also. So you are supposed to give adverse opinion. Understood till here? Next. Let us come to one more case. So what is the one more cases? You performed audit procedures. You came to know that going concern looks valid only, but there is some material uncertainty relating to going concern. For the time being now, going concern looks valid, but there is some material uncertainty relating to going concern. There is some uncertainty, there is some doubt. That means whether entity will continue in the future or not, some doubt is there. For the time being now looks good, but it is depending on some events. If I put it in this way, it depending on some events whether entity will continue in the future or not. That is going to depend on some events that is even beyond the control of the auditor, beyond the control of the management. So if I have to give you one example, your client company is going through some pending case. Your client company is going through some pending case. The person, whoever has filed the case, he is demanding a very huge amount of money. As on the balance sheet date, the proceedings are still going on. If that case materializes, just in case if that case materializes, and if the person who has filed the case, he wins the case and company loses the case, the penalty amount or the consequences which the company has to face are so huge that the entity will not be able to continue. The entity will not be able to continue if the company loses the case. Able to understand? I'm not telling company will definitely close down. What I'm saying, company might get closed down if it loses the case, which is currently going on in the court. So here there is an uncertainty. Because of some circumstances, I'm unable to decide whether entity will continue in the future or not. I have a uncertainty. I performed audit procedures. I came to know there is a material uncertainty relating to going concern. That is depending on some events or conditions which are beyond the control of the management, beyond the control of the auditor and all. Now what you should do? Now what you should, if you found material uncertainty relating to going concern, what you are supposed to do? So here also, if you found material uncertainty relating to going concern, you need to check whether there is a adequate disclosure or is there no adequate disclosure. If there is a adequate disclosure, what you will do? Had the management made any mistake? Are the financial statements misleading? Are the financial statements giving true and fair view there? Yes, 100% yes. So what opinion you will give? Here also I will give unmodified opinion. But see, management without their fault, they have already disclosed or presented an information in the financial statements. But don't you think this is very fundamental to users' understanding of the financial statements? The management without their fault, they have appropriately disclosed and presented this information in the financial statements. Don't you think, even though they have disclosed and presented it, it is a matter which is very, very fundamental to users' understanding of the financial statements? So, don't you think the auditor is having a need to highlight this somewhere in the auditor's report? What he can do? Not keyword. Emphasis of matter paragraph. The matter which is already presented or disclosed in the financial statements, but it is very fundamental to users' understanding of the financial statements, that is required to be highlighted in emphasis. You could have done it if the standard has not told anything specifically. The standard has not told anything specifically. As you said, what we would have done is we would have highlighted that in the emphasis of matter paragraph. What the standard specifically says here is, you highlight it, but don't use emphasis of matter paragraph. You use a separate paragraph with a title, material uncertainty relating to going concern. You highlight it, we don't have any objection. You highlight it, but don't use the emphasis of matter paragraph. You use a separate paragraph with a heading, material uncertainty relating to going concern. With that heading, you use that paragraph, then highlight that matter. Understood? Clear and comfortable, everybody? Right. Next, what if there is no adequate disclosure? See, if you remember, we have covered all the contents of the SA700 except one content I did not explain there, material uncertainty relating to going concern. That content we have covered it here. All the contents of the audit report in SA700 we are done. One we did not cover, that is material uncertainty relating to going concern, which we told we will talk about in the SA 570. Now we have covered that point also. With this, all the contents of the audit report we have covered. Now, if you come to the other case, if the management is not giving adequate disclosure, then what you should do? So then we have to give modified opinion. Which kind of modification? Which kind of modification? You have to give either a qualified opinion or you have to give a adverse opinion. Now multiple doubts will be there in the minds of the students. Now you will say, sir, since we are unable to determine whether going concern is valid or not, since we are having a material uncertainty, don't you think it is a case of non-availability of audit evidence? So we should have given a qualified or disclaimer of opinion. No, sir. Nobody got that doubt. We are telling material uncertainty relating to going concern. That means we are unable to decide going concern is valid or not. It is depending on some event. So you should have, it is a case of non-availability of audit evidence. No? Should have given qualified or disclaimer, right? No. Why no is, we are modifying the opinion not because of material uncertainty. We are modifying the opinion not because of material uncertainty. We are modifying the opinion because the management did not disclose that material uncertainty regarding which we have evidence. See, if there is a material uncertainty, there is nothing wrong in that. We are not modifying our opinion because there is a material uncertainty. Why we are modifying our opinion? Management did not disclose that material uncertainty. For that I have evidence. No, I clearly know that management did not disclose that. So it is a case of evidence only. I have evidence that management did not disclose that material uncertainty in the financial statements. That's why I will give either qualified or adverse. Now one more doubt you should get. Sir, you told if the management tries to tamper with the going concern and all, it will always be material and pervasive. Directly you should have told qualified. Directly you should have given adverse. No, sir. Why once again you are bringing qualified here? Here also what they say here is, yes, if the management tries to do something regarding the going concern, it is definitely material and pervasive. But here why they have told qualified and adverse is depending on severity of the material uncertainty, we have to decide it. Depending on what? Severity. Say for example, same, the company is going through one pending case. I spoke with the lawyers of the team and all. I consulted some external lawyer also. Those lawyers are all telling that, sir, company will not lose the case. The company will definitely win the case. 100%, 99% it will win the case. Everybody is saying the company will win the case. There is a material uncertainty. Agreed. But the effect of that uncertainty is not so big. The chances of winning are much high. The chances of going concern becoming invalid are very, very less. So here what I can give? Just qualified opinion I can give. But however, same pending case is going on. The chances of winning or losing I have to decide. Whenever I spoke with anybody, they are saying, no sir, there is a probability company might lose the case. So here the effect of material uncertainty is very, very bigger. The chances of going concern becoming invalid is very, very higher. Now what I will do? Now I will give adverse opinion. Understood? Clear and comfortable, everybody? So these and all are different outcomes which could be possible. And one more outcome also could be possible. What is that one more outcome is? Management is not sharing their assessment regarding going concern. As an auditor, I need to obtain audit evidence regarding going concern. Management will make an assessment. I will ask them to share the assessment. They will share the assessment. On the basis of that, I will decide whether going concern assumption is valid or not. But when I go to the management and ask, sir, please share your assessment. On what basis you have done the assessment regarding going concern? Please share with that to me. I will do the assessment. I will perform audit procedures and try to obtain audit evidence. Management is telling, no, we will not share that assessment with you. On what basis we have decided going concern is valid or invalid? We will not share that basis only with you. Now, what you will do? Since you are unable to obtain audit evidence, you have to modify your opinion here also, but here you have to give either qualified or disclaimer. But I do personally believe instead of qualified, disclaimer will be the best option. Directly have to give disclaimer, because if the management is not sharing assessment regarding going concern, so maybe here their intention could be majority of the information they have shared, just 1-2 points they did not share. Then you can think of qualified. But if most of the information is not shared regarding assessment of going concern, then we give disclaimer of opinion. Understood? Clear? So these are all the different outcomes which could be possible and how they could have an impact on the auditor's opinion. Okay, shall we proceed further? Standard over? Not at over. So what we have discussed till now? First we have seen what is management responsibility. We are seeing auditor's responsibility, in that I have told only first point. To obtain sufficient and appropriate audit evidence regarding management's assessment of going concern. Second objective, on the basis of your audit procedures, you have to determine whether there is any material uncertainty relating to going concern. In case if you find any, you have to report as per the standard. How to report as per the standard? That's what we have seen till now in the chart. How to report it, we have seen. Able to understand? So 3 objectives of the auditor as per SA 570. What are the 3 objectives? To obtain sufficient and appropriate audit evidence regarding appropriateness of management's use of the going concern assumption. Number 2, to determine whether there is a material uncertainty relating to going concern. Number 3, to report in accordance with this SA. Okay, next. Okay, so as I was saying, you need to obtain audit evidence regarding appropriateness of management's use of going concern assumption. But to obtain audit evidence, we need to perform audit procedures. So what audit procedures I have to perform? Here also they say I need to perform audit procedures under 2 categories: risk assessment procedures, further audit procedures. So first, in risk assessment procedures, what we do? No. Risk assessment procedures, what is the outcome? Identify the risk of material misstatement. Like in SA 501, I have told litigations and claims. First, you need to identify whether there is any risk of material misstatement in that area. Here also SA 570 says first perform risk assessment procedures. First identify is there any risk of material misstatement regarding going concern. But this they phrase it in a different manner. What they're expecting from you is identify whether there is any risk of material misstatement regarding going concern. But they phrase it in a different manner. So what do they say is the auditor shall consider whether any event or condition exists that may cast a significant doubt on entity's ability to continue as a going concern. Find out whether there is any event or whether there is any condition which is creating a doubt regarding entity's ability to continue as a going concern. More or less, if I put it in the other way around, what they are trying to say, find out whether there is any risk of material misstatement regarding going concern. That's what they're actually trying to say. Okay, clear and comfortable, everyone? Right. Next. Yeah. What else we have? How to identify. See, before I can say how to identify, I would like to say one more thing. Before I say how to identify that event, first we should know what are that events or conditions which create a doubt on going concern. Do you agree with me? See, the standard they're saying by way of risk assessment procedures, they're asking me to identify whether there is any event or condition that may cast a doubt on entity's ability to continue as a going concern. But before that, I should know what are that events or conditions that create a doubt on going concern. Yes or no? So that we call them as indicators. So that standard itself has given. They did not ask you to go and search what events and conditions will cast a doubt regarding going concern. They told we will only say what kind of events and conditions which create a doubt regarding entity's ability to continue as a going concern. And those are divided into three categories. Those are divided into how many categories? Three categories. Those are financial indicators, operating indicators, other indicators. So a few examples of these indicators are also given here. Examples of the financial indicators: the company is having always a net liability position. Borrowings are approaching maturity, but they don't have any amount to repay that borrowings. Negative cash flows, continuously they are generating negative cash flows. Withdrawal of financial support, your creditors, bankers are withdrawing their financial support, or adverse financial ratios. Bad financial ratios they are having. Operating indicators like management itself is having an intention to liquidate. They don't want to continue any longer. Loss of key management. Key persons in the organization have left. Labor difficulties. The company is unable to find the labor who are ready to work for their factory. Shortage of supplies. Whatever raw material they want for the purpose of running their business, that raw material is in huge shortage. Or even successful competitor. All of a sudden a huge successful competitor has come and all your customer base has shifted. Or it could be even other indicators like non-compliances with the laws and regulations. Your client is not complying with laws and regulations. Pending cases, so many pending cases are there against your company. Uninsured catastrophes. Uninsured catastrophes. In the recent times, some catastrophe happened, some calamity happened, some earthquake happened, some fire accident happened, and luckily your client is not having an insurance policy. Right. So he will have to close. Then changes in laws and regulations. So these are all other indicators. Why I was talking about this? From where we have come to here? We are discussing risk assessment procedures. So what you should do is, first you should identify whether any of these events are present. Whether any of this financial indicator, any of this operating indicator, or any of this other indicator is present or not, that we need to find it out. Sir, how can I find it out, sir? How can I find it out? Simply what they say here is by inquiring management. Don't do anything, just go and inquire with the management, sir, whether any of these indicators are present. Okay, so now by inquiring management, two outcomes could be possible. By inquiring management, two outcomes could be possible. What will be that two outcomes? There may be, yes, you have found out some events or conditions which create a doubt regarding going concern. That means any of these indicators you have found. Or there may be a case you did not find any events or conditions which create a doubt regarding going concern. If you don't find any of these events which create a doubt regarding going concern, that's all, your responsibility has come to an end. You aren't supposed to do anything. In case, if you came to know about any of these events or conditions which created a doubt regarding going concern, then you need to perform further audit procedures. Sir, what further audit procedures I have to perform? Right. So see here, what further audit procedures I have to perform. The list is there given here. So the further audit procedures which you are required to perform, or where management has not yet performed an assessment of the entity's ability to continue as a going concern, go and request the management to make its assessment now. The management has not yet done the assessment, go and ask them, sir, why you have not done the assessment? Please do the assessment now. And evaluate management's plans for future action. Sit with them. What are their plans for the future? Check them. Don't just get the plans, check how far they are feasible. The company is telling, sir, we have borrowings. You found that companies approaching borrowings are approaching maturity. They don't have funds to pay. They told that, sir, a banker is ready to give us some amount of loan. Don't just blindly believe. If the banker is ready to give the loan, ask them to do the sanction letter. So try to check how far that plans are feasible. And also ask the entity to prepare a cash flow forecast for the coming 1 year, how the cash flows are going to be. So prepare a forecast and check on whatever data that cash flow forecast is prepared, is it reliable or not? On whatever assumptions that forecast is prepared, or those assumptions are realistic or not, you obtain that evidence. And check whether any additional information has become available from the date management made its assessment. Management made the assessment, gave it to you. After that, any significant event has taken place which will create a doubt regarding going concern, analyze it. And also you have to request written representation. And in addition to that, you need to perform additional procedures like analyze the cash flow, profit, and all other relevant forecast. Check the entity's latest available interim financial statements. Go through the terms of the debentures and loan agreements. Read the minutes of the meeting. Go and inquire the entity's legal counsel, and also existence of arrangements, financial arrangements with the banks and all also you have to verify. So finally perform all these further audit procedures. Now you will be left with the findings. What findings? Going concern is valid, invalid, material uncertainty, blah blah blah, all that will be left, and depending on that findings you have to fulfill your reporting requirements. Understood? So SA 570 we have completed. That's it. Next. Now we will talk about SA 560, which is relating to the concept of subsequent events. Right. So what are these subsequent events? These subsequent events we already know. In the accounting, you might have already learned that subsequent events. So what basically is the meaning of subsequent events as per accounting standards? We will come to the standards on audit later, but as per the accounting standard, what is the meaning of subsequent event? Those events which are occurring between the date of the financial statements and the date of approval of the financial statements, that we call them as subsequent events. And accounting standards divide that subsequent events into two categories. What are they? Adjusting events, non-adjusting events. What we should do to the adjusting events? We have to adjust it to the financial statements. Non-adjusting events, disclosures we have to give. So like this is what they have told it in the accounting standards. And as we all know, accounting standards will talk about accounting requirements, not auditors' responsibilities. Whereas standards on audit talk about auditors' responsibilities. So in case if the auditor came across any subsequent events, what he is supposed to do? We know what is the meaning of subsequent events as per accounting standard, but that is not the meaning of subsequent event as per standards on audit. The term subsequent event has been defined under standards on auditing in a different manner. So what is that meaning of subsequent events? But before we could see that what is a subsequent event, we need to understand few dates. Few dates we have to understand. So what are that dates is, number one, date of financial statements. What do you mean by date of financial statements? The date, the end of the latest period is nothing but 31st of March. In India, that will be 31st of March. So if you take 24-25 financial year, 31st of March of 2025 will be date of financial statements. Date of approval of financial statements. The date on which the recognized authority has accepted the responsibility. Basically, whenever board of directors will sign the financial statements, that is when they have accepted. So say for example, date of approval of the financial statements is 10th of April 2025. Then we have date of auditor's report. What is the date of auditor's report? The date which auditor signs and mentions it on the auditor's report. Say for example, 15th of April. And then date the financial statements are issued. What do you mean by that? The date on which the financial statements are made available to third parties apart from management and auditor. Whenever these financial statements are being made available to third parties, that date we call it as date the financial statements are issued. Say for example, these financial statements are issued, audited financial statements are issued on 20th of April. Clear? And basically between the date of approval of the financial statements and the date of auditor's report, which one should be earlier? Date of approval of the financial statements. It could be on the same day also, but the date of approval of the financial statements cannot be later than date of auditor's report. Fine. So we understood all these dates. Now let us try to understand what is the meaning of subsequent events. So SA 560 says that subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact which became to auditor's knowledge after the date of auditor's report. Some event has taken place between the date of the financial statements and date of auditor's report, but the auditor came to know about that fact after the date of auditor's report. Then only that event we call them as subsequent events. See, if some event has taken place between, if you go back to this dates only, some event has taken place from between the date of financial statements and the date of auditor's report, but auditor should have known after this. If the auditor has known about this event before the date of auditor's report only, there is no requirement of standard. There is no requirement of any guidance only. Why? Because if you came to know about the event before giving the audit report only, whatever action you want to take, that action you can take it through your auditor's report only. So no. So why do you need a separate standard for that? Not required. No. So when we need guidance, when the things become complicated, you already gave the audit report, you already signed the audit report, then you got to know about an event, but that event has taken place in the past. So now the need will come. Now you start looking for guidance. Have I got to know about this information at the time when I have given audit report? I would have given a different audit report. So that thought comes to your mind. Now you have to take some action. Now you have to start looking for guidance. So that's why subsequent events are those events which are occurring between the date of financial statements and the date of auditor's report, but the fact came to auditor's knowledge after the date of auditor's report. Clear? Next. Okay, we understood subsequent events. Then, yeah, what are the objectives of the auditor? As an auditor, what are your responsibilities? So you need to understand, you need to update, you need to check whether subsequent events that require adjustment have been properly reflected. Whether if there are any subsequent events that to adjusting subsequent events are there, whether they are properly reflected in the financial statements or not, you need to check. And in case if you came to know about any subsequent event after the date of auditor's report, you have to respond appropriately. How to respond appropriately? That's what we are going to learn. And whatever it is, first you need to find out subsequent events are there or not. First, how you will get to, in order to know whether there is a subsequent event or not, to know that you need to perform some procedures. So what audit procedures you will perform to know whether subsequent events are there or not? So we have a list here, as you could see. First, you should go and understand what procedures management has followed to identify the subsequent events. See, before the auditor, management is having a responsibility to identify the subsequent events. So first go and ask the management what procedures they have performed to identify subsequent events. And also go and inquire with management and those charged with governance. Did they find any subsequent events? And also read the minutes of the meeting of board of directors and shareholders, especially which have taken place after the date of financial statements. Read the interim financial statements, quarterly financial statements, if they are ready, read them, or even obtain written representation. So you perform all these steps and you have to find out the subsequent events. Now you will find out the subsequent events, and there might be two cases. See, you have found out a subsequent event after the date of auditor's report. You gave the audit report on 15th of April. After giving the audit report, you got to know about subsequent event. But by the time you got to know about subsequent event, financial statements are not yet issued. Financial statements have not fallen in third party's hands. That is one case. Second case is you have got to know about subsequent event after the date of auditor's report. But by the time you have got to know about the subsequent event, the financial statements have already been issued. The financial statements are already in the hands of the third parties. Which one is more complicated? Second case is more complicated. First case is somewhat better. Why? Because you got to know about subsequent event, but the financial statements did not reach anybody. So the moment financial statements reach the third parties, then the things get complicated. So first we will talk about the easy case, facts which became known to the auditor after the date of auditor's report, but before the financial statements are issued. Generally, if you came to know about generally whatever things which take place after the date of auditor's report, you are not required to worry about it. You don't need to do anything. But in case if you came to know about any fact, and if you feel that if this I have known at the time of auditor's report, I would have given a different audit report. If such a fact comes to your knowledge, then you should perform these procedures. So you got to know about subsequent event, but by the time you got to know about subsequent event, financial statements are not yet issued. What you should do? So what you should do here is three things you should do. Number one, first go and discuss the matter with management. Go and discuss with the management. Sir, I got to know about subsequent event. What we shall do? Discuss with the management. Determine whether financial statements need amendment. As a part of the discussion, you please determine is that a adjusting event or non-adjusting event. Why? Because only when it is adjusting, then only it requires amendment of the financial statements. So arrange a discussion with the management, discuss with them, determine as a part of the discussion whether financial statements need amendment, and if financial statements need amendment, if you have decided that financial statements need amendment, you have to inquire whether management is ready to amend that financial statements or not. You have to inquire them whether the management is ready to amend the financial statements. Now, two outcomes could be possible. First, three things. What you will do? Number one, discuss with the management. Number two, determine whether financial statements need amendment. If needed amendment, then you need to determine whether management is ready to do it or not. Two outcomes could be possible. What are they? Management agrees to amend the financial statements. If the management agrees to amend the financial statements, happy. But you should do one thing. What you should do? You should perform extra procedures to check whether they have done the amendment properly or not. The management says, yes, sir, we have done the amendment. You can't blindly believe no. So you should check at least once whether they have done the amendment properly or not. You need to perform audit procedures. You need to obtain audit evidence regarding that amendment. If everything is okay, you will give unmodified opinion, no issue. That means old opinion itself will become relevant. But you have to do one small change here. You have to do one small change. So management has amended the financial statements, and it is you are happy that they did the amendment also properly, but you are not required to give any kind of modified opinion. The old report is still valid, but one slight change you have to do. Date you have to change. Why? Because previously management approved the financial statements on 10th of April. I gave the audit report on 15th of April. Now we got to know about subsequent event. Management amended the financial statements. These amended financial statements will once again be approved. Say for example, these are approved once again on 20th of April. So now that is other case, no? So 20th of April they have amended and they have approved it. The old audit report content and all wise it's same, but I can't give the old audit report. Why? I have mentioned the date as 15th of April. So what I should do? Keep the entire report as it is, just to change the date and give the audit report. Clear? Able to understand? So what we have seen, once again, if you understand the cycle here, discuss with the management, determine whether they need amendment. If financial statements need amendment, inquire. Management agrees to amend. Perform the audit procedures on the amendment. Try to obtain sufficient and appropriate audit evidence. And then finally, there is no impact on the opinion. Old audit report will still remain valid, but only one thing you are required to do, change the date. Now the problem comes. What is the problem? Management is not ready to amend the financial statements. If the management is not ready to amend the financial statements, now also here there could be two cases. See, now you can't give the old audit report. What you should do? You should give a modified opinion. Why? Because management is not amending financial statements. You have to definitely give a new audit report. But here also there could be two cases. You signed audit report. Audit report is ready, but you have not yet handed over that audit report to the client. You signed audit report. Say for example, on 15th of April, you have signed. You thought tomorrow I will come and give that audit report to my client. But before you could give that audit report to the client, you got to know about subsequent event, discussed with the management. Management is not ready to amend the financial statements. You are in a favorable position here. Why favorable position? The report is still with you. You did not give it to the management. What you will do here? Whatever old audit report is there, you throw it away. You give a new audit report. In that, give a modified opinion, add your signature, affix your UDIN and all, and give that new audit report. But in some cases, so if you see this, management does not amend the financial statements, but there are also two cases. Audit report is not yet given to management. Then what we do? Modify the opinion and give the audit report. What is the other case? By the time you came to know about subsequent event and all, audit report has already been given to the management. So I have given the audit report to the management. I got to know about subsequent event. That subsequent event needs amendment of the financial statements. Management is not amending. Now what I should do? First thing what you should do is you should instruct the management not to circulate audit report. Don't circulate the audit report until my further notice. Then what if without listening to you, if the management has still circulated, what you should do? You have to take appropriate action to stop the people from relying on the auditor's report. Whatever action you will take, that you will decide. So you have to take the appropriate action, whatever it is. Take appropriate action and stop the circulation. And anyhow, so you should stop the circulation. If first you should instruct the management not to circulate. If circulated, please take the action to stop the circulation. Then what you should do? Give a new audit report which contains a modified opinion and ask them to circulate this new audit report now. So this is what, in case if you came to know about subsequent event before the financial statements are issued. Now let us come to the another case. What is another case? You came to know about subsequent event, but by the time you came to know about subsequent event, financial statements are already issued. They have fallen in the hands of the third parties. Here what you will do? Here also the same three things we will do. First we will go and discuss with management. Then we will determine whether financial statements need amendment and inquire whether management is ready to amend the financial statements or not. But before that, what you should do is, if you have decided financial statements need amendment, whatever audit report which is there with the shareholders, that is not a valid one. So first you should go and ask the management, sir, take some appropriate action to stop the people from relying on the audit report and the financial statements. What you should do, you should go to the management and ask them, sir, please stop the movement, please stop the people from relying on the audit report and the financial statements. If the management does not take any action, then what you should do? Auditor himself should take an action to stop the people from relying on auditor's report. Understood? So whatever it is, first stop the people from relying on auditor's report. Either you do it or management will do it. Someone has to do it. Then after that, once again, I will see whether management is agreeing to amend the financial statements or not. If the management does not, if the management agrees to amend the financial statements, well and good. What I will do? I will perform the audit procedures, whether they have done the amendment properly or not. I will try to obtain audit evidence. Then I will give new audit report. I will give, which contains unmodified opinion only, because they have changed. No. And here the standard specifically says you will give unmodified opinion. Now this audit report will go. Amended financial statements will go once again. But the shareholders already have a copy of the financial statements and the audit report. Now if you send them new copy of the audit report and financial statements, they get confused why we are getting two copies of the financial statements and two audit reports. So in order to sort out, in order to help that shareholders, what you do is you either use an emphasis of matter paragraph or other matter paragraph, mainly emphasis or other, whatever it is. You use that emphasis of matter paragraph or other matter paragraph, and there you highlight what you do. There you highlight what is the difference between this new set of financial statements and the older set of financial statements. Just highlight it. You give unmodified, but highlight it. What if the management doesn't agree to amend the financial statements? What if the management is not agreeing to amend the financial statements? Anyhow, you will give a new audit report, give a modified opinion. Reason for that modified opinion, you will explain it in basis for modified opinion paragraph. Here also, are you required to make use of any emphasis of matter or other matter paragraph? No, you are not required to use any emphasis of matter or other matter paragraph. Okay, everybody with me? Shall we proceed further? Right. So this is what regarding SA 560. So with this, we have completed all the 500 series of standards. See one small thing, one small point missed out. See once again, if you come back to SA 570, one small point I missed out. In SA 570, reporting requirements are there, no? We have seen two cases. Going concern is valid, going concern is invalid, material uncertainty relating to going concern. Now one slight change there, not change actually, addition. So if you come to this, going concern becoming invalid. If the going concern is invalid, there also we try to check whether there is an appropriate disclosure or not. If there is an adequate disclosure, what we do? Unmodified opinion we will give. If there is no adequate disclosure, what we do? Directly we give adverse. See, even in the case of material uncertainty also, if you are modifying, if there is an adequate disclosure, we are giving unmodified. But in order to bring that matter to the shareholders' attention, we are highlighting that there is a material uncertainty. Where we are highlighting it? In a dedicated paragraph called material uncertainty relating to going concern. Don't you think here also there is a need? Going concern is inappropriate. Going concern is invalid. Entity will not continue for the foreseeable future. Management has given an adequate disclosure also without their fault. I have given an unmodified opinion. But don't you think here also there is a need to highlight this information to the shareholders in the auditor's report? Yes. How to highlight it? Here they have told use the emphasis. Here there is no need to use any separate paragraph. Here you can highlight that in which paragraph? In the emphasis of matter paragraph, you can highlight it. Understood? Only for highlighting material uncertainty, we use material uncertainty relating to going concern paragraph. But for the purpose of highlighting inappropriateness of the going concern assumption, no need to use any separate paragraph. You can highlight it in emphasis of matter paragraph. Understood? Right. So this one small point I have missed out. So with this, we have completed all the 500 series. Okay. Fine. So now what we will do is we will try to do SA 260, SA 260, 265. We will try to complete them. Very small standards and very easy standards. SA 260 talks about communication with those charged with governance. So you are required to fulfill some communication with those charged with governance. You are required to communicate some matters with those charged with governance. So what matters you are required to communicate? But first of all, before we can understand what matters are required to be communicated, we should understand who are those charged with governance. They say some complex definition. When I say those charged with governance, they say some definition. That definition will add confusion, will not give clarity. Like if you read the definition, whatever they have given in the standard, those charged with governance are those persons or organizations with a responsibility for overseeing strategic direction and also obligations related to, understood, no? Understood. So they say that they are basically looking after overseeing the strategic direction. That means they provide the strategic direction for the company. That means they look after strategical matters of the company, and also they have obligations relating to accountability. Accountability in the sense being responsible for their actions. Now, in order to make you understand this, who will fall under those charged with governance? Let me give you one simple example. From a common perspective, I will give one example. Say, for example, there is a, say myself, I have one business idea. I have one business idea. I want to start a restaurant. I have one excellent dish and all I have. So something I have some ambience I have thought of and all. So definitely I know that restaurant will work well. So I want to start a restaurant. But I'm already occupied now. Already occupied. I'm taking up these classes. I have a practice to take care. So I will not be able to sit there and manage the business. But I know that is an excellent idea. So what I have done is I have created a restaurant. I have started a restaurant. Now, in this restaurant, various operations are required to be taken care of, like everyday groceries and all they have to buy. They have to look after the cooking. They have to serve the customers, billing, multiple functions is required to be taken care. So now what I have done is, since I am unable to spend all the time, I have appointed one manager. At my restaurant, I have appointed one manager. Now this manager will look after day-to-day operations. He will buy, or he will take care of all the groceries and all. He will manage the chefs. He will also manage the customers. He will do billing. He will coordinate with the auditors and all. So every business activity will be managed by this function, managed by this person. And I'm calling him manager. So management basically is a term which refers to the people who have the execution responsibility, who executes, who make the things happen, not by themselves. They are responsible for execution. They don't actually execute. When I say management will prepare financial statements, board of directors will not sit and prepare financial statements. They will make sure that financial statements are prepared. They have to make it happen, but they will get it done with the help of staff. So here also, I have started a restaurant for this organization. I have given the execution responsibility to my manager. Now this person will fall under management definition. Okay. Now, if something goes wrong in the restaurant, people will come and blame whom? See, for example, if someone ate a food in the restaurant, just for example's sake, really I have a restaurant idea, just for example's sake, I'm destroying my idea and all. So say, for example, one person came to the restaurant, ate the food, some food poison has taken place. Just for example, okay. So very he has become extremely sick. He has become extremely sick. So he has filed a complaint against me. So now authorities will come and question whom, or really it's a fault. It's a fault only. Some chef has added something intentionally. Has added. I did not pay him salary on time. So on grudge he has done something. So this person has felt very extremely ill. Now Police have determined that yes, this is completely fault of the restaurant. They came to arrest. Whom they will arrest? Owner. They will come and arrest me. If I'm sitting in the class, they will come here, they will pick me up. Yes or no? So here, accountability. Who has to face the consequences if something goes wrong? Owner. So here I will fall under those charged with governance definition. Not basically owner, I have to face the consequences. So I will fall under those charged with governance definition. And what this manager should do, like strategic decisions, whether to open a new branch or not. If I have to open a new branch, where I have to open the branch. So all that decisions, who will provide the strategic direction? Who will take all the decisions? Will I ask my manager to open the new branch wherever he want? No. I will decide where this new branch is required to be opened, how the fund, what has to be done to the funds, should I do any interior updation, should I open it, should I add few more items in the menu or not, that all strategic direction will be taken by me. So I will fall under those charged with governance definition. So I am the person with the responsibility for overseeing strategic direction, and I'm also have obligations relating to accountability. So I will fall under those charged with governance. This person will fall under management. Management has the execution responsibility. Easy to understand till here. But this difference between management and those charged with governance becomes very thin in the case of companies. In the case of companies, say for example, there is one company. 99% of the companies, you will not be able to find the difference between management and those charged with governance. Say for example, I will give you how in company it will work. Say for example, there are some promoters in the company. These promoters have started the company. They are just investors. They are just investors. They don't take any execution responsibility. They just will decide out of the funds of the company what they are supposed to do, whether they have to expand or not. Only that decisions they will take. But when I say company, in company many functions will be there. Like there should be one finance thing, finance people should be there who has to take care of that financial statements, preparation of books of accounts, and there will be operations, there will be HR related functions, there will be some various other functions. So now what these promoters have done is they have appointed some directors. So there is a CFO who will look after financial statements and all. There is one CEO. They have appointed one CEO who will look after that operations and all. They have appointed one director of HR department who will look after the HR related things and all. So like that, they have appointed these people, CEO, CFO, directors and all. They have appointed. Now these are the people who have the execution responsibility. So these will fall under what? Management. Whereas these are promoters who are providing the strategic direction and all, they will fall under what? Those charged with governance. But in majority of the companies, what will happen is there will be promoters, there will be founders. They will start the company with their own money, and what in fact they do is they only will take the positions in the operations also. They only will take the responsibilities also. Like for example, 4 people have started a company, and these 4 people, each person has become one director. So one person is a CFO who is looking after finance, one person is a CEO who is looking after something, one person is a managing director, one person is a whole-time director. Like generally whoever own the company, they only also will pick up execution responsibility. So in those cases, both management and those charged with governance, both the roles are played by same category of the persons. In many organizations, you will not be able to find the difference, especially in companies. So management and those charged with governance, in many companies, both the roles are played by same category of the persons. They will only look after strategic direction. They will only look after execution responsibilities also. Understood? Right. So now since we understood who is management, who is those charged with governance, now let us try to understand what are the objectives. So as I have told, as per SA 260, you are required to communicate some matters with what? Those charged with governance. Sir, what matters you are required to communicate? What matters you are required to communicate? That's what in the objectives paragraph. So they say that you are required to communicate with those charged with governance. What are your responsibilities? Because many people don't have an understanding what auditor is supposed to do, what management is supposed to do. They don't know. So that's why it is your mandatory responsibility to go and communicate with those charged with governance. What are your responsibilities? And also overview of planned scope and timing of the audit. Not detailed plan, scope and timing of the audit. You should not say detailed plan to them. So this is what I'm going to do. Keep a copy of the audit plan with you. You should not do that. Just you have to give an overview of the plan, scope and timing of the audit. And also, in case if you require information from those charged with governance, it is your responsibility to obtain relevant information also. It is not one-way communication. When I say communication, two-way communication. You are also required to communicate some things with those charged with governance. If you require any information, you should be able to get that information from those charged with governance, and also provide those charged with governance with timely observations. So whatever your observations are there, those observations on a timely manner, you are required to communicate with them, and you have to promote a effective two-way communication. So four objectives. Number one, you have to communicate with them responsibilities and overview of planned scope and timing of the audit. You need to obtain relevant information. Number three, you need to provide them with timely observations, and you should ensure that there is a two-way communication. Now they talk about each point in a detailed manner. Sir, you told I have to communicate my responsibilities. What responsibilities I have to communicate? Simply two things. You have to communicate that you are responsible for forming and expressing an opinion. And just because auditor is appointed, that will not relieve the management of their responsibilities. What do I mean by that? Just because you have appointed me, you should go to the management and say, sir, your responsibilities will still be there. Even though you have appointed me as an auditor, that will not reduce any of your responsibilities. Your responsibilities are yours, my responsibility is mine. Just because you have appointed me, there will be no reduction on your responsibilities. Tomorrow, don't come and ask me to prepare the financial statements. So this is what you are required to communicate. So you have to go and communicate with him, communicate with the management that you are only responsible for forming and expressing an opinion, and in no way that will relieve the management of their responsibilities. And also I told you have to explain them about planned scope and timing of audit. But once again I have told overview. What I have told, overview of planned scope and timing, you have to communicate. Along with, you have to communicate with them significant risk also. What and all are significant risk that you have to communicate. And in addition to that, I have told you have to provide them with timely observations. No, not every observation. You will try to communicate only significant findings. Major findings you have to report, not each and every matter. Sir, what could be significant findings? A few examples they have given. Significant qualitative aspects like accounting policies related information and all that you can communicate. Inappropriateness of accounting policy. If you find any accounting policy which the management is following is inappropriate, wrong accounting policy they are following, go and communicate with them. Significant difficulties encountered. The management is putting a difficulty on your work. You want to go and communicate with them. Go and communicate. Unless all of those charged with governance are involved in the management. That means if management and those charged with governance both are same, then no need to do this. When management and those charged with governance both the roles are played by same person, this point will not become applicable. If management is different and those charged with governance is different, then you need to communicate something extra to those charged with governance. What you have to communicate? Number one, whatever matters you have discussed with the management, whatever written representations you have requested from the management. But if management and those charged with governance both are same, what is the purpose in communicating? Basically, whatever you have communicated with the management, that they are asking you to communicate with those charged with governance once again. When this will happen? When both the roles are played by two different categories of person. When both are same, what is the purpose? Anyhow, one communication you have done? No. Next. Circumstances that affect the form and content of the auditor's report. Because of what reasons your opinion might change. What factors affect your form and content of the report. So that also you have to communicate. And all other significant matters as per professional judgment of the auditor. So any other matter, whatever you feel it as, per your professional judgment, you have to communicate. So these are all the significant findings which are required to communicate. And especially in case if you are conducting an audit of a listed entity, you are required to compulsorily communicate regarding auditor's independence. Mandatory. So if in case of a listed company, you are required to communicate regarding auditor's independence. So what communication you have to do? That auditor shall communicate engagement team, not just engagement partner, engagement team, firm, and also the networking firm. Everybody has complied with ethical requirements. And also you have to communicate with them whether there are any such relationships which might affect your independence. Like if you are providing any audit services for your subsidiary associate, or you are providing any non-audit services to the clients or the related entities, what fees you are charging for audit purposes, what fees you are charging for non-audit purposes. Basically, if any relationships you have that affect independence, all that things are also required to be communicated, and this is mandatory only in the case of listed entities. And what is the communication process? When I say communicate, how you will communicate? In the written format, generally in written format. But what the standard says is, in case of listed entities, compulsorily in writing. In case of other entities, you can do it orally also. If you find that oral is inadequate, then you have to do written communication. But generally, oral will always be inadequate only. Oral communication will always be an inadequate communication. So we have to do everywhere written communication only. and whatever matters that you have communicated with those charged with governance, all that matters are required to be included in your audit documentation. Okay, comfortable? Shall we proceed? Next. Coming to the next one. SA 265. SA 265 talks about communicating deficiencies in internal control to those charged with governance and management. So whatever deficiencies you have, that has to be communicated. Basically, what this standard says is, if you have a normal deficiency in internal control, communicate with management. If you have a significant deficiency, that you communicate with those charged with governance. That's what the standard says. If you have a normal deficiency, communicate with management. If you have a significant deficiency, communicate with those charged with governance. But before that, we need to understand what is a what is a deficiency, what is a significant deficiency. So what is the meaning of deficiency? Control is designed, implemented, or operated in such a way that it is unable to prevent, detect, or correct a misstatement. You have implemented internal control, but it is unable to prevent, detect, or correct a misstatement. Or you don't have altogether internal control. Internal control itself is missing. Even if you don't have internal control also, we call it as a deficiency. You have internal control, but it is designed, implemented in such a way that it is unable to prevent a misstatement. Then also we call it as a deficiency in the internal control. Clear? Now, what is significant deficiency? A deficiency or a combination of deficiency which you feel it as sufficiently important to bring it to the attention of those charged with governance. There will be various deficiencies, but every deficiency doesn't require bringing it to the attention of those charged with governance. If you find any deficiencies or combination of deficiencies, and if you feel that these should be brought to the attention of those charged with governance, those deficiencies we call them as significant deficiencies. Understood? Next. So examples of matters that the auditor may consider whether a deficiency is a significant deficiency or not. Sir, how you will decide whether a deficiency is a significant deficiency or not? What factors you are going to consider? These are the factors which I will consider. I will consider likelihood of deficiencies. Depending on likelihood of deficiencies, I will decide. And also whether it is fraud or whether it is having a chance of fraud. If it is having a chance of fraud, the deficiency will be a significant deficiency. And also degree of subjectivity or complexity is involved in the amounts. If the amounts are very complex, if the amounts are very subjective, so many judgments are involved, in those areas risk is there, that risk will be significant risk. And also financial statement amount exposed to deficiency because of weakness in the internal control, some financial statement is exposed to deficiency. What is the amount of that item? If the amount is very big, significant deficiency. It also depends on volume of activity exposed to deficiency. Through that internal control, how many activities are getting processed? If so many activities are going through that deficiency, that will be a significant deficiency. So all these factors auditor will consider, then he will take a decision whether the deficiency or a combination of deficiency, is it a significant or not. Next one. And they have given indicators. There are some indicators which will give a hint to the auditor that there could be significant deficiency. So what are the factors which give a hint? Number one, ineffective aspects of control environment. What is control environment? We have seen the risk assessment in internal control chapter. What is control environment? Culture of honesty and ethical behavior. You find that in the organization there is no good control environment. People are not honest, people are not having ethical behavior. So that will clearly indicate there is a significant deficiency, like significant transaction in which management is financially interested. So many transactions are happening where board of directors are having a lot of interest. Or identification of management fraud. I came to know there is a management fraud. Management itself has committed a fraud. Or no remedial action for significant deficiencies. Even after coming to know about deficiencies also, no actions are getting taken. These things indicate ineffective control environment, and ineffective control environment will indicate a significant deficiency. Next, absence of ineffective risk assessment process. Basically, management is not at all studying their organization only. Where risk is there, where risk is not there, they are least bothered. Next, ineffective response to identified signified risk. Even after identifying significant risks also, they are not taking any action. and misstatements which are not prevented, detected or corrected by internal controls. You are finding plenty of misstatements which are not getting prevented, detected or corrected by internal controls. Disclosure of fraud or error as a prior period item. They found out a fraud, but in order to hide it, they are showing it as a prior period item. Or management is management's inability to oversee preparation of financial statements. Management is not having knowledge to look after financial statements. That is a very good opportunity for the people who want to commit a bigger frauds. So these are all the indicators. As an auditor, if you come across these circumstances, there is a hint which should come into your mind. Okay, since this thing is there is a possibility of significant deficiency. And whatever deficiencies in the internal controls are there that you are required to communicate, as I have told, you have to communicate with those charged with governance. What? Significant deficiency. And communicate with management. What? First we will communicate normal deficiencies, but before communicating significant deficiency with those charged with governance, you will also communicate them with management, because sometimes you might have a notion that it is a significant deficiency, but after you discuss with the management, your perspective can change. You might have a wrong understanding. So that's why before you communicate that significant deficiency with those charged with governance, you are required to communicate with management also once, unless you feel it is inappropriate. Sometimes you might feel that if I go and disclose first to the management before the information goes to those charged with governance, they might do some manipulation. Then you should not communicate. Then you have to directly go to those charged with governance. Next, written communication of significant deficiencies should include. So whenever you are communicating significant deficiencies to those charged with governance, what and all should be included in that communication? You have to describe the deficiencies and their potential effects. What deficiencies you have identified, because of that what impact could be there. Not just that, in addition to that, you should also provide those charged with governance with sufficient information to enable them to understand the context of communication. See, in most of the cases, no, those charged with governance will contain those people who are not at all aware of who are not at all aware of all these things. Why? Because see, those charged with governance are basically business people. We can't expect them to be so much educated, or even if they're educated, you can't expect them to know about our financial terminology. If you give them a report, deficiency, significant deficiency, blah blah blah, they will say, okay, oh, so much of information. But once you leave the room, no, they will throw it in the dustbin, because they will not understand. No. So that's why don't just let them know deficiencies, provide them with all the sufficient information. Just explain them. So deficiency means weakness in the internal control. Significant is this is very much bigger deficiency, because of which in your organization these things are happening. So like that, provide them with all the sufficient information to make them understand that significance. And in particular, the auditor shall explain purpose of the audit, and it is to express an opinion. In addition to reporting significant deficiency, you tell them one more thing. Sir, my objective is not to report on internal controls. My objective is to what? Form an opinion on the financial statements. As a part of that responsibility, I verified a few controls. By verifying that controls, some deficiencies has come to my knowledge that I have reported. And these might not be only deficiencies. If we would have dig deeper, there might be other deficiencies also. I'm just communicating with you whatever has come to my attention as a part of my broader objective of expressing an opinion on the financial statements. Whatever has come to my attention, that I am reporting. And these might not be only deficiencies. If you do a further investigation of your own organization, you can even find more deficiencies also. So that you have to go and communicate, that you have to mention in your that report which you are through which you are communicating the significant deficiency. So this is what regarding SA 265. So 260, 265 we are done. So now we will try to do SA 450. So for this chart should be there, but I'm unable to find that chart where I have kept it. It might be in my other laptop. I will go and check. So but I will try to cover it from here. From the material we'll try to go. Small standard only, easy one. Okay, so let us try to complete SA 450 also. You want break now? No, right? No. 450 we will complete. Then after that we will see if required. If I require, I will give. Fine. So SA 450 talking about evaluation of misstatements identified during the audit. So now just I will tell you overall structure. Here there is nothing so complicated. Just we need to understand the entire sequence in the audit once again. So what is a misstatement? Do you guys remember? What is a misstatement? Did I define the term misstatement? Please define that for me. A difference in amount, classification, presentation, disclosure, which is there in reported financial statements, and the amount, classification, presentation, disclosure required as per applicable financial reporting framework. That we call it as misstatement. And the misstatement can happen because of fraud, and it can happen because of error also. And one of the main objective of the auditor is you need to express an opinion whether financial statements are free from material misstatements. Basically, what will happen is when you start performing audit procedures, so you will perform audit procedures. By performing the audit procedures, you will find out misstatements. The whole objective of performing audit procedures is to find out whether misstatements are there or not. So you will start performing audit procedures, you will find out the misstatements. Now, what we should do to that misstatements? What we should do to that misstatements? So first, what we should do is what and all misstatements we have identified, we have to accumulate all that misstatements. What we should do? Accumulate all that misstatements. Unless those misstatements which are clearly trivial, you have to accumulate all the misstatements except those which are clearly trivial. Clearly trivial means which are clearly negligible, that you need not accumulate, that you can completely ignore it. Say for example, I am conducting audit of Reliance Industries Limited. I found out that there is a 500 rupees of fraud has taken place in the Reliance Industries Limited. Will I accumulate that also? No. So if you find out, first you will find out all the misstatements. Out of all the misstatements, whatever misstatements you found it as clearly trivial, clearly negligible, that you will ignore, that you will not accumulate. So other than clearly trivial, whatever misstatements are there, all that misstatements you are going to accumulate. Now, after you have accumulated all the misstatements, first what you should do is you should go and communicate all that misstatements with the management. What we should do? We should go and communicate all that misstatements with the management. See, whatever misstatements we have identified, that could be because of errors also. Just because if you find an error, you should not go and say, I found so many errors, I will give a modified opinion. No. You have to go and communicate with the management, give them an opportunity to correct that misstatements. The misstatements might mistake when a misstatement has happened, that doesn't always indicate a fraudulent intention. There could be some human errors also because of which errors could have taken place. So whenever you have found all that misstatements, first you have to accumulate other than which are clearly trivial, go and communicate with the management and ask them to correct that misstatements. So now once you have went and communicated all that misstatements with the management and you ask them to correct it, they might have done few things. Number one, what they can do is they could correct all the misstatements. They would correct all the misstatements. Well and good, fine. In some cases, they might say, no, we will not correct any of the misstatement. They did not correct even a single misstatement. Or in some cases, what they will do is they will correct a few misstatements. They will not correct a few misstatements. See, first case is the only favorable case where they have corrected all the misstatements. That is a good scenario. We need not modify any opinion. In case if they have not corrected all the misstatements, so first I will go and request them. I ask them to correct the misstatements. If they are not correcting the misstatements, then take one more opportunity, go and communicate with those charged with governance and tell them, sir, your management is not correcting the misstatements. Please do correct them. If after that also correction is not happening, so whatever uncorrected misstatements are there, the total amount of uncorrected misstatements that I will compare with the materiality level which I have decided. Whatever total uncorrected misstatements are there, that I will try to compare with the materiality level. If the total of uncorrected misstatements has exceeded my materiality level, I will modify my opinion. If the total of uncorrected misstatements did not exceed my materiality level, if it is within the materiality level, I will not modify my opinion. That's all. Clear? So once again, if I tell you entire steps, you identify misstatements, you accumulate the misstatements except those misstatements which are clearly trivial, And whatever misstatements you have accumulated, communicate with the management, ask them to correct it. If they correct it, well and good. Whatever uncorrected misstatements are there, that you compare it with the materiality level, and if they have exceeded the materiality level, give a modified opinion. Understood? So this only they try to stretch it a bit further. So with so many complex sentences and all. So quickly we will try to cover. So the objectives of the auditor. What are objectives of auditor? Number one, you have to evaluate effect of identified misstatements and also the effect of uncorrected misstatements. Both we have covered. So first, as I have told, you have to accumulate all the misstatements identified during the audit, but other than clearly trivial, those misstatements which are clearly trivial, clearly negligible, that you can ignore. Apart from that, all other misstatements you have to accumulate. Now you have to consider identified misstatements as and when the audit progresses. Throughout the audit, you have to remain alert for misstatements. So the auditor shall determine whether overall audit strategy and audit plan need to be revised. Sometimes what you think is, in the plan and strategy you have decided smaller samples, but in the small samples only you are able to find so many misstatements. Then you might be required to revise your strategy to increase your checking. So you might be required to revise your audit strategy and plan when the nature of identified misstatements indicate that other misstatements may exist. You found misstatements and there is a strong conviction that if I verify more, I will be able to find out other kind of misstatements also. Then go and make changes to your strategy and plan. Increase the testing, find out that other misstatements also. Or the aggregate of the misstatements during the audit approaches materiality. You have found out so many misstatements that did not exceed, but it has come very closer to materiality. Generally, you do it on the sampling basis. On sampling basis only, you have found out the misstatements which are closer to materiality. Now, if you do little bit of extra testing, might be actual misstatement might go beyond my materiality level, and you could avoid giving a wrong opinion. So that's why in these two cases, you make changes to your strategy and plan. When identified misstatements indicate there could be other misstatements, or the accumulated misstatements approach the materiality level. And also, the auditor may request the management to examine a class of transactions, account balances, to understand the cause of misstatement. In case if you have found misstatement, same misstatement is getting repeated, ask the management why the same misstatement is happening and again, and ask them to evaluate the reason and ask them to rectify it. Next. If at the auditor's request, management has examined and corrected the misstatement, you check once whether really management has corrected the misstatements in a proper way or not. Then once you have accumulated, what we should do? Communication. Ask them, communicate with them and ask them to correct it. So the auditor shall communicate on a timely basis unless it is prohibited by law or regulation. If there is a prohibition from law or regulation, don't communicate. If there is no prohibition from law or regulation, you have to communicate. The auditor shall request management to correct the misstatements. So and it enables the management to evaluate whether items are misstatements or not, and if it disagrees, take necessary action. See, when you go and communicate with the management, whatever misstatements you have identified, sometimes management will disagree also. No, sir, you are considering it as a misstatement, but it is not actually a misstatement. You felt accounting policy is wrong. Whatever accounting policy the client is following, it is wrong. You went to the management and told. Sometimes what management will do is they will give you justification. No, sir, your understanding is only wrong. Depending on our business, this accounting policy is only correct. So that could change your perception also. So if you go and communicate, either management will correct. If they disagree, they will let you know so that you can update your understanding. Next. And also, if you go and communicate with them, it will enable the management to maintain accurate books and records. If management refuses, management is refusing to correct the misstatement, first you should obtain understanding of the reasons. First you should ask them why they are not correcting it. If there is a genuine reason, well and good. And also whether financial statements as a whole are free from material misstatements. Because of that non-correction, is the financial statements contain a material misstatement. Why? Because that uncorrected misstatement, we will compare it with the materiality level, no? So that you have to analyze and evaluate the effect of uncorrected misstatement. As I have told, that you have to compare it with the whatever uncorrected misstatements are there, that you have to compare with the materiality level. So you have to consider in aggregate, not separately, the total of all the corrected misstatements you have to consider. And the auditor shall consider size and nature of the misstatements and even uncorrected misstatements related to prior periods. Everything you will consider. And in addition to that, you should also communicate with those charged with garnets. As I have told, if the management is not correcting, you have to give an opportunity to those charged with garnets. Here also, unless prohibited by law or regulation. And you should request them to correct that misstatements. And also to them also you communicate whether any uncorrected misstatements are there which are related to prior periods. and even you ask them written representation. When you ask them written representation is if the management is not correcting the material misstatements. They are arguing, sir, no, sir, this is not a misstatement. We will not correct it. They will tell you some reasons and all. Don't just hear that listens. Don't just listen to that reasons. Ask them to write that reasons in a written representation. Next, and whatever misstatements you have identified, how many corrected, how many not corrected, on what basis you have decided the misstatements as trivial. I told clearly trivial misstatements should be ignored. On what basis you have decided which is trivial, which is not trivial. So all that things should form part of audit documentation. Clear? So with this we have completed even SA 450 also. Okay, how many more standards we are left with? Ora. Two only, no? Five? 5, 25, 30, leave it. Audit sampling, analytical procedures, dedicated chapters. 320, audit strategy, planning and program. That I will cover there. 220 is there. SQC1 is there. 610 also I told I will give you a brief and all. Okay. So shall we take a break now? Okay. So let us take one short break for 10 minutes. Please come back to that. So first, let me give you one brief. What does SA 220 and SQC1 talks about? Both are talking about the quality control only. So like as I've told you in the introduction to this chapter, when we had introduction to this chapter, that auditor will do different kinds of engagements. So sometimes he will do audit, sometimes he will do review, sometimes he will do assurance, sometimes he perform related services. All these are different kinds of engagements which a chartered accountant does, and there's a need for maintaining quality in all that engagements. So for ensuring the quality in all the engagements, we have a standard called SQC1. So SQC1 provides the guidance to the chartered accountants on how to maintain quality in all kind of engagements. So SQC1 will give guidance how to maintain quality in audit engagements also, in review also, in assurance also, and also at the related services. Basically, SQC1 talks about quality control at the firm level, how overall firm should maintain the quality. Whereas SA 220 is also going to talk about quality control only, but SA 220 talks about quality control in the case of only audit engagement. So if I have to define, if I have to bifurcate it, if I have to tell you pinpointed difference, SQC1 talks about quality control at the firm level. SA 220 talks about the quality control at the audit engagement level. So for every engagement, whatever you are doing, for every audit engagement, how you have to maintain quality, that is guided by SA 220. For all engagements which a firm does, how to maintain the quality, that will be explained by SQC1. Both are structured on the same lines. Actually, SA 220 has been taken from SQC1 only. SA 220 has been taken from SQC1. Why? Because SQC1 is talking about overall quality and SA 220 is talking about only quality on audit engagement. So first we'll start with SQC1. As you could see, SQC1 talks about quality control for firms. It is talking about the entire audit firm that performs audits, review of historical financial information, other assurance services, and even related services engagement. So whatever engagement you do, be it audit, be it review, be it assurance, be it related services, for all the engagements, how to maintain the quality, that is governed by SQC1. Then, and SQC1 says that in order to maintain quality in all the engagements we are doing, you need to follow some principles. You need to follow some principles. And that principles are required to be implemented in 6 elements. How many elements? 6 elements are there. In 6 areas of your firm, you need to follow some policies and principles. Sir, what are that 6 areas in which I have to maintain the quality, in which I have to follow some principles? That 6 areas, we call them as elements of system of quality control also we call it. So there are 6 areas in the firm in which you have to follow some policies and procedures, then automatically quality will be ensured for all the engagements. So what are that 6 elements of system of quality control? Number 1, leadership responsibility for quality within the firm. Number 2, ethical requirements. Number 3, acceptance and continuation of client relationship. Number 4, human resources. Number 5, engagement performance and monitoring. So in these 6 areas, you need to maintain policies and procedures. What are the 6 elements? Number 1, leadership quality, leadership responsibility for quality within the firm, ethical requirements, acceptance and continuation of client relationship, human resources, engagement, performance, and monitoring. So what does this each of the points say? What kind of policies we need to have in each of this element? Let us try to have a quick look. Starting with the first one, leadership responsibility within the quality. See, if you give the responsibility for maintaining the quality to everybody, no one will make sure that quality is maintained. If I give a task and I say each and every one of you in the class will be responsible for completing that one task, high chances no one will do that task. That task will remain unfinished one. But on the other hand, if I give someone a leadership responsibility, so I'm making you a leader, you have to make sure that this task has to get completed on time. There are more chances that task being completed on time. Same thing happens even with the quality also. If I say entire firm is responsible for quality, no one will maintain. Someone should come forward and take the leadership responsibility. Okay, I will take the responsibility. I will act as a leader for making sure that my firm complies with quality norms. Sir, who should be that someone? No, that is for auditor. The leadership responsibility in the firm for all engagements, who has to come forward and take the leadership responsibility is the chief CEO, firm's CEO or managing partners to come forward and assume the ultimate responsibility. I'm not talking from audit perspective, I'm talking from the entire firm perspective. So for a firm, if they have to ensure quality, someone should come forward and take the leadership responsibility. Who should be that? CEO or managing partners. Not just them, they have to assign operational responsibilities to those people who have appropriate experience, ability, and authority. Then only quality will come. Just if the CEO come forward and take the leadership responsibility, quality will not be ensured. So whenever he is assigning the work to others, he should assign the work to such people who have appropriate experience, ability, and authority. So if you take the steps, the quality can be ensured. So that is what the leadership responsibility. Now coming to the second point, ethical requirements. You have to make sure that the entire firm, including your engagement team members, everybody should comply with the 5 ethical requirements along with the independence requirements. Like if you see, the firm should establish policies and procedures that provide reasonable assurance that its personnel comply with ethical requirements. Not just the top people, even all the members, even staff also, article assistants, everybody should comply with the ethical requirements. And 5 ethical requirements, what are they? Integrity, objectivity, professional competence and behavior, professional competence and due care, confidentiality and professional behavior. And in addition to that 5 ethical requirements, what also should be followed? Independence, which is a basic requirement. And firms should communicate independence requirements with personnel. So new article assistants will come in the firm. They will not know how to comply with ethical requirements, what to do if they come across ethical requirements, because everybody will not be like you sincerely listening to the auditing lectures, no? Right. So that's why you have to educate to all your personnel that maintaining independence is very, very important. And also identify the circumstances that create a threat to independence. Once again, go back to nature, objective, and scope. So they have to identify, is there any threat to independence? If possible, try to eliminate them or apply the safeguards and keep it at a very low level. And all breaches of independence should be communicated with the firm. If any breach of independence takes place, everybody should go and communicate with the firm. And also at least annually, this is very important for MCQs, at least annually firm should obtain written representation from its personnel regarding compliance with the independence. Every firm should ask from each and every staff whether they have complied with the ethical requirements or not, at least once in a year. Next, so this is the second area, ethical requirements. Third one, third one, acceptance and continuation of client relationship. So before you accept the client relationship, before you say yes or before you continue the client relationship, you need to check certain things. What you need to check? 3 things you need to check. Number 1, integrity of the client. What you need to check? Integrity of the client, whether your client is an honest person or not. To the extent possible, try to associate with the honest people, but that's where not money comes, but still. So to the extent possible, you have to check before you accept or continue the engagement. You have to check the integrity of the top level management. So integrity of the client you have to check. Sir, how you will come to know whether your client is honest or not? How you will come to know? So like as you could see, you have to identify, you have to make a brief inquiry about the reputation, what kind of reputation they enjoy in the market, what kind of operations they are doing, what is their attitude, and whether the client is aggressively concerned with maintaining lower fees. That means they are not treating the auditor correctly. They always say, we will give you 10,000 only, you have to do all the work. So this kind of attitude if they have. And also inappropriate limitation, they are coming and putting a restriction on your scope. Or indications of client involvement in money laundering. You came to know the client has previously involved in the money laundering transactions. Or reasons for proposed appointment and non-reappointment of the previous auditor. If they're appointing you now, previously who is the auditor, why they have removed him. So like that, by considering all these factors, you determine whether the client is having integrity or not, honesty or not. And one more thing which you need to check is competence to perform engagement. You will check whether client is honest or not. Before you say yes, you should also check whether you are competent to complete the engagement or not. So if you have only some 2-3 resources, you are a newly qualified chartered accountant, you have some 2-3 staff in your office, totally some 4 people are there in your office. You cannot go and accept the listed company engagement. You will not be competent to do it. You need more resources. So before accepting the audit, only check whether you are competent enough. And also check if you are accepting or continuing a client relationship, will you be able to comply with ethical requirements, all the 5 ethical requirements including independence, will you be able to comply with that or not. Check these things, just check these things, then only you say yes to the client relationship. Fourth area in which you need to have policies is human resources, nothing but basically with regard to your HR, so with your staff. So here I have written same as SA 220. Anyhow, I will explain it here itself. So what kind of policies you need to have in the area of human resources? First, at the time of recruitment, you should recruit only those people who are competent enough. If not competent at the time of recruitment, they should have that zeal to become competent. And you have to do periodic evaluation, performance reviews you have to do. If you find someone doing the job in a better manner, complying with independence, ethical requirements, you should honor him. Promote the eligible persons. If you find someone who is lacking in training, provide them enough of training. If you find someone who is not appropriate, who is always doing non-ethical things and all, remove him from the firm. These kind of human resources policies also can make sure that you are maintaining the quality. Next area in which you need to maintain some policies is engagement performance. Sir, at the time when the engagements are getting performed, then also you need to have some policies. What policies you should have? Like briefing of engagement teams before you go and start doing the audit. Just like that, you should not give the instructions to your staff, go and start doing the audit. You have to brief them what they are supposed to do, what they are supposed to do, which standards they have to follow, which process they have to follow to comply with the standards. You have to brief them. And also, if any difficult or contentious matters comes, people should be able to come to you openly and communicate the difficult matters and ask for guidance to you. So that kind of friendly environment you have to create. And also need to consult externally in case of lack of internal resources. Sometimes you might be doing some audit, you need expertise, but you don't have internal people. Like you need a services of a lawyer. You don't have internally any lawyer. Then you should not hesitate to go outside and get the help of external resources. Review of significant judgments made in engagement. Before you express your opinion, you have to review once what and all judgments you have made. And engagement quality control review is mandatory for listed entities. What is this engagement quality control review? Just before, after all the audit has been done, after you have performed all audit procedures, after you have obtained all the evidence, just before you express the opinion, someone from the firm or outside of the firm, some competent person should come and check whether the audit has been done properly or not, all procedures are performed properly or not, what judgments you have made. So someone should come forward and check it. After checking only, you have to give the opinion. So that process we call it as what? Engagement quality control review. The name itself says whether the engagement has been done in a qualitative manner or not, that review will happen. Okay, and that is mandatory for when? Only when it is a listed company. And if there is any differences between engagement team and the engagement partner, between engagement partner and engagement quality control reviewer, so if there are any differences, they have to resolve that differences. So like this, when the engagements are getting performed, these kind of policies you should have. And then finally, monitoring. Just by implementing these policies, your things are not assured, quality is not assured. Whatever policies you have implemented till now in all the above areas, whether they are really practically getting implemented, is there any requirement to change any of them? Are you required to update? Are you required to make any changes? So that you have to periodically evaluate also. Understood? So this is what regarding monitoring. So these are the 6 areas in which you need to maintain some policies to ensure that you are maintaining quality. Now, if we talk about SA 220. So SA 220 is talking about quality control only in an audit engagement. Here also they say that if you want to maintain the quality, you have to follow some policies and procedures in 6 elements. What are that 6 elements? Number 1, leadership responsibility, ethical requirements, acceptance and continuation of client relationship, human resources, engagement performance, monitoring of policies and procedures. like who will be taking leadership responsibility? For the entire firm, we said managing partners or CEO. But for audit engagement, who should take the leadership responsibility? Engagement partner. And if you want to fulfill the leadership responsibility, just taking the responsibility will not be enough. You have to fulfill it. How you will fulfill it? By way of communication. So as a engagement partner, if you have taken the leadership responsibility for maintaining quality, you should communicate. You should emphasize to your team members what? You should highlight them how important it is to comply with professional standards, how important it is to comply with legal requirements, how important it is to comply with firm's quality control policies and procedures, and also how important it is to give appropriate audit reports. And you should create an environment to raise the concerns without fear. Basically, if you just say, if your engagement partner go to the people and say, I am leader, nothing is going to happen. You have to fulfill it. How you are going to fulfill it? Educate your people. Educate them how important it is to do the audit as per standards, as per laws and regulations. Why you have to give appropriate reports. What will happen if you don't give the reports? What will happen? Engagement partner will go and sit in the jail. Don't say that. Engagement partner will go and sit in the jail, but you should not say that to the staff. What you should say, if you do something wrong, we all should go and sit in the jail. Then only they will work. Yes or no? Right. So this is how you have to fulfill the leadership responsibility. Second area, ethical requirements. This anyhow we have discussed. Five ethical requirements we have, including independence. We have 6. Then acceptance and continuation of relationship. This I've already told. Before accepting and continuing client relationship, some factors you have to consider: ability, integrity of the management, competence of engagement team, compliance with ethical requirements. They say one more point here: significant matters arised during the previous assignment. Like last year, you have done the audit for the same client, for the client. Last year, he harassed you. Harassed in the sense, he has harassed you professionally. So, whatever information you are asking, he is not sharing that information. When you are asking information twice or thrice, he is irritating. At one time, he shouted at me. I'm an auditor. He did not care only. I asked for evidence, he shouted at me. And at some point of time, someone came to beat me. So the same entity next time, once a year gets over, the same entity is coming to you and asking, sir, please do the audit for the current year also, sir. Will you do? If I am a person, if I am in that position, I will definitely not do. So you will have to consider any significant matters which have arisen during the previous engagements also, and accordingly take a decision whether to accept the engagement or continue the engagement. Human resources, I have already told, you should have some policies regarding recruitment, performance evaluation, capabilities, competence, career development, promotion, compensation, in all the areas. You should have some policies. And then finally, engagement performance. Here also more or less the same things they say: briefing of objectives briefing of objectives of the work to engagement team, how they have to comply with the standards, direction, supervision, and staff training you have to do, reviewing of the work of engagement team. Whatever work your engagement team has done, don't blindly believe. Review the work of the engagement team, because if your team does wrong, you have to face the consequences. And also you have to maintain proper documentation. If there is no documentation, nothing will help you in the future. And also keep all the procedures and policies current, relevant, and updated. And implementing all these policies alone will not be enough. We need to even monitor also whether these policies are getting operated effectively or not. And also you have to do periodical inspection of completed engagements. Whatever engagements you have done till now, periodically you verify in all that engagements, have we done something wrong, or whatever opinions we have given till now in all the engagements, are they appropriate? So you have to do the periodical reviews also. And also, why monitoring is important? Why we have to monitor? Why can't we implement the policies and ignore it? So you can't ignore it, because if you monitor, then only you will get to know whether you are doing the work as per professional standards and legal and regulatory requirements. Whatever reports you have given, whether it is appropriate or not. Whatever quality control system you have built, is that proper or not? And also follow up by appropriate personnel. So this all will happen only if you do monitoring. So that's why monitoring is the most important step. Just implementation alone will not be enough. Monitoring is very much required. Understood? So this is what regarding 220 and SQC1. So we will do one thing now. We will start audit strategy, planning, and program. So we'll start that chapter. Fine. See, now we are going to revise the chapter audit strategy, audit planning, and audit program. Generally, I don't used to do the revision of this chapter. I used to ignore it previously. Why? Because this chapter is not fit for revision. This chapter is not at all fit for revision. Why this chapter is not fit for revision? Reading only. I have to read it. That's all. What are the benefits of planning? What factors you have to consider while developing audit strategy? What are the benefits of the plan program? And this chapter is a bit irritating also to prepare for. Very much irritating. Why? Because questions will look similar, points will look repeated. So this is one of the very favorite chapter for the students to leave. Yes or no? To not read. This will come as a top priority. People used to do that. And I also used to suggest few years back. But keeping in mind the recent examination trends and all, there were attempts from this chapter, which I say no students will leave this chapter. So they have tested 8 marks, 10 marks, 12 marks from this chapter. So whatever we don't like reading, no, from there only they start asking the questions. And I will tell you, and one more important point I have to say, one more chapter which students always look for leaving out: audit of items of the financial statement. But you don't know, guys, if you are leaving out that chapter, 12 marks, 12 to 14 marks, you are leaving on the table. So I don't think any wise man will do it. Even woman also, when I say man. So no wise person, yeah, this is correct. No wise person will do that. So please don't do it. Don't leave out the chapter audit of items of the financial statements. Recently, I have done one video analyzing the model test papers and all the model test papers, weightage and all. I have given it in the form of the pie charts and all. Recently, I have done one video and uploaded. So just go and check there. In the description, I have given that Excel sheet link also, Google sheet link also I have given. Just open that, have a look at that pie charts. You see every attempt in the model, every out of the 8 model test papers, just look at the weightage, how much they have added to the audit of items of the financial statements. There were a few model test papers, 22 marks or 23 marks have been tested from audit of items of the financial statements. So such a significant the chapter is. In case if you are finding it difficult to read it from the material, for the last 2 chapters, I have a summary material also. I have a summary material. You can download it on my app or websites. You can download it. So for these 2 chapters, specifically for these 2 chapters, intentionally, since I realized that people are leaving the content of these 2 chapters a lot, so I don't want that to happen. So that's why I have prepared one summary, so that at least that summary you refer and go for the examination. Last 2 chapters, and those last 2 chapters are also something which are not fit for revision. I can't revise. What revision I have to do for that last 2 chapters? Once again, open the material and keep on reading it. So such a chapters, such very dry chapters, such boring chapters are those, but still, yeah. So I say no, so you will leave that chapters only. That's why they're asking the questions also from that chapters only. So don't do that. Even in MCQs, they are testing. Case scenario MCQs, they are testing from audit of items of the financial statements. So don't leave it. Please do read that last 2 chapters also. And in addition to that, add this chapter also: audit strategy, planning, and program. This also you don't leave it. Right. Okay, a quick thing. So audit strategy, planning, and program. The content, whatever we are going to discuss in this chapter, has all been taken from SA 300. And after that, we will also have a materiality related discussion. Also, we will have it in the same chapter. That is SA 320. So, do you think planning of audit, is it important? We do a lot of planning, right? Our day-to-day aspects we do planning, our personal aspects we do a planning. So like the way we are doing the planning for various aspects, even audit is a very important task. Audit requires also very much rigorous planning. So planning of audit of the financial statements is very important, and planning of the audit of the financial statements happens in 3 phases, or there are 3 components of planning of audit of the financial statements. What are the 3 phases of planning of audit of the financial statements, or 3 components of the planning of financial statements? Audit strategy, audit plan, audit program. See, what is audit strategy? Audit strategy is the most summarized version. It contains overall objective and scope of the audit. So if I am conducting, my strategy is to obtain reasonable assurance. Yes, that is what my strategy. To obtain reasonable assurance whether financial statements are free from material misstatements, and I have to express the opinion, and I have to obtain sufficient and appropriate audit evidence. That is my strategy. It will be simply in the form of one small paragraph. That's all. Then audit plan. So basically, and one more thing, if I have to put it in specific terms, in the strategy, I decide on 2 things: time which I require for completing the audit, how many resources I want to complete the audit. In strategy, I decide only on 2 things: within what time I want to complete the audit, with how many resources I have to complete the audit. Say for example, I have got an audit of one client. So before I start doing the audit, I have to decide for doing this client's audit, I need 15 days. I need 10 staff. So that is what we said in the audit strategy. But just if you have decided the time, if you have done the resources, planning is not completed, what you should do? You have to allocate that time and resources to different tasks in the audit. In audit, you have multiple tasks. So you need to perform risk assessment procedures, compliance procedures, further audit procedures, different items of the financial statements you have to cover, incomes you have to cover, expense you have to cover, fixed assets you have to cover, current assets you have to cover, multiple tasks you have. So whatever time you have, whatever resources you have to allocate them among all these tasks. Like I will say 10 engagement team members are there. I will say risk assessment procedures will be done by Mr. A and B. 2 days of time they will spend. Compliance procedures we have. In the income related compliance procedures, Mr. B will take care of it. I will give him 1.5 days of time. So like that, whatever time you have decided, whatever resources you have decided in the strategy, that is required to be allocated among different tasks. The document in which we allocate the time and resources, that document we call it as audit plan. The document we call it as what? Audit plan. So audit strategy, we decide on timing and direction, timing and resources. Whatever time and resources we have decided in the strategy, that allocation we will do where? In the audit plan. Now what is this audit program? Say for example, in one area, say for example, in the plan I told purchases related area was allocated to Mr. C and the time given for him is 2 days. Now this person, what things he is required to verify in the purchases area in that 2 days of time? I have to give him instructions. So now I will draft something called an audit program for purchases. In that audit program for purchases, I will give him what and all instructions he is required to follow. Like purchases, whatever purchase invoices are there which are more than 1 lakh, do 100% verification. Try to select the sample using statistical sampling. Try to verify those transactions which are with so and so customer, and take at least 10% of the sample. You follow inspection, you follow observation. So basically in that 2 days of time, what and all instructions which are required to be followed in that particular area, so all that instructions I will include it in a document that we call it as audit program. So like this, planning will actually come to an end when audit program is completed. Understood? And this, they say one more thing, planning of an audit is a continuous process. See, planning is a process. When I say planning of audit, it is a process, the process of establishing audit strategy, audit plan and audit program. So planning is a continuous process. It is not just a one-time activity. And one more thing they say, planning is a repetitive in nature, iterative in nature. So that means throughout the audit, you will be doing the planning. Throughout the audit, you have to do planning. But my question is, if throughout the audit you are doing planning only, then when you will execute the plan? So when I say planning is a repetitive process, iterative process, I don't mean throughout the audit I will be doing only planning. Initially, I will develop a plan. Initially, I develop strategy. Initially, I develop plan. Initially, I develop program. But during the course of the audit, if at all I am required to make changes to my audit strategy, audit plan and audit program, I should be flexible to it. I should be able to adopt to it. You should not say whatever plan I have decided, whatever program I have decided, whatever strategy I have developed, no matter whatever happens, I will stick to that only. I will not change my strategy, plan and program. Can I be like that? So you have to, wherever necessary, you are required to make some changes to your strategy, planning and program. Next, and one more thing I would like to ask, see, this planning process will be there, no? We will establish audit strategy, plan and program. So first step is establishing overall audit strategy. Will I establish overall audit strategy after performing risk assessment procedures or before performing risk assessment procedures? Will I establish overall audit strategy after performing risk assessment procedures or before performing risk assessment procedures? After performing risk assessment procedures. Why? Because in strategy, as I have told, you have to decide on time and resources. If you want to decide how much time you want to complete the audit, if you want to decide how many resources you want to complete the audit, that you can decide it only when you know about the entity and its environment. If you don't know what is the size of your entity, what volume of transactions are there in your entity, how can you decide within what time you are going to do the audit and how many resources you want? So first we basically perform risk assessment procedures. On the basis of the risk assessment procedures, we get an understanding of entity, environment and internal control, and on that basis we are going to build a audit strategy, then audit plan, then audit program. Clear? So this is all the basic intro. Now if we start digging into the concepts. So planning and audit is necessary. Do you agree with that? Without planning, can we do the audit? Even if we do the audit, will that be effective? Will the audit be in our control? No. And if you are doing audit, will there be any benefits? Yes, there will be benefits. What are the benefits? You can devote appropriate attention to important areas. If you don't have the plan, what will happen is for every area you will allocate equal time. Is that a good decision? Bad decision? No. You have to allocate more time for risky areas, less time for low risky areas. That you can do it only when you do proper planning. Next, it will help you to identify and resolve potential problems. If any major problems comes, if you have a plan well in advance, you will be able to resolve it in a quick manner. The auditor properly organize and manage the engagement. If you want to manage the engagement properly, if you don't want the audit to go beyond your control, what you need? Planning you need. And also you can easily select your engagement team members. Selection of team members becomes easy. You can betterly direct and supervise your engagement team. If you don't have a common plan in place, everybody will do the audit in whatever manner they want. But if we all have to bring them to one common objective, that we can achieve it only by having a plan. And also coordination of work done by others. Even it will promote a better coordination. What do you mean by coordination is, see, if there is no plan, no time limit, nothing, everybody will do only their work. Even if their work gets completed, they will not help others. But if I give them a common target, we have to complete the audit within 15 days. As a team, we have to complete the audit within 15 days. Even if one person's work gets completed early, he will go and assist the other person to make sure that they are meeting that task. That coordination you can expect only when you have a common plan in place. So these are all the advantages of planning. And as I've told, planning is a continuous and repetitive process. So basically, what does that mean? At the beginning, we do the planning, and during the course of the audit, if required, we should be flexible, we should be adaptive to the changes. Next. Yeah. And one more thing, when you are planning, this. Right. For planning includes the need to consider prior to the auditor's identification and assessment of risk of material misstatement such matters. That means before you develop the plan, before you start doing the planning, you will definitely consider risk of material misstatement. Basically, you will perform risk assessment procedures. Even before performing risk assessment procedures, some extra things also you have to consider before you do the planning. So that is what the meaning of this line. If you see, planning includes the need to consider even prior to identification of risk of material misstatement. Which matters I have to consider even before risk assessment? Analytical procedures. How you have to perform analytical procedures. How you have to perform risk assessment procedures. See, risk assessment procedures, I can do it by way of inquiry, inspection, analytical procedures, and also observation and all. So you have to decide which analytical procedures you will perform to perform risk assessment procedures. Why? Because only when you do risk assessment procedures, then only I can do my planning. Then only I can start doing my planning. And also you need to obtain a general understanding of legal and regulatory environment. So this is once again a part of risk assessment procedures only. And also the determination of materiality, not actually. So if you ask me from the technical perspective, materiality we do it later, not at the beginning. First we perform risk assessment procedures, after that we do materiality. And also we need to decide, will there be any involvement of the experts? For this audit, do I need the help of experts? That also you need to determine. And also performance of other risk assessment procedures. So if you see here, the point whatever they have given, the points whatever they are giving here, the context is not matching. They say what activities you have to do prior to risk assessment procedures, but here they are telling risk assessment procedures only in the answer. Yes or no? So something which is completely out of sync actually. But anyhow, next. Planning requires involvement of different persons. Do you agree? Who will do the planning? Auditor will do. So auditor is responsible for doing the planning. Auditor means who? Engagement partner, because it is a matter relating to responsibility. So definitely auditor is engagement partner is responsible for developing a audit plan, strategy and program. Will he do it single-handedly? Will he involve different people? Whom he will involve? Engagement team members. There is no doubt he will involve the engagement team members. Key engagement team members he will involve. Why? Because if you involve engagement team members, you will get to know you will get to know the capabilities of your engagement team, so that work allocation can happen in a better manner. It will result in the overall effectiveness of the audit. So there is no doubt engagement team members you have to involve. Apart from them, who? Okay. So is there a requirement of involving the management also? Will you involve them completely in the audit planning and program? See, yes, you need to involve the management, but you have to involve them only to a limited extent. You should not discuss with them detailed audit strategy, planning and program. And why you need to involve the management, that limited extent also why you need to involve is, if you want to do the audit, you need the assistance of management and employees at various instances. If you want to conduct inquiry, the person whom you want to inquire should be available on the date and time. So if you let them know on so and so date I'm going to conduct inquiry, please be available, then he will become available, or else he will not become available. So that's why involve the client's management and client's staff also, but only involve them to the limited extent. When their help will be needed, when they should become available, that only you involve them. You should always keep in mind, you should never discuss a detailed audit plan and strategy with the management. That will make your audit completely ineffective. Why? Because whatever you are going to do becomes predictable. That will make the quality of the, that will make your audit completely ineffective. Clear? Next. What are the planning, what are the elements of planning? I have already told it contains the three parts: establishing audit strategy, developing audit plan, and also audit program also will be there. Before that, you are required to do something called preliminary engagement activities. So what will be included in the preliminary engagement activities? So here there are a few activities, as you could see here. Preliminary engagement. Preliminary means what? Even before you start doing the audit and all, you are required to do some activities that we call it as preliminary engagement activities. So what will fall under preliminary engagement activities? Number one, performing procedures regarding continuation and acceptance of client relationship. We have already seen, before accepting and continuing client relationship, what you are supposed to do. SA 220. Check the integrity of the management, whether you are competent or not, compliance with the ethical requirements that you have to check. So those things will form part of preliminary engagement activities. Apart from that, you need to check whether you will be able to comply with ethical requirements, including independence. This is also from SA 220, compliance with ethical requirements. Your engagement team should comply. If you come across any threat, implement the safeguards, try to eliminate it. Yes or no? Right. Next one, establishing an understanding of the terms of engagement. Nothing but what? Engagement letter. Drafting an engagement letter is SA210, agreeing to the terms of the engagement. So these three activities will fall under preliminary engagement activities. First and second point we have already discussed in SA 220 and SQC1. If you read it, you will be able to connect with it, whatever we have discussed. Okay, so three activities will get included in the preliminary engagement activities. Number one, acceptance and continuation of client relationship. Number two, checking the compliance with ethical requirements. Number three, establishing an understanding of terms of engagement, basically drafting of the engagement letter and all. Next, how establishing audit strategy will assist the auditor. If you establish audit strategy, will that benefit the auditor? Yes. How it is going to benefit him? So if you have an audit strategy, that will set the overall scope, timing and direction of the audit, and that guides the development of audit plan. So this point, this statement, earlier when there used to be true or false statements, it is a favorite question of the examiner. They used to test this question a lot. So what they used to do is, they used to say the audit plan, the auditor shall establish an audit plan that sets the scope, timing and direction of the audit and guides the development of audit strategy. Is a given statement true or false? False. They just replace. But now also they have a chance of testing it in the form of MCQ, where they will give 4 statements. In that, one of the statement will be this. Clear? Next. Now, how you will get benefited? See, when it comes to assistance to the auditor because of audit strategy, they all talk about resources. Benefits, they talk about resources only. Number one, the resources to deploy for specific audit areas. Which resources to deploy for which area? Like experienced team members will be deployed at risky areas, less experienced team members will be deployed at less risky areas. So you can take better decisions regarding allotment of resources, which resources are required to be allocated for which work. And also it will help you to decide amount of resources to allocate. How many number of resources should be allocated? For inventory verification, how many people I want? For fixed assets verification, how many resources I want? You can take better decisions regarding amount of resources, how many. Next, when these resources are to be deployed, timing. Yes. So see, if you need 10 people for doing the engagement, all the 10 people you don't need it from the day one itself. As and when required, you can pitch in them. Like when performing risk assessment procedures, 3 people are enough. Then while performing compliance procedures, some 5 people are enough. Actual when substantive audit procedures start, then I need full staff. So when that resources are required to be deployed, that also you can take better decision, and how such resources are managed, direct and supervised. You can betterly manage, direct and supervise your resources. So 4 advantages they are telling regarding the audit strategy, and the 4 are all related to resources. What are they? Which resources are to be allocated for specified areas? What amount of resources are required to be allocated? When resources are required to be deployed, and how these resources are going to be managed, directed and supervised. Next. What are the factors to be taken into consideration for establishing audit strategy? So we all know we have to establish audit strategy. So in audit strategy, we are going to decide on 2 things: timing and resources. How I will decide the timing and resources? Whatever comes to my mind, I will say 10 days, 5 staff, 5 days, 10 staff. No, right? So when you are deciding the time, when you are deciding the resources, you will decide that time and resources on the basis of some factors. You will not say whatever comes to your mind. So what factors you are going to consider for establishing that overall audit strategy? Number one, first you should pay attention to identify the characteristics of the engagement. What do you mean by identifying characteristics of the engagement? What is your client's business? How many number of transactions they have? How many locations you are required to cover? Is there any separate branch auditor or not? So like this, you have to first pay attention to characteristics of the engagement. Number two, you need to even pay attention to reporting objectives. Is there any timeline for reporting? Discuss with the management. Have they set any timetable for reporting? Are how many kind of reports they are required to give? Are they required to give report once or twice? Are they required to give one type of report or many type of reports? Like for example, in the case of banks, many reports will be required. There you need more time. And also, when the directors will become available, when the directors will not be available, sometimes directors will be will have foreign travels, or they will be coming from foreign travel. If you have to finalize the audit, you have to discuss with the management. So you have to plan your timing depending on the availability of the management also. So like this, even you need to consider reporting objectives of the engagement. And then you have to consider the factors that in the auditor's professional judgment are significant, not just that, any other matter which you feel it as significant, that also you have to consider. Like few examples are volume of transactions. You can pay attention to volume of transactions. Significant industry developments, that means because of what changes are happening in the industry, and significant changes in financial reporting framework or other significant recent developments. So these other factors also you can consider. Next one, consider the results of preliminary engagement activities. Just now we have seen 3 preliminary engagement activities. By doing that 3 preliminary engagement activities, you would have already got some information. Use that information also for establishing strategy. And wherever applicable, if you have gained any knowledge on other engagements performed by the engagement partner for the same entity, have you performed any other engagement for this client in the past? Like for example, current year the client is asking you to do company audit. A few years back you have done some tax audit for the same client. Can I use that information for establishing audit strategy of the current year? Yes, you can do it. So you can consider results of preliminary engagement, and you can also use the knowledge gained from similar engagements. Like in the last few years, you have done some engagement. From there, you got to know something about the operating effectiveness of internal controls. Previously, when you have done the audit, you are satisfied. These kind of internal controls you have not seen anywhere. Excellent system of internal controls you are having. This client is having. So definitely that will be a positive factor, no? So that I can consider and say that since I have an excellent system of internal control, maybe less time and less resources will be enough. So like that, even you can use the knowledge gained from other engagements for the entity, that also you can consider. And also ascertain the nature, timing and extent of resources. See, basically time and resources you are deciding. How much time you want to complete the audit, that depends on resources. If you have more resources, so many people in your office are free, you need less time. If all your resources are occupied, then you need more time. So even pay attention to nature, timing and extent of the resources also before establishing that audit strategy. So these are the 5 factors which you have to consider, 5 things which you have to consider while establishing audit strategy. They can ask a question in 2 ways. Either they might ask you to write only factors which you have to consider while establishing audit strategy. Then you are required to write only the 5 side headings. What side headings? Number 1, characteristics of the engagement, reporting objectives, other factors which auditor feel relevant as per the professional judgment, preliminary engagement activities, and knowledge gained on other engagements, ascertain the nature, timing, and extent of the resources. And other way for asking the question is they will ask you only one paragraph, only one part they might ask. And many times what they have asked is this: B, they have asked reporting objectives, they have asked twice or thrice. So they only to write about reporting objectives, they have asked in many cases. Okay, right. So two ways of asking the question. You should be ready, no matter in whatever way the question gets tested. Then explain the relationship between audit strategy and audit plan. What relationship exists? Don't say for God's sake direct and indirect. That's not what they're expecting. Direct and inverse relationship. Are they both related or not? That's what they're expecting. Yes. Why? Because a change in one automatically results in the change in other. And also you can develop audit plan only after the development of audit strategy. And if you want to change one, automatically the other thing is required to be changed. That is how they are closely related with each other. Those are not two separate stages of audit. It is a collective phase. Next. During the course of audit, if required, will you make changes to the planning? Are you permitted to change are you permitted to make the changes to your planning? Yes, 100%. You are permitted. You have to do it also. Why you might be required to make changes to your plan? Because of unexpected events. All of a sudden, unexpected events might happen. Say, for example, you came to the audit with the 10 staff. Out of that, 2 staff have become sick. So now you have now that 2 person who have become sick, those work has to be taken care by remaining 8 people. So you can't say no, I have already built a plan. Whether you die also, I don't have any problem. You please come and do the work. I can't say that. No. So that's why unexpected events could happen that might require you to make the changes to your audit plan. Or sometimes conditions might change. Whatever conditions that are present when I am planning, those conditions might not be present at the time of execution. And also the audit evidence obtained from results of audit procedures. Sometimes during the course of performance of audit procedures, you can get some extra information. On that basis also, you might be required to change your planning decisions. Like if you remember SA 505, there we have seen SA 580. If management written representations are not reliable, you need to reassess the integrity of the management, reassess the risk of material misstatement, and make suitable changes to your strategy, planning, and program. So those are some cases. During the course of the audit, we get some extra evidences which might require us to make the changes to our strategy, planning, and program. Next. What are the factors that affect planning, supervision, and review of work of the engagement team members? See, as I have told, see, practically you will see that tomorrow when you go and join the articleship in one of the audit firm, your partner will not do any audit. Your partner will not do groundwork. What he will do? He will just give you instructions. He will send the team. You have to go there. He will give you instructions. So basically, first in the first 2-3 months, they will ask you to do watching only. Watching in the sense, they will give you ledgers and all. They will give you supporting documents. You have to just check it. So whether matching invoice amount in the invoice is matching or not, and all that you will check. Then after some 2-3 months have passed, then he will give you some analytical procedures. He might tell you how to perform analytical procedures, some extra things you will learn. So basically all the work will be done by you. Then what your engagement partner will do? Review. He has to review. What is the guarantee you have done the work in a proper manner? Even if you do the mistake also, who has to face the consequences? Engagement partner has to face the consequences. Assume you are an article assistant. You came to me asking for a leave. Sir, my sister's brother, someone's daughter's wedding, sir. I need 1 week leave, sir, you told. At that time, I shouted on you like anything. For my wedding only, I took only 2 days of leave. You are asking for someone's leave, someone's marriage, you are asking for 1 week of leave and all. How dare you? I shouted at you like anything. You have a grudge on me now. This fellow shouted me, I need to do something. So what you will do? While doing the audit, no, even if you find the misstatement also, you will try to hide it. You will say, you will go to the engagement partner and say, sir, I have done the work, no mistake, zero mistake, blindly sign. Because you listen to the audit class effectively. When it comes to accountability, auditor means only engagement partner. Okay. So you went and told everything is okay. That a fellow auditor like me, so what I have done is I believed in you, I signed the audit report and I gave the report. Tomorrow if that fraud and all, now you only will call the regulatory authorities. Hey, this auditor has not done the audit properly of so and so client. Please go ahead and catch him. So these things also can happen. Finally, I am in danger, no? So that's why whatever work which has been performed by your staff, agreed your staff only. You only gave the instructions, but don't blindly believe on it. You have to verify. We have to review. In some cases, you are required to do more extent of review. In some cases, I am required to do less extent of review. So what factors will decide on extent and supervision? How much supervision I have to do, how much instructions I have to give, how much review I have to do, that depends on various factors. The factors are like complexity, the size and complexity. If the client's business is very complicated, if the size of the entity is very much big, I need to give you more instructions, more review also I'm supposed to do. It also depends on your competence. If engagement team member is very competent, is very capable person, he doesn't need more instructions from me. If he is not that competent enough, he's a newly joined article assistant, I need to do more review, more supervision, more instructions I have to do. And it also depends on particular area of the audit. Some areas of the financial statements require more guidance, some areas of the financial statements require less guidance. And it also depends on risk of material misstatement. If I assess risk as very high, I will give more directions, more supervision I will do, more review I will do. If I find risk as low, I will do less direction, less supervision, less review. So these factors will decide the extent of planning, supervision and review of engagement team members. Okay, next. What are the documentation requirements? See, you tell me whatever strategy you have developed, whatever plan you have developed, that will you document or will you not document? You have to document it. So why? Because it is a record of important decisions at the time of establishing planning and strategy. Many important decisions you take. So if you want to maintain record of all that key decisions, whatever you have taken during the early stages of your audit, only way for that is maintaining documentation. And if you maintain documentation of audit strategy, planning and program, it will be helpful to fix a responsibility. Like the way we have seen, which work was allocated to which person, we can find it out and we can fix the responsibility. And tomorrow if someone comes and brings an allegation against me, boss, whether you have done the audit effectively or not, at that point of time also, if I maintain that in the audit documentation, I can throw audit plan strategy on their face and say, see, I have done everything correctly. So maintaining audit documentation, maintaining the documentation of audit strategy, plan and program is very, very important. So what and all you will document? The strategy you will document, plan you will document. If you have made any changes, that changes you will document, that revised strategy and plan you will document. Because of what reasons you have made the change, that also you are going to document. So everything should form part of your documentation. Next. Audit program. As I've already told, what is an audit program? It contains a series of verification procedures which are required to apply in each and every aspect of the audit. And it is nothing but a detailed plan of what applying the audit procedures. Next. Next one. Especially for bigger audits, audit program is very much essential. Can you develop one single audit program which is applicable for all the clients? No, highly impossible, I will say. Why? Because client to client business changes, industry changes, rules and regulations changes, internal controls changes. So it becomes extremely difficult, close to impracticable to develop one single audit program applicable for all clients. But what you can do is, you can have some kind of standard things. Some things will be applicable for every client. So whatever things which are applicable, some instructions will, whatever instructions applicable for every client, that you can maintain one copy. That standard copy you can use it for all things, but whatever special things which you are required to do, for that you need to have a customized program. Next. And also assistants have to keep an open mind. They're talking about you only. So when you are maintaining the, when you are going and doing the audit, when your engagement partner has allocated you some audit program, he gave the audit program, he told, hey, I'm allocating you fixed research. In that fixed research, what you are required to do, I am giving you instructions also. Please follow that instructions. Now you should not be like a sheep which follows whatever has been told to it. So you should keep an open mind. If you find that your partner might have missed something in the audit program, you have to go and communicate with him. Sir, I think we might have missed it out. So then he will add that, update the audit program. Or if you find that your partner has included something which is not relevant for this particular entity, go and tell him, he will remove that. So you should keep an open mind. You should not be like just a list of instructions are given and you are blindly following the instructions. It should not be like that. So you have to keep an open mind. And even we have to periodically review the audit programs also. If required, we should be ready to make the changes also. Like the way we are changing audit strategy and plan, even audit program also periodically we have to review. We need to check whether audit program is considering all the aspects of the entity, and if required, you should be ready to make some changes to the audit program as well. Next, while developing audit program, what points you have to keep in mind? Number one, you should always stay within the scope. Your objective is to obtain reasonable assurance. In the program also, you should include only those instructions which will help you to obtain reasonable assurance, not absolute assurance. Prepare a written audit program. Don't have oral audit programs, try to have a written audit programs. You can have evidences from multiple sources, but identify best evidence, include instructions regarding that best evidence, and apply only those steps and procedures which are useful in accomplishing the verification purpose. See, one evidence you can obtain for one item, you can obtain evidence from multiple sources, but all evidences are not important. In all that evidences, only one or two evidences will give best evidences. Only that steps you have to include in the audit program. Don't unnecessarily overload your audit program with all the unnecessary steps and all. And also include the audit objectives for each area. What is the objective for each area of audit? That also you mention. Next, consider all possibilities of error. When you are drafting the instructions, you make sure that you have given the instructions, you have given the verification procedures in such a way that all errors are considered. And also coordinate the procedures, even include some instructions for coordination as well. So these points are required to be kept in mind while developing an audit program. So then we have something called advantages and disadvantages. See, advantages, I'm not reading it. These advantages will be very similar. From here and there, they have picked some two points and told. From audit strategy, what are the benefits we have seen. From planning, what are the benefits we have seen. From there, from here and there, two instructions, they will come and keep it here. Even from audit documentation also, they will pick some points and they will give it here. Next, disadvantages, we can have a quick look once. Disadvantages is work will become mechanical. See why? Because in the audit program, the auditor himself is telling what instructions you are required to follow. So it will be just like doing whatever has been told to you. So the work might feel very, very mechanical. And also the program often tends to become rigid and inflexible. See, sometimes no, engagement partners also will become lazy. Not sometimes, always they will become lazy. So audit program, what they will do is year after year, they will ask you to follow the same instructions. They will not spend the time in updating the audit program. Whatever last year's audit program is there, that only they will ask you to follow in the current year. Because of that, see, whatever steps which were designed in the previous year, those might not be relevant. Circumstances might have changed. But if we still follow that same rigid audit program, our audit effectiveness might be lost. And then finally, ineffective assistants may take shelter. So some people, they will not do the work effectively. Some misstatement is there. On the face, you can identify. No one is required to give instruction. On the face, a big fraud is visible, but you did not identify. Later, when your partner is asking why you did not identify that fraud, you told you did not tell me that in the instruction. So like this, ineffective staff might take protection under that audit program, and it will kill the initiative of efficient staff. See, some people will have that innovative thoughts and all. They want to do the things in a new way. But if you hand over audit program to that kind of people, that will kill their initiative. So if you have, it will be like you are not letting them use their creativity in work and all. So these are all the advantages. But these advantages can be disadvantages. But these disadvantages can be eliminated or reduced to some extent. How you can reduce to them? How you can reduce to them to some extent? By maintaining by assistants keeping an open mind, and by encouraging the assistants to participate, by creating a friendly environment where they can come and share their thoughts. If you can do that, these disadvantages can be reduced to some extent. Sample of audit program we have, as I have told once again, since example is there, chance of testing in the examination is high. So just have a look at that example. This is one useless question. So simply they say that you can get the evidence from multiple sources. For one single item, you get the evidence from multiple sources. But all the evidences will not give equal level of assurance. Yes or no? Like for example, if you see, this sentence itself is very difficult. In most of the assertions, much of the evidence be drawn, and each one should be considered and weighed to ascertain its weight to prove or disprove the assertion. Nothing you understood, I know. So what they say here is, regarding many items of the financial statements, you get evidence from multiple sources. Once you got evidence from multiple sources, you have to start weighing it. Weighing in the sense, not physically weighing it, determining their importance. To determine its weight to prove or disprove. Some evidences will have higher weight to prove my assertion. Like for example, how I have to tell you, if I'm doing sale here, if I'm doing sale, to support sale, multiple documents will be there. Sale invoice also will be there. Sale order from the customer also will be there. Goods delivery note also will be there. Gate pass also will be there that the goods have left. E-way bill also will be there. Multiple documents will be there. But different, every document will not give equal level of confidence. Different documents will have different weightage when it comes to proving or disproving the assertion. Say for example, sale invoice. If you say sale invoice will have the highest weightage to prove the assertion. Sale order is also a evidence only, but when compared with the sale invoice, it will have little weight. It will be less in priority. So like that, you get evidence from multiple sources. All that evidences you have to consider and weigh them and determine their weight to prove or disprove their assertion. And when you are doing this in this process, an auditor would be in a position to identify that particular evidence which brings highest level of satisfaction, and that he will use it for the purpose of taking the decision. Like they say here, an auditor can pick evidence from variety of sources. Like he can do documentary examination. He can get the evidence from documentary examination. That is what we call it as inspection. Very good. Physical examination. Once again, inspection only. Statements and explanation of management, officials and employees. Inquiries, you can say. Inquiries also you can say, or even you can say written representations. Statements and explanation of third parties. External confirmation. Arithmetical calculations. State of internal controls and internal checks. Compliance procedures. Interrelationships of various accounting data. Analytical procedures. Subsidiary and memorandum records. Once again, inspection. Minutes. Inspection. Subsequent action by the client and by others. This is something like observation. So you can get evidence from multiple sources. From all these sources, whatever evidence you are getting, you have to weigh it. In this process, you will find the best evidence which give highest level of satisfaction, that you use it for the purpose of decision making. Okay, right? Next. That's all. So completed. We have completed SA 300 related discussion. Audit strategy, planning and program we have completed. Now the next thing which we will pick up for discussion is materiality. So materiality, have I explained you already? Did we already know what is materiality? When a statement can be called as material if it could influence the decision of users of the financial statements. Is materiality an absolute term or it is a relative term? It is going to be a relative term. It changes from person to person, situation to situation, facts of the case to facts of the case. It will keep on changing. And when I say materiality, generally materiality will be material items, we fix it in numbers. Generally we decide the materiality in quantitative things, but not just the quantitative things, even sometimes qualitative aspects also will be considered material. The checking of the going concern assumption, is it material or not material? It is not a number, no, but it is a qualitative aspect. So materiality need not always be determined in quantitative terms. Even materiality can be determined by using qualitative aspects also. Next. So SA 320 is a standard which is talking about how to fix the materiality. So let us try to understand how to fix that materiality and all. Yes, this one. So how to fix the materiality? The standard says you have to decide materiality in such a way that first you need to determine a percentage. First you need to determine what? A percentage. How much percentage? Once again depends on professional judgment. So you need to determine one percentage. That percentage you have to multiply with benchmark. That percentage you have to multiply with benchmark. Now what could be benchmark? Benchmark could be any item from the financial statements. It could be any aspect of the financial statements. It could be turnover, it could be profit, it could be total assets, it could be expenses. Any item could be benchmark. So you have to determine one percentage using your professional judgment. You have to choose one benchmark, once again using your professional judgment. So, and if you multiply that percentage with the benchmark, you will get one resulting figure. That resulting figure we call it as materiality. Say for example, I have determined 5% depending on my professional judgment. I have chosen turnover as a benchmark. So turnover is, say for example, 100 CR. So if I multiply that 5% into 100 CR, it will come to 5 crores. 5 crores will be my materiality level. Clear? So this is how you have to fix the materiality. You have to determine one percentage and that you have to multiply with benchmark. Benchmark could be any item of the financial statements that you have to decide it using your professional judgment. And the standard says you need to determine materiality at two levels. You need to determine materiality at two levels. Number one is overall materiality, and the other one is performance materiality. What do you mean by overall materiality? The materiality which has been decided for the financial statements as a whole. If I am saying that if there is a misstatement in the entire financial statements amounting to 10 crores, I will consider financial statements as materially misstated. So that materiality level which you are fixing for the entire financial statements as a whole, that we are going to call it as overall materiality. Then we have something called performance materiality. What is performance materiality? The materiality which I am keeping it for a particular class of transaction, account balances or disclosure, that I call it as performance materiality. And performance materiality and overall materiality, which one is a higher figure, which one is a lower figure? So the statement actually there is performance materiality will generally be lower than the overall materiality. So whatever it is, we have to determine materiality at two levels: overall materiality and performance materiality. And one more thing, I told benchmark, one of the very favorite question of the examiner. What are the factors which affect selection of benchmark? This one. Sources for choosing, not sources. This one. Fifth one. Oh, no, wait. This one. Third point. Factors that may affect identification of an appropriate benchmark. So there will be multiple items of the financial statements. As I told, revenue could be benchmark, profit could be benchmark, turnover could be benchmark, anything could be a benchmark. But out of all that factors, out of those many options, auditor has to choose one. How he will choose that one? Professional judgment. But while taking that decision, there are some factors which he is required to consider, and many a times they have asked this question. Many times I've asked this question: what are the factors that affect the selection of appropriate benchmark? So what are that? Number one, this is not actually a factor. First point is a general statement. Any element of financial statements like assets, liabilities, equity, revenue, expenses, anything can be chosen as a benchmark. Whether there are items on which attention of the users of particular entities' financial statements tend to be focused. If you feel that the users will focus more on some item of the financial statement, like for example, it depends on industry. In IT companies, people are more interested to know about profits. In FMCG companies, people are more interested to know about turnover. So since people's attention is getting focused there, you can select them as a benchmark. And also it depends on nature of the entity, what kind of entity what kind of entity your client is. It also depends on life cycle. Is it in the early stages? If it is in the early stages, sales will not be there, they will not have major sales, they will be very volatile, you can't take them as a benchmark. If the company is in the growth phase, then revenue will be on a proper phase, and also their profit also will become stagnant, then also you can take profit as a benchmark. So it depends on life cycle. It also depends on industry, economic environment in which the entity operates, what is its ownership structure, and how it is getting financed. So on all these factors, it will depend. And also it depends on volatility of the benchmark. If some items are, if you want to choose profit as a benchmark, profit is very much volatile. It is highly volatile. It is changing. In one year it is 5, in another year it is 100. So can you take their profit as a benchmark? No. So then you have. On the other hand, if you look at the sales, they are volatile. They are not volatile. Sales are having a trend like 100, 110, 120, 130. So these are not that much volatile. Within a close range, these things are there. Then you can take the turnover as a benchmark. So it depends actually. These many factors auditor will consider. He will consider the user's attention, where it is getting focused. It depends on nature of the entity, life cycle, industry requirements. He will also consider volatility of the benchmark. After considering all that factors, he will choose which benchmark will be appropriate. To that benchmark, he will apply the percentage. Then the next thing, okay sir, I have selected, see for example, after considering all the factors, I have chosen revenue will be my benchmark. What I have done? Revenue will be my benchmark. Now from where I will take this revenue figure from? What is the source? If the current year financial statements are ready, if say for example, if I'm starting the audit after the closure of the financial year, by the time I'm doing the audit, the management has already prepared the financial statements. The financial statements are ready. I need not look for any other sources. From the financial statements of the current year itself, I can take benchmark. I can take the revenue figure. But in big entities, even before the closure of the financial year only, I will start doing the audit. Then the current year financial statements will not be ready. Then what we will do? We'll start looking for other sources. What could be other sources? Prior period financial statements, interim financial statements. Even you can take it from the budgets also. Budgets and forecast also you can take it. Next, after that. Yeah, it is purely going to be a professional judgment. Yeah, here they say this is also having a chance of getting tested in the form of MCQ. There is a relationship between percentage and chosen benchmark. Here, what they say here is, see, you can take revenue as a benchmark. You can also take profit as a benchmark. Two most widely used benchmarks. Whatever percentage you are applying, when you have taken revenue as a benchmark, say for example, if you are choosing 5% as a bench as 5 percentage as a professional judgment when you have taken revenue as a benchmark. On the other hand, if you take profit as a benchmark, the percentage which you apply will be generally higher. Whatever percentage that you apply when you have taken revenue as a benchmark will be generally lower than the percentage which you will apply when you have taken profit as a benchmark. Say for example, turnover of the company is 100 CR. They have made a profit of 10 crores. If I am taking 5% as benchmark here, if I multiply 5% here, you will get 5 CR. But in order to get the same 5 CR here, same 5 CR here, you have to multiply with 50%. So revenue is a bigger figure. Their smaller percentage also will give significant level of materiality. Whereas profit is a smaller figure. To get a reasonable amount of materiality figure, you need to apply there a bigger percentage. Clear? So this they can test. How they will test you is, once again, choose the correct statement. They will give 4 options. In that, one option will be a correct one. Like if you read the statement, a percentage applied to a profit before tax from continuing operations will normally be higher than a percentage applied to total revenue. He will do mismatch. He will do mismatch there. So he will try to twist it like anything. So you should be able to understand the concept. Don't go by mugging up the sentences. Understand the concept. So if you understand the concept, you will be able to mark the correct answer. Next. See, yeah, at the beginning of the audit, you maintain materiality. You decide the materiality level. Will you be permitted to revise the materiality? Can you revise the materiality levels? Yes, you can obviously revise the materiality. Like the way we are making changes to audit strategy planning and program, we are making changes to our risk assessment procedures. We are making changes to the understanding of the entity. Even materiality also, whatever we have decided at the beginning of the audit, that might undergo some changes during the course of the audit because of change in circumstances, availability of additional information, and in some cases what can cause the revision of materiality is when you have initially taken budgets as a benchmark. I told, when the current year financial statements are not ready, you can take budgets or forecasts as a benchmark. So say for example, in the current year budget, they have told company will make 1000 crores of revenue. Have taken that 1000 crores as a benchmark, applied 5%. If actual revenue, once a year gets closed, if the actual results also come closer to 1000 crores, say for example 900 or 1050, I need not revise the materiality level. But actual results are 500 only. Then what will happen? I need to revise it because there is a huge gap there. Understood? That also could be one reason why I need to revise the materiality. And whatever materiality that you are deciding, that all needs to be documented. So how you have chosen the materiality, what is your overall materiality, what is your performance materiality, have you revised the materiality levels? In case if you have revised, because of what reasons you have revised, so what is the reason behind it? So all that things you are required to document. Okay. And one more important thing I will try to say before I wind up this, which I do have gut feeling that this question will be tested. This one, materiality level or levels for particular classes of transactions, account balances or disclosures. So what they say here is, sometimes there will be some items of the financial statements, sometimes there will exist certain items of the financial statements where the misstatements of even smaller magnitude also will be considered material. Generally I fix the materiality. So what I will do is I will fix the materiality for the entire financial statements. But some areas will be there, some aspects of the financial statements will be there. where even smaller amounts also will be considered material. Even though the amount is less than the materiality level which I have set, still they will be considered material. There I will do more detailed verification. For example, I set a materiality level. I will not be worried about up to 5 CR of misstatement. Or I have set a materiality that I will not verify the transactions below 5 lakh rupees. I set a limit on verification. I told I will not verify transactions up to 5 lakhs. I will not verify only. But some transactions will be there where even though the value is less than 5 lakh rupees, still I will verify them. Like one example, if I have to say related party transactions. When you look at the related party transaction, even if you found that 1 rupee of transaction has taken place, still you will go and verify the supporting documents. Yes or no? So like that, a few aspects of the financial statements will be there where you will consider even the amounts of smaller magnitude also still material. That's what they say. Once again, the sentence formation and terminology which they use will be a bit complicated. Factors that may indicate that existence of one or more particular classes of transactions, account balances, or disclosures for which misstatements of lesser amounts than materiality, which we have said for the financial statements as a whole, could reasonably be expected to influence economic decisions of users. So sometimes there will be some items of financial statements where misstatements could be very small than the materiality level we have fixed, but still we expect them that they will influence the decision of users of the financial statements. What are the examples? Like for example, whether law or regulation or the applicable financial reporting framework affects users' expectation. Instead of reading that, I will give you examples like related party transactions, remuneration of the management. If you pay close attention, the CEO or CFO of the company, they will draw the salary. That could be a very small amount, but still that will affect the user's decision. If they came to know that, say for example, Infosys company CEO, he will draw less than 1% of the profits of the company, but still that people will consider it as material. Then, and also related party transactions, anyhow I have told, it also depends on key disclosure. In some industry, people want to know a few things even though how smaller they are. Like in case of a pharmaceutical company, research and development expenditure, the success or failure of the pharmaceutical company lies only on their research. They might be spending less than 1% on the research and development, but still user wants to know it. And also where attention is focused on particular aspect of the entity's business that is separately disclosed, like newly acquired business. Take for example, Reliance has acquired one new company. They paid 50 lakh rupees only for the acquisition, but still people want to know it, no matter how smaller that is. So like this, these are all the circumstances where these are all some factors or examples you can say where some items of the financial statements, even though in these areas very small amount of misstatement is happening, still that will be considered to influence the decisions of users of the financial statements. I don't know why, but I have a feeling that this will get tested. Right. Over. So with this we will wind up SA 320 also. So audit strategy, planning and program we have covered. Now next what we shall do. What do you want me to? Automated environment we will do. You don't want automated environment. I know I should not ask. Wrong question from me. Fine. So we'll do audit sampling now. So this particular audit sampling chapter has been taken from which standard? SA 530. When I say we are going to discuss audit sampling, we are completely going to talk about the content relating to SA 530. First of all, what do you mean by sampling? What do you mean by audit sampling? So if you look at the definition of the audit sampling, they say that application of audit procedures to less than 100% of items of the population in order to form a conclusion on entire population from which the sample has been selected. So how do they define the term audit sampling? Audit sampling refers to performance of audit procedures to less than 100% of items on the population. Say for example, I have a population. So in this, so many items are there. I am performing audit procedures not on 100% of the items. I perform audit procedures on less than 100% of the items. Say for example, I am taking one small sample. On this sample, I will perform audit procedures. When I performed audit procedures on the sample, what is my objective? I want to form conclusion. I perform audit procedures on the sample. On the basis of that audit procedures, I will get evidence. On the basis of that evidence, I have to form the conclusion. So my ultimate objective is to form the conclusion. On what I will form the conclusion? Will I form the conclusion only on the sample, or will I form the conclusion on the entire population from which the sample is selected? I am going to form a conclusion on the entire population from which the sample is selected. So say for example, I have 10,000 items of population. In that I have selected some 1,000 items. On that I have performed audit procedures. And on the basis of that audit procedures, I will get some evidence. On the basis of that evidence, I will form conclusion not just on this 1,000 transactions. I will form conclusion on entire population of 10,000 transactions. Clear? Able to understand everybody? So this is what the audit sampling is. This is how the term audit sampling has been defined under SA 530. Understood then? And one more thing here, before we go any further, we need to understand few more things relating to sampling. Basic terminology, basic statistics terminology you have to understand. Three things. Number one, population. What is population? That large mass of data from which you are selecting the sample, that we call it as population. Now what is sample? The items which you have selected on which you will perform some audit procedures, that I call it as sample. Then we have one more term called sampling unit. So what is a sampling unit? Is nothing but the individual items which make up the population, that we call it as sampling unit. Nothing but, if I say this class is a population, each and every student here, each and every student which are making up this population, you all will be called as sampling units. Next, there are two broad approaches to sampling. What are they? There are two broad approaches to sampling. So what are that two broad approaches to sampling? Number one is statistical sampling and the other one is non-statistical sampling. So what is the statistical sampling? What is this non-statistical sampling? Statistical sampling refers to such a method of sampling which is completely scientific and also it is objective. Objective means what? Unbiased method. Here we do random selection. What we do? Random selection we do. What do you mean by random selection? Every item will have an equal chance of getting selected. So here we do random selection. Then after that, this method is something which is depending on mathematical theories and probability theories. So if we follow a sampling approach where we are doing random selection, where our method is scientific, where our method is objective, and also it is based on mathematical and statistical concepts, that method of sampling we are going to call it as statistical sampling. Then what is non-statistical sampling? Which is not scientific, which is not objective, there is no random selection. And how we will exactly select the sample in the case of non-statistical sampling is purely on the basis of our professional judgment. On the basis of our professional judgment. So which one is more beneficial? Statistical sampling or non-statistical sampling? Statistical sampling is much beneficial. So why? Because it is more scientific. So there are various advantages. If you use the statistical sampling, there are various advantages. See, one more thing before that, you're all telling that between statistical versus non-statistical sampling, which one is more beneficial? Statistical. Which contains less risk? Statistical. Which one auditor should use? Professional judgment. Which one he should use depends on professional judgment. Yes, I am saying it is scientific, it is objective, less risky, agreed. But nowhere the standard has told you are required to do only statistical sampling. It is completely your professional judgment. You apply your knowledge, experience and training and decide accordingly whether you want to go for statistical or you want to go for non-statistical. If they have to say you have to use only statistical sampling, what is the purpose of telling you the non-statistical sampling? Yes or no? So once again, they have used our weapon. What is that? Professional judgment. We will give you options. You break your head and decide accordingly. Okay. Next. Is sampling mandatory? Is sampling mandatory? We have a dedicated standard, SA 530. Think and tell. Sampling mandatory? No, sampling is not mandatory. Nowhere, no standard, not even SA 200, not even SA 530, no standard has told that sampling is mandatory. Even SA 200 also says the objective of the auditor is to obtain reasonable assurance whether the financial statements are free from material misstatements and whether they are prepared as per applicable financial reporting framework. That only they have told. They did not say you have to verify the transactions on sampling basis and you have to give opinion. So sampling is not mandatory. Only the thing which the standard says is you have to obtain reasonable assurance, express an opinion. How you will obtain reasonable assurance, how you will express an opinion, that is up to you. Whether you do it by 100% verification or you do it by sampling, that is completely your choice. That is up to you. Once again, you use your professional judgment. Once again, you use your professional judgment and decide accordingly. Clear? So then what SA 530 says? What SA 530 says? Even SA 530 also does not say you have to follow the sampling. They say that you use your professional judgment, and after using your professional judgment, you have decided that you will express your opinion by following sampling. Then we will give you some guidance. Follow the guidance which we have given under SA 530. Okay, SA 530 did not make it mandatory for the auditor to do sampling. What is when SA 530 will become applicable? SA 530 will become applicable if the auditor, after using his professional judgment, he has arrived at a conclusion that he will use sampling. Then SA 530 will come and then SA 530 will become applicable and it will give the guidance. If the auditor has decided to do 100% verification, then SA 530 has no role to play. Will SA 530 become applicable in all audits? May or may not. SA 530 will have a role to play only when the auditor has decided using professional judgment to verify the transactions on sampling basis. Okay. Then, sir, whether auditor will do sampling or whether auditor will do 100% verification, that I told auditor will decide it on the basis of professional judgment. But while taking that decision, he will consider some factors. While taking the decision, he will consider some factors. Sir, what factors he will consider? Number one, size of the organization. If the client for which you are required to do the audit is a very big entity, 100% verification becomes close to impossible. There you go for sampling. He will also pay attention to state of internal controls. If the internal controls are very effective, you become very comfortable to go with sampling. Adequacy and reliability of books of accounts. If you find that books of accounts are more reliable, you will be more comfortable going with sampling. Tolerable error range. Now, what is this tolerable error range? The errors which auditor is willing to accept. Say, for example, if I'm tolerating you, what do you mean by tolerating? I'm bearing you, I'm accepting you. So tolerable error range means the errors which auditor is willing to accept. If I put it in other way around, the risk which auditor is willing to take. So if the auditor is willing to take some risk, then only he will go for sampling. If you say, no, I am a very convenient auditor, I have to have, I don't tolerate any kind of error, I am not ready to accept any risk, then you can't go for sampling. Then you have to go 100%. Then you have to do 100% verification. But there will not be such auditors who say I will not tolerate any error. Then you can't survive in the market. Next, degree of desired confidence. If you want high level of confidence, you might go for population. But even high level of confidence also, you can increase your sample size and get it. But if you want 100% confidence, you have to go for population verification or else sampling. But we don't need 100% assurance only, so we can comfortably go for sampling. So these are all the factors which auditor will consider to decide the extent of checking. They might ask a question. They will not ask you whether on what factors auditor will decide whether he will do sampling or he will do 100% verification. They will not ask the question that way. How they will ask the question is, what are the factors which should be considered for deciding upon extent of checking on sampling plan? Indirectly, what is the meaning of the question is whether you will do 100% verification or you will do sampling. That depends on what factors. Okay, comfortable everyone? Shall we proceed further? So they say three more factors here: sample design, sample size, and sample selection. Three terms they use. But before we can do that sample design and all, I think we are required to understand first what are the different techniques available for sampling. What are different techniques available for sampling? That we need. Sample selection methods we need to understand. So we have various kinds of sample selection methods. Broadly, they have given 5 here. Number 1 is random sampling. Then we have interval sampling or systematic sampling. We have monetary unit sampling, haphazard sampling, and then finally block sampling. Let us try to understand each of this in a detailed manner. Number 1, random sampling. What we do in the random sampling? Random I have already told. What do you mean by random? Every item should have a equal chance of selection. Let us take one simple example. This class containing 100 people and all. From you, I want some 10 people. I want some 10 people. So how can I pick you? See, I can look at your face and pick up. Will that be a biased or unbiased? Is that a statistical or non-statistical? Non-statistical. Why? Because I use my professional judgment. Then, what else I can do? Roll number. Say, for example, you are all having roll numbers. So now I am calling seat. Okay, seat numbers I will call. So say, for example, I am calling out the seat number 5, 15, 25. So now, am I unbiased? Am I giving every item equal chance of selection? No, actually. Why? Because even when I call out the numbers also, I'm following one sequence. Somehow, not consciously, but subconsciously, there is some sort of sequence I'm following. I'm not giving every item equal chance of selection. I want to give every item equal chance of selection. I don't want to have any kind of partiality towards any item. Now, what I can do? I can take the help of something called random number tables, statistical tools these are. Or even I can go to the Google and search for random number generators. You can go and select random number generators. So even Excel also you can use. You can make use of Microsoft Excel also to generate the random numbers. So I will open the Google and I will search for random number generator. I will enter the starting seed number 1 to 100. I want some 10 random numbers. I will generate. Now the system has told 56. I will pick up roll number 56. Or then I clicked once again generate random number. It was telling 98. So I will pick number 98. So like this random. Now am I unbiased? Yes, I am unbiased. So this method of selection of sample where every item will have an equal chance of selection, but to make sure that I am making use of some statistical tools like random number tables, random generators, online tools, that I call it as random sampling. Simple random sampling, whatever I have told. Okay. Now if I extrapolate this example, see in our class, girls are also there, boys are also there. I want to give equal priority. I need 10 people. Out of 10 people, I want equal number of girls, equal number of boys. Now I am following the same approach. I'm generating the random number tables, random numbers they are giving, and that what is happening is that number I am picking. So like that, say for example, some 10 numbers I have called 52, 61, 99 like that. Can you give me? I have given equal chance for boys and girls here. No. Why? Because whatever roll numbers I have called, everybody can be a girl or everybody can be a boy, or I can get 7 members boys or 3 members girls. In any combination I can get, but I want to make sure that I want equal percentage of boys and girls. So for that, what I need to do is first I need to this population is having different characteristics. I need to divide this entire population into subpopulation having similar characteristics. You are a population having dissimilar characteristics and we want to divide this into subpopulation having similar characteristics. So I have divided a group of girls, I have divided a group of boys. So I arranged all the girls at one place, I arranged all the boys at one place. This process of bifurcation, this process of division of larger population having dissimilar characteristics into smaller population having similar characteristics, that I call it as stratification. So I have divided. Say for example, in the initial, in the 30-40 seats girls are there, in the back 60 seats boys are there. Okay, so now I want 5 people from each subgroup. Now what I will do, so girls are sitting from seat number 1 to 40. So what I will do, once again I will go to the random number generator. So I will enter minimum value 1, maximum value 40, enter 5 numbers there. From the boys are sitting from 41 to 60. So once again I will enter 41 to 60 minimum to maximum. I will enter 41 to 100. So I will generate 5 random numbers. I will pick 5 boys. So now what I have done, I used random sampling. And I made sure that different characteristics and all getting covered in my population. And this I made sure by doing a process called stratification. First I did the stratification, then I made use of simple random sampling. This entire process I call it as a stratified random sampling. This entire process I'm going to call it as what? Stratified random sampling. And stratified random sampling is the most widely, very frequently used method of sampling. Even Big Four entities also use the same thing in many areas. Okay, and you can divide the population into subpopulation in many ways. On different ways you can divide. Like I'm talking about this class, I have divided it on the basis of gender. I can divide it on the basis of age. I can divide it on the basis of many reasons. So even in the books of accounts also, when I'm checking the financial data, I can divide the population into subpopulation on many bases. If I'm verifying purchases, I can divide the purchase transactions on the basis of vendor, from which vendor I am purchasing. I can divide the transactions on the basis of period of the financial statements. I can divide the transactions even on the basis of value. 1 lakh to 5 lakhs, 5 lakhs to 10 lakhs, more than 10 lakhs. So I can do the stratification in multiple ways. Clear? Right. So simple random sampling, stratified random sampling, we are done. Then coming to the next method of sampling, which is interval sampling or systematic sampling. Now what is this interval sampling or systematic sampling? Now we have to do some math. Advanced math we have to do. What is the advanced math? Division we have to do, advanced math. So in the sampling interval, in the interval sampling or systematic sampling, we need to do one math. What is that math is? You need to divide the size of the population with required sample size. Say for example, I have a total of 10,000 items. I have a total of how many? 10,000 items. Out of that, I need a population of 1,000. By dividing this, you will get a figure. What is that figure here? 10. So this I call it as sampling interval. So now what I will do is, since the sampling interval is 10, first I will take first 10 items. 1 to 10 items. I will not take, just I will go to first 10 items. I will pick randomly one number. In the first 10 items, say for example, I have picked a number 5. Now, fifth item I will select. After that, every 10th item. 5 to 15, 15 to 25, 25 to 35. Able to understand? First I will decide sampling interval. I will come to the first interval. One random number I will choose. From there onwards, every nth item. Say some sampling interval is number n. Every nth item I will pick into my sample. This method I call it as interval sampling or systematic sampling. Not effective. Why? Because here also there is no complete elimination of bias. Some sort of bias is there. Then we have something called monetary unit sampling. The other name for monetary unit sampling is value weighted selection. Basically, if you are giving importance, instead of giving importance to the number of the transactions, if you are giving importance to value of the transactions in selecting the sample, that method we call it as value weighted selection. Like if I am saying whatever transactions are there which are more than 10 lakhs, that I will verify 100%. Whatever transactions are there which are from 5 lakhs to 10 lakh rupees, that I will verify at that from that population I will verify 20%. Less than 5 lakhs, I will verify only 10%. So your sampling decisions are driven by value of the transactions. So that kind of methods we call it as value weighted selection or monetary unit sampling. And then finally, block sampling. Not finally, one more thing is also there after that. So block sampling we have. So what do you mean by block sampling? In the block sampling, instead of picking, in normal cases, we pick one item. But in the case of block sampling, what I do is I pick a series of continuous items. See, if I have to give you one example, you are all sitting here. I need some 10 people. I told third row, entire third row will come in my sample. So this is about block sampling. Whatever things I want in my sample, instead of picking one item, I have selected a block of continuous items. So that I call it as block sampling. But block sampling is not advantageous. Why not advantageous? Because generally items will be arranged in a sequence, and the items which are arranged in a sequence tend to have similar characteristics. See, generally, even in the class example also, if you take, friends only will sit together. No, hey, imagine here. I know you will sit like that only. So friends will sit together, and generally whatever characteristics, generally that group will have similar characteristics. So if people are sitting together, generally those who are serious, if 5 people are sitting together, all that 5 people might be serious and they might be listening to the classes. And sometimes what will happen is 5 friends have sat together, no one of them is having an intention to listen to the class. Generally data will be arranged in that manner. Yeah, generally classes will be, you sit also in that order only. No, if a group is there, that group mostly tend to have similar characteristics, because then only bonding will happen. Bonding in the sense friendship. Okay. So then only friendship will happen. So then only we'll be able to sit together. Right. So even when you take the financial data also, data will be arranged in one sequence, either chronological order or alphabetical order or value based order. Somehow a sequence will be there. When you pick a block of items, what will happen is those items which have a similar characteristics will get picked up. You will not be able to cover the other characteristics. So that's why this method is not that effective. Then we have last one, which is what? Haphazard sampling. What is haphazard sampling? The name itself says you don't follow any structured method. You don't have any method. Like for example, I'm closing my eyes and pointing my finger. That person will come into my sample. So this is what I call it as haphazard sampling. So I did not use any specific technique, but at the same time, I made sure that there is no bias. So that method we call it as haphazard sampling. It is more or less a kind of random sampling only, but without using the random number tables. We are eliminating bias, but at the same time, we are not following any such specific technique. So that's why this we call it as haphazard sampling. Haphazard sampling is also not at all effective. It is also very rarely used method. Why? Because it is difficult to prove your point at a later point of time. Say for example, you closed your eyes and picked some 10 invoices and did the verification. Tomorrow, if some complaint comes against you, you did not do the verification properly. I told sir I did sampling. How you did the sampling? Judge is asking. You are telling I closed my eyes. You are showing a video where you are closing your eyes and picking some 10 items. Doesn't sound good, no? So that's why it is difficult to establish. So haphazard sampling will not be used will not be used at all in the industry. So these are 5 methods for sampling. Right. So then if you come back to, so I was saying something no before this. 3 terms: sample design, sample size, and sample selection. And what are the requirements for this? So talking about 3 decisions you are required to take in the case of sample. You have to decide on sample design, you have to decide on sample size, and you have to decide on sample selection. So what is sample design? Sample design means now I have told multiple methods are there. Which method you have to use? You have to take that decision. So how you will decide which sample design will be suitable? That depends on the purpose of the audit procedures, and it also depends on the characteristics of the population. Like if I have to say one simple logic here, if the transactions are homogeneous, simple random sampling will work. If the transactions are heterogeneous, having dissimilar transactions, then we need stratified random sampling. So which method, which sample design you want, that decision will be influenced by the purpose of audit procedures you are performing and the characteristics of the population. Similarly, sample size. Sample size, they did not say exactly. The standard did not say exactly 10% sample you should have, 5% sample you should have, or in your sample minimum 500 items should be there. They did not say it. Then what they told? They did not say what is the exact sample size. Then what they would have told? Professional judgment. So they told that you keep the sample size in such a manner. You keep such an amount of sample size which is sufficient to reduce your sampling risk to an acceptably low level. What they have told? You keep the sample size in such a manner that will reduce your sample size to an acceptably low. That means use your professional judgment. That's what simply they have told. Next, sample selection. How you are going to select the items? Very simple. If it is a statistical sampling, we use scientific methods and we give equal chance of selection for everything. If it is a non-statistical sampling, we use our professional judgment. That's it. Now, next important thing is what are the factors which affects the sample size? This is very important. So from here also very frequently they ask a question. So what are the factors? That means should you have more items? Should your sample size be bigger? Should your sample size be smaller? Should you have more items in your sample or should you have less items in your sample? That is depending on some factors. So what are that factors? And they actually give that factors for test of controls separately, for test of details separately. What are the factors which affect the sample size for test of controls? What are the factors which affect the sample size for test of details? Both they have given separately. Let us try to understand what are the factors which affect sample size for test of controls. What are the factors that affect sample size for test of details? First one, talking about the first thing, it depends on reliance placed by auditor on the internal controls. If you want to place more reliance on the internal controls, see in the test of controls, we try to verify internal controls to determine their operative effectiveness. So if you want to rely more on internal controls, will you verify more controls or less controls? More controls. If you want to rely more on internal controls, you will try to verify more controls. So between the internal control, between the reliance on internal controls and sample size, what kind of relationship exists? Direct relationship exists. So the greater the reliance auditor places on the operating effectiveness of the controls, the greater is the extent of sample size. So what relationship we have here? Direct relationship. And also it depends on tolerable rate of deviation. Tolerating I have already told. How much deviation auditor is willing to accept. If the auditor is willing to accept more deviation, the auditor is willing to accept more deviation, will he verify more controls or less controls? He will verify less controls. If he is not at all ready to accept any deviation, then he will do verification of more controls. What relationship exists here? Inverse relationship exists here. So first one is direct, second one is inverse. Next. Third one, expected rate of deviation. Something related to risk of material misstatement, you can say. If you are expecting more misstatements to happen, you will verify more internal controls. No. If you think that more misstatements will happen, there are more chances of deviation, we will try to verify more internal controls. If you expect less chances for deviation, you will verify less controls. Here what you have? Direct relationship you have once again. Next, it depends on the auditor's desired level of assurance. If you want more level of assurance, more internal controls you will verify. If you want less level of assurance, less internal controls you will verify. There is also here direct relationship. Next one, it also depends on size of the population, but they say size of the population will have very little effect on the sample size. Size of the population will have very little effect on the sample size, in the sense they are talking in terms of percentage. They're talking in terms of percentage. Like if I say I need 10% sample, if the population contains 10,000 items also, if the population contains 1 lakh items also, 10% will remain the same, no? Yes or no? So size of the population will have very little effect, if any, on the sample size. Right. So there will be negligible effect on the sample size due to increase in the number of sampling units in the population. This purely they are talking about the percentage terms, from the percentage terms. So these are the factors which affect sample size for test of controls. What are they? 5 we have. What are they? The reliance which auditor wants to place on internal controls. What kind of relationship does that have? Direct relationship. Tolerable rate of deviation. What kind of relationship does that have? Inverse relationship. Expected rate of deviation. Direct relationship. Very good. Desired level of assurance. Direct relationship. Size of the population. No relationship. Minimal effect or negligible effect, you have to write it. Next, what are the factors which affect the sample size for test of details? Number 1, risk of material misstatement. If you expect risk of material misstatement is high, what you will do? More substantive audit procedures you will perform. What relationship? Direct. Relying on other substantive audit procedures. Other substantive audit procedures means here they are talking about analytical procedures. Substantive audit procedures, you will do it on test of details also. You can do it by analytical procedures also. For analytical procedures, there is no concept of sampling. In analytical procedures, we do analysis of the ratios and all. Their sampling concept is not there. Where sampling will come? Test of details. See, if you want to rely more on analytical procedures, if you want to rely, here other substantive audit procedures means analytical procedures they are referring to. If you want to rely more on other substantive audit procedures, you will do less amount of test of details, no, less sample size. If you don't want to rely more on other substantive audit procedures, that means if you want to rely less on analytical procedures, you want to do more test of details. It is very difficult to put this into a relationship format. Let us keep it aside. Don't say direct, inverse and all this, you keep it aside. Next, desired level of assurance. This way anyhow know it was direct relationship. Tolerable misstatement. Inverse relationship. So lower the for example, if the auditor is willing to tolerate very less amount of misstatement, he will do more verification. If he is willing to tolerate more misstatement, he will do less verification. In inverse relationship. It also depends on expected misstatement. Expected misstatement is nothing but a other name for risk of material misstatement. If you are expecting more misstatement, more verification. If you are expecting less misstatement, less verification. Direct relationship once again. Stratification, nothing but different characteristics. If your population contains a different characteristics, you might need to increase your sample size a bit than when compared with the lesser stratification. Next one, size of the population. Here also they say negligible impact. Okay, so 7 factors they have told which affect the sample size for test of details. What are they? Risk of material misstatement, reliance on other substantive procedures, desired level of assurance, tolerable misstatement, expected misstatement, stratification, and size of the population. I want to explain one more small concept, and after that I will wind up this chapter sampling. One small thing which I want to bring it before you is projection of the misstatement. Projection is very important. Projection of the misstatement. So what is this projection of the misstatement? See, projection means estimation, I will say, in simple terms. Projection means estimation, I will say. So what they say here is, say for example, I have a population. 10,000 transactions are there. In that, I have taken one sample. Listen carefully, guys. This you face difficulty in learning on your own. So I will give one simple illustration to make the concept clear. So there is a population of 10,000 units. From this, I have taken a sample of 1,000 units. I will perform audit procedures on sample or population? Sample. I performed audit procedures in my sample, and in my sample, I found some 10 misstatements. How many? 10 misstatements. Now, I found 10 misstatements only by verification of sample. If I would have verified the entire population, I would have found out even more misstatements. I have to do that estimation. If in my sample 10 misstatements are there, how many misstatements could have been there in my entire population? That estimation you have to do. That estimation only we call it as projection. And that projection you should not do on the basis of number. Projection you should not do on the basis of number. Projection you have to do on the basis of value. Projection you have to do it on the basis of value. How you have to do that is, you have a total population of 10,000. Determine what is the value of the entire population. Say for example, it comes to some 200 crores. You have taken a sample of 1000 items. Determine what is the value of the sample. Say for example, value of the sample is 500 crores. Now you found 10 misstatements. Determine what is the value of the misstatement. Say for example, value of the 10 misstatements put together is some 20 lakh rupees. So now what you should do is, if in my 500 crores worth of sample, 10 lakhs worth of misstatements are there, how many misstatements will be there in my 200 crores of population? Now you do the math. In my 500 CR, I'm able to find 20 lakhs worth of misstatement. In 2000, know that? In 2000 crores of population, how much misstatement could be there? So do the math. 2000 into 20 divided by 50. 80 lakhs. So 80 lakhs will be my projected misstatement. This 80 lakhs I call it as what? Projected misstatement. And this projected misstatement will be compared with the materiality level. If it has exceeded, I will modify. If it is not exceeding, I will not modify. But there's a little point here. When you are projecting the misstatement, out of the misstatements, you have to divide the misstatements into two categories. How much is anomalous misstatement, or how much is anomaly, and how much is non-anomalous misstatement? Anomalous misstatement means those misstatements which are not repetitive in nature. They will not occur again and again. They are not representative. They will not occur again and again. Only once they will happen. The nature of misstatement is like that. So say for example, out of these 10 misstatements, I have one misstatement which is anomalous. The value of that one misstatement is 5 lakh. Remaining 9 misstatements are non-anomalous, which are repetitive in nature. The value of the remaining 9 misstatements is 15 lakh. Now for what value I have to do projection? Should I do projection for total identified misstatements, or anomalous misstatements, or non-anomalous misstatements? We have to do projection only for non-anomalous. Why? Because anomaly means non-repetitive. You should not do projection there. So non-anomalous misstatement you have to do projection. So out of 20 lakhs, out of 500 CR of population sample, I'm able to find 15 lakhs worth of anomalous misstatement. How much misstatement could be there in the 2000 crores of population? So now if you do the calculation, it will come to 60 lakhs. To this, I have to add anomalous misstatement without projection. What is anomalous misstatement? 5 lakh. So to this, you have to add that 5 lakhs. It will come to 65 lakhs. This is the total projected misstatement that you have to compare it with the materiality level. Understood? Clear? And one more point also they say in the answer, which is quite confusing. They say for test of details, you need to do projection. For test of controls, you should not do projection. For test of controls, projection is not required. Why? Because whatever sample deviation is there, the same will be the population deviation also. For test of details, we need to do projection. But for test of controls, there is no requirement to do projection. Why? Because sample deviation itself is a population deviation. Like say for example, in test of controls, we have an internal control. When we test internal controls, say for example, one internal control is there. In that internal control, there is a problem. I have verified some transactions. 100 transactions I have verified. After every 9 transactions, 10th transaction is going fault. Some error is there. Some coding error is there. Some internal control coding error is there. That internal control will process 9 transactions correctly. 10th transaction will always be a failure. That means in 10 transactions, what is the deviation I am getting here? 10%. Since there is a problem with the internal control only, no matter, even if you pass through it 1 lakh transactions also, the deviation will be same 10%. Yes or no? Able to understand? So that's why in the case of test of controls, no need to do explicit projection. Why? Because sample deviation itself is going to be a population deviation. No explicit projection will be required. That's all. This is what regarding projection of the misstatement. With this, we will wind up audit sampling chapter. Okay. Did you expect that I am going to wind up the session only? One more chapter I will take up. Right. So let us try to come to the next chapter, which is analytical procedures. What, you don't want analytical procedures? Hey, why? Because I'm saying is automated environment also just like reading of the chapter only. So very straight away direct points will be there. I don't think that is a time well spent. I want to spend good time with you. Okay. So conceptual things I want to teach you. Kindly do accept it. If I am teaching something, I would have thought of something. Okay. Right. So I'm doing it for your benefit only. So automated environment is not something which I which I don't think you guys deserve that chapter. I mean, not in a wrong way. That chapter doesn't deserve you. Okay. Okay. So analytical procedures I will teach. What? Bank or no bank audit, nothing. Listen. So what is analytical procedure? Tell me what is analytical procedure? See, till now we are saying in the analytical procedures, we don't do that routine checking and all. We don't do all that labor work of verification and all. But instead what we do is we apply our mind. This is where your actual skill and analysis will come into picture. So till now I was saying, when I say analytical procedures, analytical procedures involve study of relationship between financial and non-financial items. But here I'm going to change that narrative. I'm going to change the narrative. So till now I was saying it is a study of relationship between financial and non-financial, but actually not. Analytical procedures is a study of relationship between financial and financial information, and it also involves a study of relationship between financial and non-financial information. We also try to study relationship between two financial items also. We also try to study relationship between financial and non-financial items also. And what about non-financial? Nothing, no use, because you are studying relationship to evaluate financial information. So at least one aspect should be financial information. No, right? So it involves a study of relationship between financial and financial. It also involves study of relationship between financial and non-financial. Like if you see gross profit ratio, gross profit is a financial and financial. Gross profit and sales, net profit percentage, fixed assets turnover, debtors turnover. These are all examples of studying of relationship between two financial ratios. And if I say study of relationship between financial and non-financial, like if I say employees and employees and wages, or it could be what I can say. hmm, what is here? Electricity bills, electricity units consumed versus electricity bill. So like this, I can do multiple kinds of analysis. So what is the ultimate purpose is, in analytical procedures, I study the relationship between plausible items of financial and non-financial data. From that, I am going to evaluate whether the financial information is correct or not. My ultimate objective is to evaluate financial information. But that evaluation, I am doing it by way of studying relationship between financial and financial or financial and non-financial. Now, if you come to the concept here, I calculated gross profit ratio. So I calculated gross profit ratio, 30 CR is a gross profit, 100 CR is a sale, gross profit is 30%. That's all. Analytical procedures is over. Here you have just done calculation of the ratios. Just you have calculated the relationship. Then what you should do is, the second step is comparison. Second step is what? Comparison. With what you will compare? You can do inter-firm comparison, or even you can do intra-firm comparison. So what do you mean by inter-firm comparison? Okay, give me examples. What kinds of inter-firm examination you can do? So you can compare this entity with the competitors' data. You can compare this entity's data with the industry average. Like if I'm conducting audit of IT company will not have gross profit, no? Automobile company. So if I'm conducting audit of automobile company, Maruti Suzuki company audit I am doing. So I calculated gross profit ratio of Maruti Suzuki. I can compare that with Tata Motors. I can compare that with Mahindra, or I can compare that with the industry average. Then, or I can do intra-firm comparison. What is intra-firm comparison? I calculated gross profit of the current year. I can compare it with the previous year. I can compare it with the budgets. So I can do that comparison. So first step is calculation of the ratio. Second step is comparison. Okay, boss, you will compare. What will happen? Current year, you have compared the current year with the previous year. Previous year it was 40. Current year it was 30. 10% fall has come. You did the comparison. That's all. You found a misstatement? No. Just by doing the comparison, you will not find any misstatement. See, this reduction could be because of genuine reason also. When compared with the last year, current year, the raw material prices have gone up. That's why the price has fallen. That also could be a reason. So the third step, by doing comparison, you will find difference. But the moment you find a difference, that doesn't mean that is automatically a misstatement. You need to investigate. What you need to do? You need to investigate that difference to find out, is that difference is because of a genuine reason, or is that reason is because of a material misstatement. Understood? So these are the four things which will be involved in the analytical procedures. Number one, what is number one? You need to calculate the ratio. Number two, comparison. Number three, you have to find out the differences. Number four, you have to investigate the differences. Okay, right. So what is the purpose of analytical procedure? What is the purpose of analytical procedure? Number one, the main purpose of any audit procedure, not just analytical procedures, the purpose of any audit procedure is to obtain audit evidence. Is to obtain audit evidence. But if you pay close attention, analytical procedure is actually a method. You can use that as a substantive audit procedure. You can also use that as a risk assessment procedure. In today morning session only, when we discuss a risk assessment in internal control chapter, I have told what methods we can use it for performing risk assessment procedures. We can use inquiry, inspection, observation, and analytical procedures. Analytical procedures is actually a method which can be either used as a risk assessment procedure and also as a substantive audit procedure. If you are using risk assessment procedure as a substantive audit procedure, your purpose is to obtain sufficient and appropriate audit evidence. If you are using analytical procedure as a risk assessment procedure, your objective is to identify the risk of material misstatement. So it has two purposes. If you are using it as substantive audit procedure, your purpose is to obtain sufficient and appropriate audit evidence. If you are using it as a risk assessment procedure, your objective is to identify and assess the risk of material misstatement. And also one more thing they say, you can also use analytical procedures at the end of the audit also. At the beginning, we use it as a risk assessment procedure. At the actual execution, at the actual testing phase, we use it as a substantive audit procedure. And even we can use it at the conclusion phase also. How we can use it at the conclusion phase is, whatever understanding you have obtained regarding the entity, whether the same information is reflected in the financial statements or not. You get some basic understanding. Just before you form the conclusion, you will just evaluate whatever information that is reflected in the financial statements, is that matching with the understanding whatever you have obtained regarding the entity. So that for finding that, hello, gone. Fine. So I was saying, even analytical procedures can be used at the conclusion of the audit also, just to determine whatever information that has been reflected in the financial statements, is it matching with the understanding whatever you have obtained. So basically, you can use analytical procedures at all the three phases of the audit. At the beginning phase as a risk assessment procedure, at a testing phase as a substantive audit procedure, and even at the conclusion phase. At all the four stages, you can use it. Three stages, sorry. See, there is analytical procedure, and sometimes they use the term substantive analytical procedures. At various places, you will be able to find the term called substantive analytical procedure. So now, what is an analytical procedure? What is a substantive analytical procedure? Very simple. As I was saying, analytical procedures can be used as a risk assessment procedure, or it also can be used as a substantive audit procedure. If you are using analytical procedure as a substantive audit procedure, that we call it as substantive analytical procedures. And whether you will use test of details or you will use analytical procedures for performing substantive audit procedures, it once again depends on professional judgment of the audit. So that is completely your choice. By performing substantive audit procedures, you need to obtain sufficient and appropriate audit evidence. And how you will do that, whether by doing test of details or by doing analytical procedures, that is completely your choice. Use your professional judgment and decide accordingly. Then coming to next few things. So we have covered all the first four questions. Now coming to the next question. So what factors you will consider while taking decisions relating to substantive analytical procedure? I told whether you will perform substantive procedures as a test of details or as analytical procedures, that depends on various factors now. So what are the factors? That depends on professional judgment. But that professional judgment will be influenced by various factors. What are that factors? Number one, availability of data. In order to perform analytical procedures, you need data. Current year's data you want. If you want to get interest rate comparison, competitors data you want. If you want to do intra firm comparison, you have to get previous year's data. If all the data is available, I will perform analytical. If the data is not available, I will not risk myself for doing analytical procedures. I will do test of details. It also depends on disaggregation. Nothing but disaggregation and all I will cover later. Anyhow, we have one more point in the subsequent question. This you keep it on hold. Account type. See, some items will be suitable for analytical procedures. Some items will not be suitable for analytical procedures. It depends on the account type also. It depends on source. Source means nothing but once again reliability. If you are getting the data from a reliable source, see, availability of data alone will not be enough. That data should be reliable also. If the data is reliable, you have data, but data is also reliable. I will be comfortable in using analytical procedures. If the data is not reliable, I will be better off making test of details. Predictability. The most important thing, if you have to perform analytical procedures, there should be predictability. That means one item can be predicted on the basis of another item. Some sort of relationship must exist. If that predictability is there, then only I can perform analytical procedures. If the predictability is not there, if one item doesn't bear any relationship with the other item, I can't perform analytical procedures there. It also depends on nature of assertion. Say for example, if you want to know completeness, accuracy, valuation, then analytical procedures will become applicable. If you want to verify ownership assertion, you want to know whether company is the owner of the assets or not. You want to know. For that, you can't use analytical procedures. For that, you have to compulsorily do inspection. Test of details only you are required to do. And also it depends on what can go wrong. Basically, more or less kind of risk of material misstatement. If the chances of happening misstatement are very high, I will prefer test of details. Analytical procedures, we are not going into details, so little bit risky. If risk is very high, if the chances of happening something wrong are very high, I better go with test of details, not on analytical procedures. Next. Now, what techniques are available for performing analytical procedures? 4 techniques are available for performing analytical procedures. One is trend analysis, then we have ratio analysis, reasonableness test, and structural modeling. Sir, what happens in trend analysis? See, here I will not do inter-firm comparison, but I will do intra-firm comparison. So I will track how the item is moving over a period of time. I will calculate the trend, like for example, revenue and all. I will see in the last 5 years how the trend is. I will see whether in the current year the movement is in line with the trend or not. If it has broken the trend, I will try to investigate further whether it is because of a genuine reason or because of a misstatement. Then ratio analysis. In the ratio analysis, what I do is I pick 2 financial items and study the relationship and do the comparisons. Next one, reasonableness test. In the reasonableness test, what I do is I don't go to the previous year. I also don't study relationship between 2 financial items. If I go to the previous years, that is trend analysis. If I try to study the relationship between 2 financial items, that is ratio analysis. Then what I do in the reasonableness test is I study relationship between financial and non-financial item, the two of the same current year. The two same current year only I will check. Like for example, one example they give here. They say management is saying they have 10 lakhs worth of stock in the balance sheet date. That I will try to match it with storage space. Whether they have that much storage space to hold that stock or not. So that I am doing the comparison. So I'm not going to past year. I'm not studying relationship between 2 financial items. I have taken one financial item and related non-financial item, that too of the same year. Next one, structural modeling. These are all some statistical tools. Using some statistical concepts and statistical tools, you can analyze the data. You can predict the data. So that we call it as structural modeling. So these are the 4 methods available, 4 techniques available for performing analytical procedures. Next. So question number 7 talks about, if you want to perform analytical procedure as a substantive audit procedures, it involves 4 steps. Each of that step has been explained as a separate question. 8, 9, 10, 11. Each question will be talking about each step. So first one is suitability. You have multiple techniques. Like as I have told, you have trend analysis, you have ratio analysis, you have reasonable test, you have structural modeling. You have, first you need to determine, if you want to use analytical procedure, first you need to determine which one is suitable. So once again, as I have told, that depends on The ultimate conclusion, what they say in the entire answer is no specific rule, use your professional judgment. But they will not say it in a straightforward manner. They try to say ghuma ghuma ke they will say. So what they are trying to say here is, if you see, substantive analytical procedures are generally more applicable to large transactions that tend to be predictable. I have already told you, if predictability is there, analytical procedures. If predictability is not there, no analytical procedure. However, the suitability of a particular analytical procedure will depend upon auditor's assessment of how effective it will be. Nothing but it depends on your professional judgment. Sometimes a simple, unsophisticated predictive model also can be effective. When compared with the last year, revenue has increased, but when I see the profit has fallen. I investigated, I found a fraud. It is not a rocket science. Simple, unsophisticated model. Sometimes that also will work, but always it will not work. Sometimes even simple things also will give you better results. And different kinds of analytical procedures will provide different levels of assurance, and which technique you have to use, that depends on nature of the assertion and assessment of risk of material misstatement. So the first step is you have to determine suitability, which analytical procedure will be suitable for which assertion. Second one, you have to evaluate reliability of the data. See, in analytical procedures, we are basically comparing the data, current year's data with other entities, or current year's data with the past years. If you expect the results of analytical procedures to be reliable, then the data which you are using should be reliable. If the data which you are using for performing analytical procedures, if that is not reliable, even the results of the analytical procedures will not be reliable. So once you have determined which analytical procedure will be suitable, the next step is you have to determine whether the data is reliable or not. How can you determine the reliability of data? Number one, it depends on source from which you are getting. If you are getting it from an external source, reliable source, then it will be reliable. It also depends on comparability. The data which you are using is comparable. If you are able to compare, then you can determine its reliability. If you have such a data which you can't compare, like for example, this is also one of an example I use. Amazon, if you are starting an e-commerce platform, that e-commerce platform data, you can compare it with competitors like Flipkart and all. There are many businesses out there. If you are into business of selling customized products, say for example, you are selling the products which are this camera. I'm selling the camera with the names engraved, or I'm selling some camera where you start shooting, your name will come automatically on the screen, something like that. Okay, so these products I'm selling online. This data I want to compare with another entity. Only one more entity is there. Only one kind of industry, only one kind of company is there which does the same business. Now I want to use that company's data, but I will not be able to determine reliability. Why I will not be able to determine reliability? That data I can't compare with anybody else. If I don't have comparability, I can't determine reliability. So whether data is reliable or not, that depends on comparability also. It also depends on nature and relevance of information available. How relevant information is. Like for example, if you want to use the budgets will be reliable only when they are realistic. When a company is preparing budgets, they should keep in mind what is achievable. So company in the last year, they have made a turnover of 100 crores. In the budget, they have told in the current year, we will make 1000 crores. Will it be reliable? No. Why? Because the budgets are not relevant here. They are not realistic. Then also it will not be reliable. It also depends on controls over the preparation of the information. So whatever controls that are operating over the preparation of the information, if that controls are effective, data will be reliable. If that controls are not effective, data will not be reliable. So second step in performing analytical procedures is you have to determine the suitability of reliability of the data. That depends on four things. What are that four things? Source from which you got the information, comparability of that information, nature and relevance of that information, and controls over the preparation of that information. Clear? Next. Third step. Okay, you have determined suitability, you have determined reliability. The third step is explain the matters relevant to the auditor's evaluation of whether the expectation developed sufficiently precisely to identify a misstatement may cause the financial statements to be materially misstated. I know you will not understand this. I will tell. So, what they are trying to say here is, so we need to understand this question in a proper perspective. So what they say here is, whatever expectation that you have developed using a analytical procedure, whether that will result in a material misstatement or not. That depends on what factors. So which means here they say expectation developed using analytical procedure. What do you mean by expectation developed using analytical procedure? That deviation. Say for example, I compared gross profit ratio. Okay. So I compared some ratio, gross profit ratio I have compared. So last year it was 30%, current year it was 40%. Difference is there, 10%. Now I have to investigate that difference. This is the expectation. I found a deviation by comparing some data, by calculating some ratio. Now, if I investigate this further, there could be two options. One is my analysis will be fruitful. I can find out a misstatement. Sometimes I will realize that till now I was doing the analysis at a wrong place. Whatever expectation that you had by performing analytical procedures, even though you found a deviation, even though you investigate further, you will not be able to find a investment. Sorry, you will not be able to find a misstatement. You might be doing a wrong analysis. So whether the expectation that you have developed using analytical procedures, whether that will result in a material misstatement or you will end up doing wrong analysis, that depends on what factors. If I start explaining the points, then things will start to settle down. So what they're trying to say once again, whatever expectation that you have developed using analytical procedure, whether that will result in a material misstatement or that will result in a wrong analysis, that depends on what factors. Factor number one, they say the accuracy with which the expected results can be predicted. If the item on which you are performing analytical procedures, if that is more predictable, if you can predict that with more accuracy, then in that case, if you investigate, more chances you will be able to find out the misstatement. Like for example, gross profit. If I am comparing gross profit, Tata Motors, Maruti Suzuki, you take, both are into same line of business. They have same cars selling at the same ranges, and also raw material price is also same for both. So they should have gross profit margin, same, more or less the same. If I know gross profit margin of Tata Motors, I can accurately, easily predict the gross profit margin of Maruti Suzuki also. Say for example, I came to know Tata Motors gross profit margin is 40%. And what is the expectation regarding Maruti Suzuki's gross profit margin? More or less 40%. But I came to know that Maruti Suzuki is having 60% gross profit margin. If I investigate, difference is that 20%. If I investigate that further, there are more chances for finding out a material misstatement or there are more chances for ending up with wrong analysis. Able to understand my question? Gross profit comparison I am doing. I found a deviation. If I investigate that further, what are the chances? For which the chances are higher? For identifying a misstatement, the chances are higher, or for ending up with wrong analysis, the chances are higher. For identifying the misstatement, the chances are much higher. Why? Because gross profit is predictable with even accuracy. Yes or no? On the other hand, say for example, I am doing analysis on research and development expenditure. I calculated one ratio, research and development expenditure as a percentage of sales. Tata Motors is spending 10% on research and development. I calculated same ratio for Maruti Suzuki. They are spending only 2%. I found a deviation, 8% deviation is there. If I investigate that deviation, the chances for finding out material misstatement are higher or the chances for ending up with wrong analysis are higher? The chances for ending up with wrong analysis are higher. Why? Because you are performing analytical procedures on such information which cannot be predicted with that accuracy. Understood? The more accuracy in prediction, the better will be the results. Next, second one, the degree to which information can be segregated. If you are able to segregate the information and perform analytical procedures, then the more chances are you will find out material misstatement. Say for example, Reliance Industries Limited is there. Reliance Industries Limited is into multiple business. Main business is crude, oil extraction and all. Now I calculated gross profit percentage of Reliance. I also calculated gross profit percentage of ONGC. I did the comparison. I found a difference. If I investigate that difference, the chances of finding out material misstatement are higher or ending up with wrong analysis are higher. The chances of ending up with wrong analysis are higher. Why? Because Reliance is a multiple business entity. So main business is oil extraction, but it is having multiple businesses. But ONGC it is having only one business, which is oil extraction. So here if I even investigate also, the chances are ending up with wrong analysis are much higher. But instead of doing like this, if I segregated the information, in the reliance of the total information, I have segregated only crude business related information. For crude business alone, I have calculated the ratio. That ratio I have compared with ONGC. There, if I find deviation, if I investigate that further, the chances of finding out misstatement are higher, or chances of ending up with wrong analysis higher. Chances of finding out the misstatement is higher. So if you are able to disaggregate the information, if you are able to separate the information and perform the analytical procedures, then the chances of identifying misstatement are high. If you are doing analytical procedures on consolidated information, the chances for ending up with wrong analysis is high. Then last one, it also depends on availability of the data. Say for example, I am doing some analytical procedure. My client company, I have 100%, 12 months data. Competitor, I have 6 months of data only. I calculated gross profit ratio for my client on 12 months, for my competitor on 6 months. Compared the ratio, deviation I got, investigated further. Chances of ending up with wrong analysis are much higher, or material misstatement. There are more chances for ending up with wrong analysis. Why? Because you are performing analytical procedures on incomplete data. On the other hand, if you have for your client also 12 months of data, competitor also 12 months of data, there you find a mistake, there you find a deviation, investigated further, there the chances for finding out the material misstatement are much higher than when compared with the other case. Understood? Clear? So three factors will decide whether expectation you developed using analytical procedure will result in a material misstatement or not. What are they? Accuracy with which you are predicting the results, degree to which the information can be disaggregated, and finally availability of the information. See, this is the third step. First step is suitability, second step is reliability, third step is expectation will help in identifying material misstatement or not. Then finally, what is the last step? Whatever differences you have found out, that you have to investigate. How you have to investigate? Inquire with the management. Go and ask the management, sir, I found a deviation, please help me out, tell me the reasons why such a deviations are there. If the management is not giving you enough of information, then you need to perform alternative audit procedures. If alternative audit procedures are also not possible, then you have to give a modified audit or analytical procedures. So that's all as a part of this marathon, as a part of this live face-to-face marathon. So this is what I have to, this is what I could deliver before you within the time available.